Get you up to speed now on the Federal Reserve and a surprising report. The United Nations warning the Fed risks causing significant harm to developing countries if it continues with these steep rate hikes. The UN Conference on Trade and Development saying interest rate increases to date will reduce poor countries' economic output by $360 billion over 3 years, and additional increases would result in further harm. Secretary General Rebecca Greenspan saying, quote, "There's still time to step back from the edge of the recession," adding, "We have the tools to calm inflation and support vulnerable groups." A very interesting warning from the UN.
Tracking stock futures this morning higher for the Dow, the S&P 500, and the Nasdaq, and this after the market routes deepened on Friday to end a dismal third quarter. So here to discuss what to expect in Q4, the fourth quarter, we've got Matt Miskin, who is the John Hancock Investment Management Co-Chief Investment Strategist. Just great to have you here with us this morning, Matt. First and foremost, when we think back to what the third quarter was and what could possibly protrude into the fourth quarter here, what would you be keeping your eyes on?
Yeah, the third quarter was one of the trickiest one investors have faced. And one of the things we look at when we go underneath the hood of the overall market is risk on parts of the market did better than risk off. And what I mean by that is things like U.S. small caps outperformed, consumer discretionary did well, which is a very cyclical sector, and high yield bonds and bank loans did well. So those are all high beta, higher risk parts of the market. And yet overall markets were down 5 to 10%, depending on where you went. So it was very tricky to manage risk in a down market when risk on parts of the market did better. Our view is that that part of the market, the risk on parts of the market, start to turn and lag the overall markets into the fourth quarter. And defense will start showing up, whether it's in the bond market, whether it's in higher quality stocks as the year goes on.
Matt, can you make any short-term bull case for stocks?
Oversold is one that, basically we're at these levels where it's been seeing selling pressure. Sentiment is washed out, meaning that, everyone is pretty bearish. Even the strategists out there that have been more bullish have kind of turned and become more bearish. So that's, in our work, one of the things we do is we tap all these resources of our broker dealers, research firms. And it's amazing how many are bearish right now. So if we get any good news, like, the Fed pivots a little bit, if Treasury yields just stop going up, if oil prices came down, although we're not seeing that today, those would all be things that could make a short-term bounce in global equities.
Matt, you say in your note to us that the Fed is taking down the housing market, the financial markets, eventually the labor markets, because they are so focused on inflation. And you, like many folks, are saying this stuff operates with a lag. The Fed might benefit from slowing down. The Fed does not seem like it's listening, right? Is the Fed at risk of making a big policy mistake here?
Absolutely, Julie, they are. And they're bringing it right to the brink. It's almost like they're playing a game of chicken with the labor market. And unfortunately, that's just not a great way to run monetary policy. It's almost like they want things done immediately. I almost think of like the Amazon effect, where you press a button and you want something delivered at your door the next day. The Fed wants that with inflation. They want to basically say inflation's coming down this month. And it just doesn't work like that. What they're doing today is actually going to show up in terms of tightening in the economy next year. And so you can't just stop inflation in its tracks. If you do want to, which that's what they want to do, the best way to do it is cause a global recession. But the thing is, you're bringing in all these other risks into the picture. And by the time the data shows up, it's actually too late. And then they're going to be pivoting on to another problem that they've created, which is, in this example, a weakening labor market. But we think that's going to happen next year. And we think eventually bonds rally as a result of that. And there's attractive income there because they're overshooting to the upside.
Matt, when you say global recession, what type of global recession are the markets pricing in right now?
So it's mixed. It's not as bad as you might think. So overall stocks are down. So that would suggest, some pricing in a recession. But high yield bond spreads are still pretty tight, around 500 basis points. Historically, that's a 20-year average. Again, you're seeing even cyclical parts of the market do decent. Oil prices are still very high. So there's earnings estimates, for example, haven't come down that much. So there are parts of the market that aren't really pricing a recession in our view. Treasury yield, again, going up all the time. That's not pricing in a recession. So you can lean into certain parts of the market, get income right now, and in our view, position for a recession that hasn't been priced in. And in portfolios, that's what we're looking for as best ideas to actually see positive income streams, decent risk-adjusted returns in what can continue to be a choppy backdrop.
John Hancock, Co-Chief Investment Strategist Matt Miskin. Always good to see you. We'll talk to you soon.
Good to see you, Brian.
Good morning, everyone. U.S. stock futures have dipped into the red this morning as they were green earlier. We're barely positive. We're now barely to the downside. The Dow futures down by about 0.2%. S&P 500 futures flat but to the downside. And the NASDAQ futures, you're also seeing that lower by about 0.2%. And that's all today following yesterday's sell-off as the third quarter comes to a close. But our next guest says the likelihood of a global recession is far from certain. Invesco Investment Solutions Senior Portfolio Manager Alessio De Longis joins us now in studio. Alessio, great to have you here with us. Help us not just kind of wrap up the quarter, but also kind of put in perspective what markets are clearly pricing in right now and the risk of a global recession.
Thank you for having me. Yes, look, I think the recession is our base case, right? It is the more than a 50% probability at this point. But it's important to focus on the fact that the economy, time and time again, has shown very dynamic ways of adjusting, and we should never underestimate that there is a still relatively good probability of a good case scenario. To go back to your earlier question, what is priced? My concern is that when you look at recession pricing is not correct. Particularly the equity market has just begun, I would say, in the last couple of weeks, really to price in more seriously the risk of a recession. Why? If you look year to date, many people say, look, the market is already down 20-25%. Isn't that the average correction during a recession? Yes, except that bond markets are down as much. By definition, a recession implies underperformance of equities over bonds because earnings have to correct lower. So far, equities are simply pricing in the fact that discount yields, that government bond yields have gone up. So whatever value your cash flows had, it's now lower. But we haven't priced in a recession. Earnings have not begun to correct. You see the data this morning. Consumers are still growing. Consumption is still there. Inflation is still surprising to the upside. That is not an economy in recession.
If people go and check their accounts this week and for the first time, let's say in 3 months, they're going to be shocked because this was it was a terrible quarter. Having said that, what should they be doing and how do you prepare for the fourth quarter in this environment?
That is the black swan that this generation of investor has lived. The worst bond bear market since records have been kept. You see more and more historical data saying this was the worst since 1926. Oh, wait, we found a new database. It actually takes us to 1876. It's even worse, right? I think what we are doing in our portfolios is we are reducing the weight of the equity exposure into bonds. We have now, for the first time since 2008, a golden opportunity to buy high-quality investment AAA credit at 5%. Your cash, your bank account is soon gonna
why even bother buying stocks? If you can get 5% on credit, why even touch tech stocks?
So tech stocks, interestingly enough, obviously we all have to have some equity exposure within equities, and I think you bring a very important point. Within equities, shifting towards the more defensive sectors. Now, interestingly, and this may sound controversial, I think tech or communication services are actually defensive. Their underperformance year to date has been primarily driven by the rise in bond yields.
All tech, or is it kind of focused in on some sectors or subsectors within tech?
Great question. Larger capitalization, dominant big tech companies, where you have large return on assets, very wide profit margins, positions of almost total control of dominant players in the market, and low leverage. So those are the characteristics of defensiveness, of quality, right? So the big, large quality stocks. That can hold its value, and it will hold its value, especially if rates peak year also, we have a golden opportunity to rebuild exposures to thematic, strategic items such as technological revolution, digital revolution, at 30-40% discounts. Those themes aren't going away.
What should I be doing in this environment? Just internally, what questions should I be asking myself? Should I even be an investor?
You should. So, don't look in the rearview mirror. The past is the past. That's rule number one. First of all, the only lessons from the past is, are you able to stomach again what just happened? If the answer is yes, stay the course. If the answer is no, revisit your strategy. So what the market has done in the past is just an opportunity for you to test your behavioral comfort zones. Otherwise, stick to your plan. And the plan here, I think, always stay invested. Going to cash has worked for the last 3 quarters, but historically, it never pays off for more than that short window of time. Investors are always compensated over the medium term for owning bonds, for owning stocks, for owning credit. So running away and putting the money under the mattress, it's never a wise decision. You may feel like a rock star for a couple of quarters, but be ready to get back in very quickly.
I have a waterbed anyway, Alessio. I can't stick all my cash under there. I would just disintegrate. All right, well, good to see you in person here. Invesco Investment Solutions Senior Portfolio Manager Alessio DeLongis. Good to see you as always. Have a good weekend.
Thank you.
Well, the surging dollar has created a host of problems for central banks, governments, and businesses the world over, despite the benefits for U.S.-based importers and American travelers. The strength of the world's reserve currency is adding extra pressure to already troubled major economies like the UK and Japan, not to mention the broader developing world. In a recent op-ed, Jeffrey Frankel says the U.S. economy's relative strength and Fed tightening will keep the greenback strong for some time. He's Harvard University professor of capital formation and growth, and he joins us now. Professor, it's good to talk to you. We gave away your thesis right there, but walk me through your thinking right now. As we see the dollar continue to surge, we're looking at levels we haven't seen in 20 years.
Yes, that's right. Well, first, good to be with you. Levels we haven't seen in 20 years, and by many measures that we haven't seen since 1985, which is almost 40 years. Against major currencies. There is talk about, is this a bubble? Does it require government intervention, cooperation, a new Plaza Accord? The Plaza Accord is what the G5 countries agreed in 1985 to bring the dollar down. But I think the strength of the dollar can be readily explained by economic fundamentals.
Economic fundamentals being that the U.S. continues to be, despite concerns around inflation here, in a relatively better position in terms of the economy compared to its peers? Is that really what it comes down to in terms of why people are putting their money behind the dollar?
That is what it comes down to. The exchange rate is us versus them, of course, relative. But I would break it down into 3 factors. First, economic strength. Despite all the talk about recession, the U.S. economy remains pretty strong. It certainly is by measures such as employment and even gross domestic income and so on. And meanwhile, Europe is hit by the shock of losing Russian natural gas, and so Europe in general is in trouble. Japan is stagnant. The economy has not even retained its GDP where it was before 2020. China is facing a big slowdown. So relative growth rates is factor number 1. Factor number 2 is commodity prices. Prices of oil, other forms of energy, minerals, agricultural products, of course, have gone up over the last couple of years. But our trading partners are much more vulnerable to that. We're no longer a net importer of oil or other forms of energy. We're a net exporter, and same for agricultural products. So whereas Europe and Japan and China are importers, so they've been badly hit by the increase in prices of oil and other forms of energy. And number 3, probably most important, the Federal Reserve is ahead of the others, or is raising interest rates faster than the others in order to fight inflation. And when a country has higher interest rates, that attracts international investors and causes the currency to appreciate.
So all those factors certainly put the U.S. in a better position. With that said, we have heard so many companies warn about FX headwinds because of the strength of the dollar in its most recent quarter. And I wonder, when you think about the risk factors at play here, to what extent is this likely to potentially tip into a earnings recession when you think about companies having to deal with these headwinds that are already weighing on their balance sheets?
Well, of course, any movement in the exchange rate has pros and cons. The con is loss of international competitiveness, loss of exports, which hasn't happened yet, but may start to happen, an increase in imports, hurting import competing industries. But that's really just a side effect of the Fed tightening. It's higher interest rates hurt the construction sector, housing sector, and other interest rate sensitive sectors. And a higher dollar hurts internationally, those sectors open to international trade. But what the Fed is doing, has to do, is try to slow down the economy in order to get our inflation rate back down.
Really quickly, Professor, we've already seen the Bank of Japan intervene to prop up the yen. Are we likely to see more central banks take similar moves, given where this is all headed?
Well, it's hard to say. I kind of doubt it, but I wouldn't have predicted probably the Bank of Japan, because intervening, they haven't done it for 11 years, and the G7 countries had agreed not to intervene in foreign exchange markets some years back. So this is sort of unusual, return to the interventions of the 80s and 90s. The U.S. doesn't regard the current situation as a problem. So I don't think we'd join any intervention. And without the cooperation of the Federal Reserve, other countries intervening on their own, they're generally not effective.
Jeffrey Frankel, Harvard University Professor of Capital Formation and Growth. Good to have you on the show today. I appreciate the time.
Joining us now for more on the latest economic picture following the Fed's latest hawkish messaging, we've got Matthew Luzetti, who's the Deutsche Bank Securities Chief U.S. Economist. Excuse me, Matthew. Great to have you here with us this morning. First and foremost, coming off of last week and the decision that was widely expected from the Fed, I guess the big question is, where do we go from here in the Fed's pathway from your perspective?
Sure. First, thanks so much for having me. I think what we got from Chair Powell last week was a decidedly hawkish message. The Fed delivered another 75 basis point rate increase. They signaled, we think, that another 75 basis point hike is likely in November. We think that they raised the Fed funds rate to 5% early next year. And it really is a central bank that is focused on the incoming inflation data. And I think the message from Powell was that is the number one thing for them. They will risk a recession if that is what is needed in order to get inflation down. Ultimately, we think that is what will be needed, and that a recession happens by the middle of next year. But it really, I think from the Fed's perspective, they need to get inflation pressures down. They need to have very clear and convincing evidence that inflation is back on a path down towards their target in order to pivot at some point to a more dovish messaging. But ultimately, we don't think that that's happening this year. We think it's a story for next year once a recession and those dynamics are far clearer.
Matt, we got some commentary or speak, I believe it was on Friday, from Jay Powell, saying that we might be heading into a new economic normal. What does that look like in your estimation, and how long might it last?
Sure. So I think we have two things to focus on from the Fed's perspective. It's the near term. How do they deal with high inflation, a very tight labor market, and how do they get inflation back down closer to 2%? That dynamic, we think, ultimately works its way out with a recession, with the Fed tightening very aggressively over the next several months, the economy turning down in the middle of next year, the unemployment rate probably rising to somewhere between 5.5% and 6%. And then I think there's a second question, which is, what does this economy look like structurally after we get past that recession and inflation comes back down? I think we do know a few things. One, inflation is just likely to be structurally higher. Deglobalization, and aging population, some of these climate change policies are all likely to be supportive from an inflationary perspective. I think one thing that the economy is also currently dealing with is not enough labor supply. It's a key driver of high wage growth. You see firms that still need to find workers. Job openings are near record high levels. And I think those two things together tell you potential growth in the economy is likely lower going forward, and structural inflation is likely to be higher going forward.
Now, within your modeling for the U.S. economy, how dire does it get in the U.S. housing market? We've seen rates really climb here. It's starting to impact home values, existing home sales, new home sales. How bad could things look?
Yeah, I think what you've seen, given the surge in mortgage rates, the collapse in housing affordability, is that we should still see very negative growth in the housing market over the coming quarters. We think residential investment is almost down 30% annualized in the most recent quarter. But given the leads that we have from housing affordability, that should continue. I think underlying that, there is some interesting dynamics, though. We got housing starts last week, and within that, multifamily housing starts actually hit a cycle high. And so I think what you're seeing is this shift away from single family homes for purchase towards multifamily houses for rent. And it is a signal, I think, that you have a housing market in the US economy that is structurally undersupplied. And so there will be a negative impact near term, given what's happened with mortgage rates and housing affordability. But the longer term story on housing, I think, is actually a positive one from an investment perspective, given that we are structurally undersupplied.
Matt, in previewing this earnings season, in a couple of weeks, we're going to hear from banks, and they're really going to be setting the tone, perhaps, for what consumers, what businesses, small businesses, larger businesses, and even deal making as a whole. We've got a few things that they're going to be able to signal about the state of the economy. What do you expect them to really lay out and to kick off not just earnings season, but kind of the mindset economically right now?
Yeah, I think you have, and we see this in the surveys, whether it's the PMIs last week, the ISMs. It's an economy where I think you still are under supplied in terms of labor. And so firms still have supply constraints, particularly on the employment side. The global supply constraints that we were all worried about before, a lot of those are dissipating. Commodity prices are clearly coming off. But the price pressures now, I think, are coming through wages and the difficulty to find labor. I just think that there's massive amounts of uncertainty about the outlook at this point. How much the Fed will have to tighten policy, the knock-on effects from that to financial conditions, and ultimately the economy. And so I think you should hear from firms that, despite the fact that demand today looks still pretty solid and resilient, the labor market still looks solid and resilient, that the outlook over the next 12 months is highly uncertain. And so that firms, have to begin to think about what do their plans look like if a recession hits over the next 12 months. We still think it happens by the middle of next year, but even the timing of that, I think, is highly uncertain and will be dictated by what happens with near-term inflation data and how aggressive does the Fed have to tighten policy.
We continue to be locked in on all things currency markets, Matt. The U.S. dollar at a 20-year high at just levels not many folks have seen before. What impact will that have on the U.S. economy?
It should help the Fed in many ways. It helps to tighten financial conditions. It makes exports from the U.S. more expensive, so it helps to reduce growth through that channel. Importantly, it should help to bring down inflationary pressures. But most of the goods inflationary pressures we've seen have been on the supply side and supply constraints. So I think it is something that helps the Fed, but I think the Fed needs a lot more help than that. They really need tight financial conditions. They need that through real yields moving to even higher levels. I think they need equity markets to be lower. They need credit spreads to be wider. And I think this is over the past several months, the Fed gave a message at the July FOMC meeting. The market responded by really easing financial conditions. And I think that triggered the Fed's eventual more hawkish response from Chair Powell over the past several months, particularly at Jackson Hole in the most recent meeting. He's really giving no dovish signals at all. And I think that's because the Fed knows that they need tight financial conditions. It'll come through a number of channels. The currency one is certainly one of them. But I think the Fed also needs to see tightening come through equity markets, as we're beginning to see a little bit, but also wider credit spreads.
Matt, we're seeing discretionary names in the equities market right now get a little bit of nibbling action as we kick off today's trading session and this week's trading. Do you believe that within discretionary, there are some more resilient pockets than others that are perhaps not as directly impacted by either inventory or supply chain concerns as others? Because those are things that are definitely out of the Fed's jurisdiction, if you will.
Yeah, I think you have an economy that has multiple phases going on here. We talked about the housing market and some of the collapse in activity that we've seen there. On the good side, outside of autos, you certainly have some inventory pickup issues that have taken place. We haven't seen that show up in the CPI data in terms of price discounts yet, but I anticipate that will come. On the other side, you have the auto sector that still looks supply constrained, very meaningful price pressures, likely have pent-up demand there. And within the services sector, you have an economy that still, I think, is running hot in many ways. You have pent-up demand. You still are below the pre-COVID trend in terms of spending in that sector. You have difficulty finding labor. And so that is, I think, leading to persistent inflationary and wage pressures within the services sector, but also an area where we should see a meaningful pickup in activity. The other thing that I would mention is that Gas prices surged earlier this year. I think that was a really important drag on economic activity, particularly through consumer spending. We should not discount how important that is for consumer spending on the other side. As gas prices come down, that helps to lift consumer confidence and should help to lift disposable income in other sectors and ultimately spending in other sectors.
Yeah, I think all those savings over the weekend at the gas pump, Matt, I went out and bought myself a sandwich because why the heck not? Matthew Lozzetti, Deutsche Bank Securities Chief U.S. Economist. Always good to see you. Talk to you soon.
Thanks for having me.
For more on all of this, let's welcome in Vanguard Senior International Economist Andrew Patterson to talk about some of the backdrop that we are looking at for all of this action. So, Andrew, as we look ahead to the Fed tomorrow, I'm curious, everybody talks about the press conference and the language and trying to read ahead to what the terminal rate might be. What are you going to be listening for specifically from the Fed chair?
So really tomorrow, seems like 75 basis points is pretty baked in. There's some discussion around 100, but if they do go 100 tomorrow, as a result of an inflation surprise or a higher CPI print, what do they have left to do if there's another one, right? They've acknowledged for a while that this is going to be a bumpy ride as they continue to bring inflation down. But tomorrow we'd expect them to really emphasize, not necessarily the terminal rate. They're not going to give you much clarity around that. They may hint at it, but really how long they're going to keep rates at that terminal rate. So how long they're going to keep rates high, because terminal doesn't mean you have to start cutting. It just means you've stopped raising rates. So maybe putting some emphasis around that could be a signal to the market that, just how much emphasis they're putting on combating inflation and how long they're willing to stay at those higher rate levels.
Okay, and so you mentioned that at this altitude, we'll still be incurring some of a bumpy ride, or should be expecting that. But should we also be expecting a soft landing at the end of that bumpy ride?
So again, trying to predict that, we tend to think about it in terms of scenarios. We were thinking that the probability of the soft landing scenario was increasing a bit. So call it around 20-ish% from around 15 earlier in the summer. That may have changed a bit with the inflation print, but again, that was just one CPI report, and one report does not make a trend. So much like the Fed emphasizes, we do want to remain data dependent on that. Right now, a soft landing is not our base case scenario. We would define that as being able to avoid a recession. We do believe that sometime in 2023, there's likely to be a recession, one called by the NBER at least, for at least a period of time. In terms of magnitude, though, we don't think we're thinking about anything like 2009 or 2020. Likely at this point, again, based on the data, likely to be somewhat more mild in nature.
Andrew, we talked to a guest earlier who said the terminal rate could be more like 5% instead of the, say, 4% that the market might be pricing in. Does that sound reasonable to you? And, I mean, does 5% still comport with the scenario that you're just painting where we would not see a major pullback in the economy?
So as of right now, we're not ready to move to a 5% terminal. We'd have it a little bit between 4 and 5, probably closer to 4.5. Again, remaining data dependent there. Certainly, if it started to look as if the Fed were going to have to go to 5% and stay there for some time, the probability of a soft landing diminishes, and the probability of a recession increases along with the likely depth of that recession.
Welcome back, everyone. The Federal Reserve continues its fight against inflation this week, but could excessive Fed tightening tilt the U.S. economy into a recession in 2023? That's a risk that's on the mind of our first guest this morning. And for more on what to expect from the upcoming FOMC meeting, we welcome in Sean Snyder, the head of investment strategy over at Citi U.S. Wealth Management. Sean, great to have you here with us. First and foremost, from your perspective, 75 basis points, it seems baked in, cooked in at this point. But what about the next meetings thereafter, and what would the Fed really signal if they were to continue to be hawkish or aggressive with their policy then, and the reaction that the U.S. economy would have to incur?
Thank you for the invite, and good morning. Listen, I think the August inflation report served as a wake-up call to investors that core inflation is not going to come down rapidly. It's going to be sticky for a while. And I think that kind of reassured them that the Federal Reserve is indeed sincere and that they're going to have to go 75 basis points at this next meeting. But I think the bigger question for investors right now is, what is the terminal Fed funds rate? What is the rate at which they will go on pause? Right now the market seems to be centered on this idea that it's going to be 4%, 4.5%. But there's some that are saying maybe it has to go north of 4%, maybe it needs to be 5%, or at least higher than the inflation rate. So that could mean the Fed goes even further than currently priced in or expected. And I think that is what everyone's going to be looking for guidance for, on whether or not 4 to 4.5% terminal Fed funds rate is what the Fed would consider restrictive to the economy, because then at that point they can probably go on hold, go into this holding pattern, just wait and see how monetary policy affects the economy over the next 12 months.
Sean, I like the way you put it in your note. You said the Fed's dual mandates may become dueling mandates going into 2023. And at that point, how do they weight the two mandates, right, which are full employment and price stability, if indeed we see a spike in unemployment, for example?
That's exactly right. So the Federal Reserve has two mandates. One is price stability. They want to keep inflation around 2%. And then the other one is maximum employment. And what maximum employment is traditionally thought to be is an unemployment rate of somewhere between 5 to 6%. Right now you have inflation, according to the metric that they like, PCE, deflator, well north of 6%, according to the CPI, north of 8%. And you have the unemployment rate at 3.7%. So the Federal Reserve can look at those two metrics and say, okay, price stability gets our sole attention right now. But if they do tilt the economy into recession, and I think that would be 2023 if it were to occur, I personally think the first half it were to occur, but it could be the second half, then the unemployment rate will start to rise. And then it makes it a little bit more difficult for them. And then they have this dueling mandates, right, where they have to decide which one is their focus. I do think they are willing to accept some job loss. If you do have a recession, they tend to last about 11 months on average, and the unemployment rate tends to rise about 2%, which would put the unemployment rate at 5.7%. So sort of in the range of full employment. But I just think it's going to be a more difficult task to communicate their policy if we start to see consecutive monthly job losses, which tends to be synonymous with recession. I think that will put them in a more difficult place, and I think that will put them in perhaps a holding pattern.
Sean, if we're talking about mid next year for us entering into a real recession, that also means that we would be, 4 quarters removed from hitting a technical recession after, or at least based on the definition of 2 consecutive quarters of declining GDP that we've already seen here during 2022. What's the longer standing kind of implications of that that might be felt by the average household?
Well, I think there's a couple things to consider. I think one, the first half of 2022, we did see 2 negative GDP prints. I think they were sort of distorted by COVID still. You saw inventories, rise sharply across retailers. They no longer need to order those inventories. They have too much inventory. And I think that has kind of resulted in this drawdown in GDP in the first half. But I think that's sort of distorted. Consumer spending still held up okay. But I do think if you look at leading economic indicators, they are not yet suggesting that we are in a recession, but they are suggesting that we may be headed towards one in 2023. And I think if the Fed continues to tighten aggressively, then I think that is the most likely scenario. We put the odds at maybe something close to 70%. But again, it's up to them. It is sort of, in their ballpark of whether they want to do this or not. I think the most likely scenario or implication for households is twofold. One, I do think inflation would come down. And if you look at the misery index of the United States, which measures the unemployment rate and the inflation rate combined, you see really, really weak consumer sentiment. And the reason is inflation is felt by many, while unemployment is most acutely felt by those unemployed. So I think in some regards, most consumers might actually think a recession's sort of okay if inflation's coming down and they're staying employed. For those that unfortunately face unemployment, obviously that's going to make things even more difficult if they're facing high inflation and also losing their job. So there will be, I think, some difficult times ahead for people if that tends to be the case that we see. And I think Europe's also facing a difficult situation. But at the end of the day, the Federal Reserve feels this is something they really need to do, and that we can't live with persistent inflation. So I think that is a very tough task for them, but I think they are, up to the task, and hopefully we can still achieve that soft landing. And there are some signs we might be able to do it. Economic activity does look like it's picking up in the third quarter this year, so that's positive. There are some signs that inflation is coming down and may start to decline materially over the next 9 months. So fingers crossed, maybe they can pull it off, but it's looking tough.
Fingers crossed. Sean Snyder, thank you. Citi U.S. Wealth Management, Head of Investment Strategy. Appreciate it.
Take care now.
All right, so my obvious takeaway will be on the housing sector and its impact down the road. And it'll be interesting to see, in particular, the impact, and Mark's written about this, of all these investors buying up so many properties across the country. And I think he makes the point there that they are going to now continue buying homes, but now rent them out. People are going to stay on the sidelines. I think that rent crisis will stay sticky. But it was a relief to say nothing like a 2008 recession.
Yes, that was a huge relief. He was basically also saying, making the argument that a recession isn't inevitable. And Rochelle, if you take a look at the jobs market, this was what Mark Zandi was saying, just the jobs market remains very, very strong. And yes, we have seen a cooling in terms of jobs added to the U.S. economy on a month-over-month basis. But historically speaking, when you look at a labor market that is this strong as we currently are in right now, it's hard to really see a strong case for a recession anytime soon.
And it's hard because obviously we've gotten so used to the technical definition of a recession. But as we were talking to our guest earlier, when you're raising rates into an environment where you have a strong labor market, it is a very, very different feel. It's obviously a lot of homeowners not getting kicked out of their houses per se. They're holding on to their investments instead. So obviously some real nuances in this that really speak to that argument about whether or not we're in a recession. But the strong labor market is obviously that strongest indicator, to say the other.
If we had one more second, I did want to ask him about the comments from Joe Biden in the 60 Minutes interview. I thought the most stunning part of the interview, to pivot a little bit, was his downplaying of inflation and the latest print talking about how it was an inch, I think is how he referenced the 0.1%. But that may have been Joe Biden's worst answer as a president. I think that you will see
and he tried to walk it back a little bit.
Not very well, because we're talking about a 40-year high for inflation. The month-to-month number should certainly not be his emphasis. When you're talking about American people who saw the largest increase in groceries, that thing they feel the most, that will come back to haunt.
And even in gas prices, where we are right now, yes, we had 13 weeks of declining gas prices, but when you go to fill up your car, at least my car, I'm paying significantly more than I was a year ago. And you can say that, I think, basically across the nation at this point. We know high gas prices is such an important issue for voters when they do head to the polls. So yes, comparing it to the levels that we saw midsummer, it looks like we are in a much better position. But historically speaking, gas prices still astronomically high.
I'm still stunned every time I see that.
Just happened on Saturday. That was President Biden last night on 60 Minutes saying he does not believe that the economy is going to get much worse from here. We want to bring in Mark Zandi, Moody's Analytics chief economist. And Mark, we just heard what the president thinks, but what's your assessment of the economy and the odds of whether or not we're going to see a recession?
Well, I think the soft landing is more likely than not. But having said that, recession risks are uncomfortably high. With inflation as high as it is and the Federal Reserve on high alert raising interest rates, and we're going to see another large rate increase in a couple of days, the economy is going to struggle here over the next 12, 18 months, and navigating through all this is going to be difficult. I think with a little bit of luck on the pandemic and the Russian invasion and some reasonably deft policy making by the Fed, they can't raise rates too far, too fast, or that would push the economy into a recession, but they have to raise them far enough, fast enough to quell inflation. But if they could kind of sort of get that right, I think we can make our way through with a soft landing. So it's going to be close, but at this point, I still say odds are that we'll make our way through without a downturn.
Mark, what's your view just on the progress that the Fed has made so far in terms of taming inflation?
They've done a good job in two regards. One, they've been able to bring inflation expectations back close to their target. When Russia invaded Ukraine and oil and commodity prices jumped, inflation expectations took off. And of course, that is a real problem, because if they stay high, then actual realized inflation will likely be high as well. And so they've done a really good job raising rates, signaling to markets that they're going to raise rates further. And that has brought in inflation expectations down. And that's good. And they've also started to slow the economy, particularly the job market. The job market's been rip-roaring, as you know. If you go back 6-9 months ago, average monthly job growth was 500K a month. We're now down to 350K. That's moving in the right direction, although we need to see much slower growth, probably closer to 100K or south of that, because that would be consistent with underlying labor force growth. So they've got more work to do, but I think they've moved the economy in the right direction.
And now some people are still predicting that we're heading for a recession, if not this year, next year. But then, of course, as you were mentioning, the strength of the labor market. How complicated is it to really characterize the economy right now?
It's really bizarre, right? I mean, GDP, the value of all the things that we produce, which has historically been kind of the benchmark for gauging how the economy is performing, that actually fell in the first half of the year. So based on that, you'd say, oh, my goodness, the economy's in recession. It's struggling. Then you go look at the job market, and the job market, as I said, is rip-roaring. It's not only the job growth, but got just close to a record number of unfilled job positions. Layoffs are about as low as they've ever been. There's been some layoff announcements by various companies, but in aggregate, they're incredibly low. The quit rate, the percent of the labor force that's quitting their job, is very high, which is not consistent with a recession. So, it's been a reason for a lot of debate. That's why there's so much debate about how the economy is performing. But to me, at the end of the day, what matters most is jobs, and people have jobs, lots of them, and unemployment is very low, close to record unfilled positions. So all that suggests that the economy is moving forward and not in recession.
Now, we're also seeing that there was a survey that talked about the rising healthcare costs. You obviously have a lot of people returning to work, some coming back with long COVID, with other complications. Meanwhile, a lot of people unionizing, trying to get higher wages. How complicated is it from a business owner perspective in this environment?
Well, it's complicated, right? And that's not only about having to pay more for labor and other material costs. It's all this shortages related to the supply chain disruptions. It goes back to the pandemic and the disruptions to the labor market. Shoved a lot of people out of the workforce, and still haven't gotten all those folks back, in part because of the pandemic. But fortunately, businesses' profit margins and profitability have held up pretty well. I mean, just incredibly well. Another reason why we're not in recession. While GDP declined in the first half of the year, profit growth was very strong by any historical standard. So, they've been able to, manage through all this, even though it's difficult. They've gotten some help, obviously. The government support during the teeth of the pandemic was very important. The Paycheck Protection Program for small businesses and all the other support really helped businesses more broadly. So they got some help here. But, I'd have to say they've done a really admirable job of, in aggregate, obviously I'm painting with a broad brush, but, in aggregate, businesses have done a really good job of kind of navigating through, all these landmines.
Mark, we had Bob Nardelli on the program last hour, the former CEO of Home Depot and Chrysler. We asked him just about one of the biggest risks here to the economy, also how it stacks up compared to 2007, 2008. Let's take a listen to what he had to say.
The president said COVID was over. I think we have a new epidemic. It's called, the quiet resignation. And labor continues to be a problem for us. So the breadth and depth of what we're facing today is a multiple of what we faced in 07, 8, and 9.
So, Mark, he was actually saying that the situation now could potentially be worse, it sounds like, when comparing it to 2008. I don't think you agree, but what's your reaction to what we just heard from Bob?
Yeah, no. I mean, as I said, recession risks are high, but I think if we suffer a recession, it'll be pretty modest in the grand scheme of things. Probably not even as severe as a typical recession since World War II. The fundamentals of the economy are pretty good. I mean, consumers are sitting in pretty good shape. I mentioned the jobs, a lot of excess saving, leverage is low. Businesses, we just talked about that, highly profitable, leverage there is pretty low. Financial institutions, I mean, from my perch, they're about as strong as they've ever been. Lots of capital, lots of liquidity, good risk management. State and local governments are rolling in cash. Rainy day funds are overflowing. Real estate markets, the housing market is undersupplied, vastly undersupplied. Generally, when you go into recession, you have an oversupplied market. So, the federal government's balance sheet's a mess because of all the borrowing to help out with the pandemic. But that, we're still the AAA credit on the planet. And, I don't think that's going to be an issue anytime soon. So, no, I just don't see that at all. Now, he did bring up a point about labor supply long run. I agree there. I mean, labor, it's going to be tough to get labor because of immigration, much weaker immigration, and of course, the aging out of the baby boomer generation, retiring en masse, and that's weighing on labor source participation. So he's right about that, and I think that is our number one problem going forward. But no, this is nothing like 08 and 09.
And in particular in housing, it is not. And that's why you write in the Washington Post that we are headed for a correction, not a crash. Practically speaking, though, what does that mean and what will be the impact on the broader economy?
Well, house prices are going down. I mean, it's just a matter of affordability. I mean, you saw back a year ago mortgage rates at record lows, below 3% on a 30-year fixed. How demand was booming, remote work, juiced up prices. Now, of course, mortgage rates are up over 6%, and they are bumping up against those high house prices. And monthly payments are just not affordable. So potential for some homebuyers are completely locked out of the market. So we'll see prices adjust here, and a correction in my nomenclature is a decline 5-10% peak to trough in national prices. Some markets will see double digit, the most juiced markets previously. But a crash, that would be comparable to 08, 09. That would be down 25-30%. I just don't see that. I mean, the market's vastly undersupplied. Lending quality has been excellent since the financial crisis. You got a lot of investors out there that, this is a business model for them for buying homes and renting. They're going to be back into the market, once prices come in a little bit. So, I just don't see more, prices crashing in the current context.
Is there a solution ahead for what some are referencing as a rent crisis across the country? We saw that reflected in the latest inflation print.
Yeah, more supply. If I were king for the day, and maybe I need a week, but I focus on tax credits to support more affordable rental, like LIHTC, low-income housing tax credit. That's tried and true. An infrastructure in place to make that work. We can change a few dials there and really juice that up. Neighborhood home tax credit, new market tax credits. There's a lot of things we can do that I think it's not going to solve the problem next quarter. Maybe not even by this time next year, but you look towards mid-decade, that could make a big difference if policymakers could get it together and do something along those lines.
All right, Mark Zandi, great to have you on touching on a number of subjects there. Really appreciate the time, sir. Thank you. From the World Bank to FedEx, warnings of a looming global recession are spreading. Housing, home goods, retail, tech, no sector seems safe. So what is around the corner? We're thrilled to welcome back Bob Nardelli, former Chrysler chairman and CEO, former Home Depot chairman and CEO, and current founder and CEO of XLR8. Good to see you, sir, and welcome back to the show. All this gloom and doom, are you buying it?
Well, Dave, let me thank you again for having me on, but the answer to that is yes. And I've been projecting, this decline towards a recession for some time now. So, Fred Smith is a longtime friend. I have tremendous respect for him. I think he finally is looking at things realistically. He mentioned the other day that between FedEx and UPS, they basically move about 12% of the U.S. GDP. You look at some of the biggest banks like Goldman now, again, looking at the reality of where we are in this downward spiral. You're talking about housing, which is a key indicator from my days of Home Depot. While lumber prices are coming down, we see new housing forecasts are down, permits are down, the value of existing homes and turnover is down. Electricity is up 15.8% month over month. We see natural gas is going to be a big problem. We're down year over year about 233 billion CPUs on the thing, BTUs. We've got about 4 trillion billion BTUs available for storage, but again, that's under year over year storage volume. So yeah, I think we're seeing a big problem, Dave, coming at us. We had one bank CEO talk about we're heading for a hurricane. So yeah, it's on a downward spiral. You look at inflation. When you really look at inflation, I think it's deceptively correct, the number reported, because it doesn't include shrinkflation. When you walk down the retail aisles and you see the price the same, but a third of the volume is gone. So I think we really need to brace ourselves for what's coming.
Well, Bob, how much worse do you think it could potentially get?
Well, I think, my projection would be that the Fed's going to raise a minimum of 75 points on Wednesday. There's talk that it could go to a full point. I think we'll see some additional increases in the balance of the year. He may hold off in November because of the election and not want to cast a problem there. But I think we'll continue to see the Fed rate go up. Therefore, we'll see mortgage rates go up. Therefore, we're going to see continual impact on the consumer out there. I know from all the businesses, both private and public, that I'm involved in, we're seeing cancellations. That's resulting in inventory build because the material was on order, and really the cancellations are being stuck. The inventory is being stuck with these companies, some cases 50 million plus, $50 to $100 million in some of the smaller ones, and they're having to figure out a way to eat that or at least move it out. So it's, I think we're in for some choppy water for the balance of the year and beyond.
So, Bob, comparing where we are right now to what we saw in 2008, how do you think that's going to stack up?
Well, I was at Chrysler at 2008, so my timing was not so good there. But again, it was singularly focused on the financial institution meltdown. It didn't have the breadth and depth of what we're looking at now. Almost, a CEO today has the highest degree of complexity that I've ever seen for someone running a publicly traded company. If you look at it from inflation to supply chain, you just go down the list. And while the president said COVID was over, I think we have a new epidemic. It's called, the quiet resignation. And labor continues to be a problem for us. So the breadth and depth of what we're facing today is a multiple of what we faced in 07, 8, and 9.
And Bob, I want to ask you about some of the labor challenges. Obviously, just narrowly avoided a freight rail strike. You have a strong union movement coming along. As someone who is getting that C-suite perspective, how would you navigate these sorts of challenges?
Well, it's interesting you bring that up. It's I hate to use this example, but it's like a theater, and it's a full house and somebody yells fire and everybody's rushing for the door. So everybody's looking for that rate increase, that wage increase. They want to get it before this thing really turns down, and then they lose the justification. So whether it was in the rail, whether it was in the airlines, we're seeing it in a number of our factories. Recently negotiated a new contract for 8 to 10% increase this year, and then multiple increases in years 2 and 3. So labor is in high demand, and they've got leverage now, and they're taking full advantage of it. It's not uncommon for some of the services, residential services. I know I'm seeing it myself, where the rate was $100 an hour, and now it's $150 with no justification other than fuel prices, cost of living, etc. So again, we have an ever increasing level of complexity that we're having to deal with, both as a consumer and as a business leader.
You talked about the housing slowdown earlier. Shauna pointed out an interesting fact that we're seeing home builders actually positive. Wall Street is bullish on these home builders. Maybe it's because they can charge an arm and a leg for rents. On the other, so what is your prediction for what this slowdown means for builders and for Home Depot and Lowe's and the like?
Yeah, well, again, I hear the same thing you hear, Davis, that rental rates are up significantly because, again, new homeowners, first-time homeowners are having concerns over the mortgage rate. And we did see a tremendous spike in a lot of the building supply materials. And again, old habits are hard to die. But if you look at lumber rates and some of the other businesses that I've been in, we started to see a little softening on lumber rates. So that should be helpful. But it's not enough to offset, as you mentioned earlier in the program, the increase that we're seeing, a modest decrease, I think it was like 0.1% of 1% in the value of existing homes. But I think we're going to see some complexity. Now, the great thing about Home Depot, from my experience there, and even Lowe's, you go from 2 phases. One is an investment in a home to improve the value of it, and now we'll move into the maintenance of the home to maintain it. So, again, there's a nice offset there, a nice balance between investment and maintenance that goes on. I think you'll see Home Depot and Lowe's continue to do quite well.
Thank you so much, Bob Nardelli, there for joining us this afternoon. A great conversation. We appreciate it.
Thank you very much.
Everyone, let's take a deeper look at markets here this morning as we're 30 minutes into trade. Our next guest says that the Fed might be reactive rather than proactive, and that the economy should brace for additional overcorrections set to hit even sectors considered risk off. Joining us now, we've got Michael Darda, who is the MKM Partners Chief Economist, Macro Strategist here. Thanks so much for joining us here this morning, Michael. First and foremost, when you think about the Fed and what you've said and what you kind of have wrapped up to be the reactive nature of the Fed rather than proactive, what is the best way that the Fed could be proactive as they've been kind of behind the curve at this point?
Yeah, thanks for having me on. So I think the best thing they could do would be to focus on forward-looking information and leading indicators. We have a bit of a problem here with the Fed chasing backward-looking information. And so they're very focused on things like wages and rents and services inflation. Those are all very important variables. But they don't move first when economic conditions change because many of those prices are tied to leases and contracts. So we have a big problem if the Fed is driving the vehicle looking through the rearview mirror, and it puts us into boom cycles followed by bust cycles. And so if we think about how did we get into this inflation quagmire in the first place, it was because the Fed ignored a lot of forward-looking information telling us we were in a V-shaped rebound, that inflation was coming. Focusing on those lagging indicators gave them a false set of comfort. So you all probably remember the temporary transitory imbroglio. And now just the opposite is the setup, with the Fed getting aggressive here and persisting with aggressive policy, likely to take it too far and to create some economic upheaval next year.
Yeah, and already some of that economic upheaval, I guess we are seeing evidence of. We should mention we just got mortgage rates, as reported by Freddie Mac, coming in above 6% for the first time since 2008. So if we look at certain lagging indicators, you mentioned in your note wages, rents, services, price, inflation. What are these forward-looking indicators then on the flip side that you think the Fed should be focusing on and investors should be focusing on?
Sure. Well, I can give you three that have been very robust, long leading indicators of recession. One is what the setup was, which is the yield curve. So we have a yield curve inversion now that is broadening out and persisting and likely to intensify as the Fed continues with aggressive rate hikes here. Usually you see inversions about a year before a recession. Money supply growth is now negative in inflation-adjusted terms, both narrow money that the Fed controls and broad money that the banking system controls. And so those two variables, an inverted curve and negative inflation-adjusted money growth, have been pretty robust forward-looking recession signals in the past. In fact, used together 10 for 10 in the last 10 recessions since the mid-1950s. Not bad. Housing, residential real estate, you mentioned mortgage rates, also tends to peak about 2 years before recessions hit. Residential real estate is now in a tailspin. It was one of the first sectors that went into a boom with easy money and low rates. And now it's one of the first sectors that has gone into a bust. So forward-looking information is telling us that growth is going to slow pretty sharply. Inflation's likely to continue coming down. The sticky price inflation is going to take some time. But we really don't want the Fed chasing backward-looking information here, because that just means, bust that follows a boom. And then if they're still doing that, another boom. So let's have them focus on more forward-looking information and create a regime of stability in terms of inflation expectations and inflation itself.
So, Michael, when do you think we'll see a bust?
Well, we're seeing it now in residential real estate. I fear it's going to broaden to envelop the entire labor market. Probably second half of 2023 would be my guess in terms of when we start to see rises in the unemployment rate that would be recessionary. Historically, anytime the unemployment rate is lifted half a percentage point or more from where it was a year earlier, we've been in a recession or on the cusp of one. So keep your eyes on the unemployment rate. It's not a leading indicator, but it's probably the most reliable coincident indicator of a recession, meaning are you in a recession now or are you not? The first half of the year, despite those negative GDP readings, the unemployment rate was falling, job growth was positive. That's not a recession by any logical definition. But if the unemployment rate is moving up in a persistent way, that's always been associated with recession in the past. And I think that's probably something we're going to see in 2023.
Michael, doesn't seem like the Fed's listening to you when you're saying this stuff. I mean, if the Fed was paying attention to the indicators that you're talking about, would there not be a 75? I mean, should the Fed not raise 75 basis points next week? Should it pause after that or at some point? Like, if they were doing what you're suggesting, what then would the rate increase strategy look like, or not rate increase strategy?
Yeah, well, if they were looking forward instead of backward, then I think they would have limited the easing. They would not have persisted with the short rates at zero for so long. They would have started more sooner and more aggressively on the rate hikes and the balance sheet reduction. So we wouldn't be in a situation now where they're going really aggressively.
Well, but I guess now that we're here, now what? How can they correct if they were going to correct for those mistakes made in the past?
I wouldn't persist with 75 basis points. I'd slow it down.
All right, we'll leave it there. Michael Darda, MKM Partners, Chief Economist and Macro Strategist. Always good to see you. We'll talk to you soon.
Thank you.
Welcome back, everyone. We're watching markets set for a rough few weeks ahead with a hawkish Fed, elevated inflation, and the approaching holiday season all driving the markets. One thing to watch, how will the consumer, yes, the ordinary everyday spender, weather inflation? For more, we've got Neil Shah, who is the Edison Group Director of Research. Neil, great to have you here with us this morning. Of course, the Fed, the major catalyst for some of the market moves that we've been tracking over the past several weeks. And now it seems like 75 basis points, that's all but a foregone conclusion, excuse me. And so with all of the other factors that we're going to be monitoring as well, what type of weight do you believe the markets will give to them?
But I think there's I think you're right. There is a foregone conclusion. There's expectation that inflation needs to be tackled and that the central banks need to act quickly to address that. I think even if there's a glimmer of hope in the sort of near-term inflation expectations, I think the central banks have got to get ahead of the curve and tame inflation. So I would say that highly unlikely would see anything else but a 75 basis point increase.
It's Julie here, Neil. You say in your notes to us that consumers are going to have to feel the pain here because we've seen this pretty robust consumer spending cycle, even in the face of inflation. It feels like people are starting to feel the pain, right? Particularly over there in the UK with what's going on with energy prices. So how, beyond 75 basis points, whether you're talking about the Fed, the Bank of England, the ECB, how far do you expect central banks to go?
It's a tightrope that they're going to have to walk, and I think they're going to have to monitor data relatively closely. But the last time I was on the show, I said that there's a sort of four-stage process that certainly we're talking about when we're looking at investing in equities. Stage one was the acceptance that we're in a higher inflationary environment. Stage two was the acceptance that you got to adjust your discounting and your valuation views. We're in and stage three is what I was saying that we're going to look at in the current earnings season, which is that earnings expectations have got to come down. Now, in that is the story of the uncertainty that we've got on the horizon about how is the consumer going to fare. A lot of companies that we talk to are nervous about this coming quarter's earnings. I think you're seeing deferrals around decisions. You're seeing spend being sort of pushed out. At some point, I think we're going to get through that. At some point, I think that the comparatives will start to make the sort of pricing data look better. But in real terms, I think there is a real cut to earnings. Real earnings are declining, and that's got to hit spend in some way. So I think we're seeing how far that is to fall. I have to say that it doesn't feel like Armageddon this time, that it's controlled and we seem to be able to get through it. I think the biggest issue is going to be the skill sets of management teams. There's a lot of management teams who've not been through a proper, an industrial recession or a downturn. And whether they've got the skill sets to manage their companies through that is a big question mark.
And Neil, we've been talking about the R word, the recession word here in the U.S. for a bit, but when you look over at the tightening financial conditions over in Europe, the skyrocketing energy prices, even though they've ameliorated a little bit, especially in Germany, how bad are you concerned that it could get in Europe with respect to a recession there? And then what is the spillover effect into the United States, say?
Well, my view is that the US stands a better chance of weathering the storm compared to Europe. And I think it's a difference in energy security policy. I think Europe's going to be hit harder by that. I also think that in terms of policy decision making, it's very, very variable in Europe. So my feeling is that it's going to be tougher in Europe. and there's a greater concern around uncertainty in Europe, I think the US is better positioned. And one of the things we're recommending people to do is take a look at European businesses with large US exposures, because actually I think you'll fare better as a result of it. In terms of spillover, I mean, clearly there is an impact on any US company that's sort of selling into Europe. But my hope is that that the US surprises on the upside and that they'll be able to sort of weather that.
Neil, it's interesting. You're saying that the consumers, we're expecting to start seeing consumers scale back post-summer, and that's going to start to be noticed by companies. But we've also got data out of MasterCard this morning, their spending pulse, expecting that U.S. retail sales are going to grow 7.1% this holiday season.
Yeah.
I suppose within that, though, of course, is this caveat that you've seen more credit card purchases be taking place. What does that tell you about how the consumer is spending right now and where they're really kind of couching the actual physical cash that's going out the door versus what they're going to increasingly be putting on credit?
Yeah, I mean, look, I think it's, we've had, a couple of decades of, I would say sort of relatively benign conditions for sort of consumers. And that it's one of those things you've got to learn to tighten your belts. The things that your parents taught you in terms of be sensible about how you spend, etc. And I think there's going to be an adjustment process around that. As I said, I'm not surprised by the data. I mean, my view is that actually the US consumer is in a better shape than I guess the European consumer is. There is just more uncertainty here in Europe. And that's tied to, as I said, the energy security side of things. But for us to get through this, at some point, I think that there has got to be a little bit of bite. There's going to be a sort of dip in spending. And that's what's going to lead to a moderation of inflation expectations. Otherwise, it would just continue. So you've got these issues around rising prices, supply chain issues. And if you've got still robust demand behind it, you'll just see rates push up to counter that.
Neil Shaw, Edison Group Director of Research. Thanks for being with us, Neil. Appreciate it.
Pleasure.
Our next guest says trading the soft landing is hazardous. The stock market isn't giving a thumbs up that a moderate jobs report clears all problems. And added to this, the risks of a full-blown energy crisis in Europe are rising. Joining us now is Ben Amons, Medley Global Advisors Managing Director for Global Macro Strategy. Ben, good to see you here this morning. We all morning long we've been talking about the influx of mixed economic data. Is that what investors should be expecting here for the month of September?
Yes, indeed. I think that if you see the resilience in the U.S. economy, it's certainly not the case in Europe and the U.K. and even in China. So as much as these purchasing manager indices are showing somewhat uplift, that may be really from a rebound on inventory rebuild in the U.S., whereas in other cases, there's more contraction happening. So very mixed picture leaves you need to believe that soft landing is really dangerous to trade here. It's not so guaranteed that you actually will be in one. And if you see the news today out of the UK that they're going to put price controls on energy, that's just putting off inflation in the future, and while they're dealing with a major energy crisis. So I think markets are getting nervous here, and you can see it from the moves in yields and the moves in currencies there, particularly that we're entering the fall with a pretty, let's say, tense moment here as we may be hitting recession in Europe and the UK at the same time.
Hey, Ben, it's Julie here. It's good to see you. Let's connect the dots here, shall we? Because we were talking at the top of the show about the European energy crisis and how acute it could be, even with this aid now that the UK and other governments are talking about. Talk to us about the ripple effect potentially for here in the U.S. and for perhaps U.S. companies that have exposure in Europe.
Yeah, for sure, Julie, and good to see you again, too. Yes, one, you can see it actually natural gas prices. Right, they have been rising pretty fast here, and that is input to companies for any type of production. And secondly, it's also about expectations. If we are entering into a major recession into Europe, it's going to impact the U.S. economy as well. It's just not going to be insulated. Lastly, it's about the measures taken. So, the Bank of England and the ECB have to catch up to the Federal Reserve, and as they push up rates faster, it pushes up their local bond yields, and that's reflected today into treasury yields, for example, on top of it that you had a stronger than expected ISM services. So I connect all these dots. Yeah, we're looking at an environment of rising yields and then falling stock prices on a really mixed or negative economic picture.
Ben, do you think what's happening in the Eurozone right now blows back onto the U.S. to such an extent that it puts us in a recession?
That's maybe a bit difficult to determine at this moment. And the real reason is that the U.S. consumer obviously has been quite resilient, as everyone has concluded, and may not be so directly affected by Europe exactly that way. But on the other hand, companies and export and trade will be. And ultimately, that's what could be negative on employment here. So I think that's probably the real connection. As Europe gets into a recession, we do get changes in the employment picture here. And that would lead then to confidence issues and spending curtailing. So, yes, there is a risk here. I don't think that the U.S. economy right now is in a recession, but it could be on the heels of as Europe enters a recession. So clearly a link there.
So, Ben, you said at the beginning of this conversation that it was dangerous to trade the idea of a soft landing, assuming there would be a soft landing. So what assumptions did you make, and how should folks be navigating this market?
Yeah, we know that quote-unquote soft landings have been really rare. I mean, the last one was in the 90s, and that was actually because of a productivity boom that started in the U.S. and technology coming to fore. I think helped the U.S. economy avert a potential worse outcome from coming out of the 91 recession. We just don't have those circumstances today. Secondly, and this is, I think, part of the pivot misunderstanding that happened in July. People assumed there's going to be a soft landing and the Fed will pivot. And we now learn out of Jackson Hole that that's not going to be the case. So that makes it dangerous, too. Policy must tighten further in order to make sure they can control inflation. And on the latter, inflation is highly uncertain. Yes, it's softening and commodity markets have changed, but the outlook for inflation is so unclear given the nature of the energy crisis in Europe that doesn't let us be unaffected. Yeah, that all makes it, to me, really hazardous, as I said, in order to trade a soft landing by being overweight stocks.
Yeah, we're seeing maybe some of those concerns being priced in real time. Ben, Dow now down over 200 points. Those losses accelerating to kick off this holiday shortened week. But to your point on the Fed, how much further do you think the Fed will go with respect to interest rates?
Well, it seems to be indicated now by several Fed members, and that looks to be the real message, that the funds rate not only has to hit 4%, but maybe has to go above 4% to be absolutely certain that they can get inflation on a trajectory downwards by next year. Because that's by far not guaranteed, even though there are projections out there by the Fed and the private economists that it will. The funds rate really has to go higher than what we've experienced in years. If you add on quantitative tightening, which is now really getting full-blown this month, it would actually add incrementally about 5 basis points a month or so in tightening. It actually, if you calculate it that way, it can lead you even to a higher funds rate by next year, something like 4.5% to 5%. So the Fed is really on track to try to fulfill its mission on price stability. Yeah, it doesn't lead into a pivot and pause or even cutting of rates. No, it leads us to a higher funds rate, likely above 4%.
Ben Amons, Medley Global Advisors Managing Director for Global Macro Strategy. Good to see you. We'll talk to you soon.
The August jobs report coming in better than expected, with 315,000 non-farm payrolls added during August. The unemployment rate also rose to 3.7%. Let's discuss more with Yahoo Finance's Brian Chung. Brian, first and foremost, you want to focus in on this unemployment rate. What's sticking out to you there?
Yeah, well, really interesting to see that the unemployment rate actually just ticked up a little bit from 3.5% to 3.7%. But the way that the Bureau of Labor Statistics calculates the unemployment rate is a little bit wonky, because what they're doing is they're taking the total amount of people that are not working but looking for a job and dividing it by the labor force. Now, that means that in theory, the unemployment rate could go up, not because people are getting laid off, but because there's a larger labor supply with more people that aren't working now looking for jobs. So what's actually happening here, right? Is it people being laid off, or is it people wanting to actively search for jobs? And it looks like it's actually the layoffs. Now, the reason why is because when you kind of unpack the report, the unemployed level was above 6 million for the first time since February. And it looks like there was an increase in the permanent job losers as accounted by the BLS. And you also saw a decrease in the people who currently want a job, which is kind of a subsect of the people that are not in the labor force. So kind of when you add all those things together, it does tell you that the unemployment rate, one driver of it could be perhaps layoffs as opposed to a larger amount of people just simply looking for jobs. Among that subsect, I was kind of looking at the demographics because they have a pretty nice breakdown here. Mostly high school grads with no college experience or no college degree, accounting for some of that higher uptake in the unemployed base. Also, take a look at the Black or the African American labor force. The number of people that are employed kind of ticked down. And you also saw the number of people unemployed among that cohort actually increase. The unemployment rate among Black Americans going up from 6% to 6.4%. So if there is kind of one negative aspect of this report on a Main Street level, it is certainly that trend. Again, that might be a feature, not a bug, of the Federal Reserve's rate hikes, because that could be squishing businesses. They're going to have to cut down on their staff. That's probably behind those dynamics there.
The latest jobs report print showing a pullback from the prior month's revised 526,000 jobs. However, still a solid pace of growth amid a tight labor market. And joining us now with more on the labor market perspective is the U.S. Labor Secretary Marty Walsh. We've also got for the conversation Yahoo Finance's Jennifer Schonberger. And Secretary of Labor Marty Walsh, thanks so much for joining us here this morning. First and foremost, just want to get your headline reaction to what you saw come out in the print from the Bureau of Labor Statistics this morning.
Yeah, good, strong report. And also, I think the number that is encouraging is that labor participation went up. So that's why we see a little uptick in unemployment from 3.5 to 3.7%. But what we want to do, what businesses in this country need, are more people getting involved, getting back into the workforce. And hopefully that will continue. That trend will continue as we move forward. I'll take a 3.7% unemployment rate all day long if we get more people involved in the workforce.
Mr. Secretary, always nice to see you. Do you think this, jobs report, jobs in excess of 300,000, are these more normal reports? Is this what we should expect in the months ahead?
Well, it's hard to say that. I still think that there's some good reports in front of us. And then at some point, there's going to be a leveling off, and having a good report will be 50,000 jobs. But I still think we're at the point where companies are still hiring at a big pace. People are still looking to get back in the workforce. We have areas like hospitality and some parts of education that aren't quite fully back from pre-pandemic levels. A lot of sectors are back, but I still think there's a lot more room for growth. And then on top of that, there's areas like cybersecurity and nursing and teaching that are looking for more and more employees. So I think we're going to see some growth in those areas as well.
Mr. Secretary, Jennifer Schonberger here. Thanks so much for joining us. The Federal Reserve is certainly going to be paying attention to this report as it looks how much it's going to be raising interest rates at its next meeting later this month, taking that in conjunction with upcoming inflation data. What do you think this report means for the outlook for inflation?
Well, it's as far as what the Fed does, I'm not sure what they're going to do, but I think that when you look at I watched the trends in inflation and seen the gas prices come down for I think almost 8-9 consecutive weeks right now. We see a little downturn in inflation. The numbers went down a little bit. Clearly, we want to see those numbers go down even more. My side of the aisle, if you will, not the Fed side, but our side of the aisle, we need to continue to make sure the supply chain is moving forward. We need to continue to make sure goods and products are coming into the United States of America, and we're getting things to the American people. And we need to continue. The president passed the Inflation Reduction Act that will help us on inflation as we move forward. Not immediately today, but it's going to help us. So we just have to continue to move along here. And whatever the action the Fed takes, we'll see how that helps us as well. But I think the signs are going in the right direction. Our economy, for the most part, is strong. You take away the inflation that we're dealing with, we have a strong economy right now.
Particularly on the education front. And we say this knowing that this is a mid-month to mid-month reading. And so perhaps not all of the education jobs may have been accounted for, at least within this reading, considering that most schools start back up mid-August into early September. Yeah. With all of that considered, though, what most notably should we be keeping an eye on, especially considering the teacher shortages that we've seen some school districts reporting, and then even all the way up to the re-welcoming more firmly here, at least in this school year, compared year over year to the 2021-2022 school year, that a lot of people are having going back to campus. That teacher demand is significant right now.
Yeah, first of all, that's the biggest difference right now that we're dealing with. 2021, 2022, beginning of school year, we weren't really sure, or school districts weren't really sure what was going to happen with the COVID pandemic. Now, fast forward a year, all schools are open. More places have in-school learning, all in-school learning for the most part in almost every school in America. We have a major issue with teaching. And we had a meeting at the White House with the First Lady last week. We had some teachers in there. We had some private sector businesses in there. We have some major concerns, and we really have to think about the way we treat our teachers, the way we pay our teachers across the board, and also we need to recruit and retain teachers into the profession, and teachers of color as well. I mean, when you think about our economy moving forward, the way we're going to continue to strengthen our economy is by having a workforce that's educated and ready to work in that economy. If we don't have teachers to teach, and the only people who are going to get hurt there are going to be our kids. And so we are focused here at the Department of Labor on, not for today, but we're focused on, in a very short period of time, how do we get more teachers into the field? How do we get some of those teachers back? You're absolutely right. We have to address this issue.
Mr. Secretary, as someone that has worked their tail off for many years, Mayor of Boston, now you're in the seat as the U.S. Labor Secretary. What do you think about this generation's quiet quitting movement?
I'm just learning about what the quiet quitting movement is, and I haven't in my travels in the last couple of weeks. Chicago, Detroit, San Antonio, all over the place. That issue hasn't come up, but certainly it's something that if it raises to our level, we'll have to address it. Certainly, as the city of Boston mayor, if I had a situation where I had people taking a step back and working for me, I would address it as an employer. I'd go over and talk to them and find out what the issue is, what the situations are, and have those conversations. And I think that's how, if I'm explaining it right, that's what I would do. Quiet quitting was presented to me about 2 weeks ago, and what I thought it was, I thought people quitting their job, and then I found out it's not that. It's people kind of stepping back a little bit in their job, and certainly that can be dealt with between a management, the company, and the worker.
Mr. Secretary, let me just stay on that. Would you fire these workers? Do they just need to be dealt with just as cold as possible? If you're going to pull back on work while your employer is sending you a check, do you need to be dealt with?
It shouldn't get to that point where you're firing somebody. You should, if you're an employer, if you're a manager, you should catch on right early enough that your employees aren't satisfied, aren't happy, and there needs to be a dialogue, a conversation. And if your employee is just doing it because the fact they don't want to work, that's a whole different situation. But I honestly believe in having the dialogue and conversation with your employees and your employer working together collectively with managers and finding out what the situation is. So, for example, if that happened here at the Department of Labor, and I heard there was quiet quitting going on in a particular agency, I would go down and talk to them and say, listen, what's the deal? And try and find out, identify what the problem is. Do you have a problem with the boss? Do you have a problem with the work? What's going on? Are you being overworked? Not in your job description? That's what you have to do when it comes to quiet quitting. I don't think it should become a thing, but I think companies should be paying attention to it because there's something going on with your employees.
Mr. Secretary, we've got Labor Day around the corner. Unionization efforts are picking up around the country, gaining steam. Are we at an inflection point for unions gaining ground in this country? And what is your and the Biden administration's approach to strengthening unions?
Yeah, well, there's no question that the labor movement's at an inflection point. We're seeing, for the first time since 1965, 71% of Americans are looking favorably upon organized labor. You've seen some ballot initiatives around the country go down, which is amazing to see. You have other ballot initiatives in the country looking to strengthen workers' rights in organizing. The president has been very clear on the issue of supporting people's rights to collectively bargain and encouraging companies for free and fair elections and letting workers decide. But I also think companies and unions, I think organizing is a great thing to see. I would love to see more conversation between major corporations and the AFL-CIO as we move forward here to find out there's a lot more in common than they have separate. That separates them. I'd love to see those conversations move forward in the future here, in the end of 2022 into 2023.
Just to briefly follow,
if I were in that role, that's what I'd be doing.
Just to briefly follow up on that, Labor Secretary, we did have Sarah Nelson, who is the president of the Association of Flight Attendants, join us earlier and lay out the scenario, the reality for us that there are flight attendants, there are labor force participants in the airline sector that literally can't make ends meet right now, and that it's more expensive to come to work than stay home for them. What do you hope is the resolution in some of the union negotiations, especially for one of the most active portions of the services segment, if you will, especially over the course of this summer, and demand doesn't seem to be slowing down?
Well, listen, I think that I didn't hear all of Sarah's interview there, but I think that, you can't, I'm not saying you didn't say this, and I'm not saying this. Organized labor is not adding to the cost of doing business. What it does, it's representing the respect and the rights of workers. And I think that there's an opportunity. I think what's happening in the airline industry, a lot to do with the pandemic, a lot to do with worker shortages, a lot to do with what's been going on in this country for the last 2 years. I think that the pandemic threw that industry through a loop, and also through the hotel industry and retail industry to a loop, and also through the train industry. The only industry that seems to have come back from that completely without having any disruption is retail. And I think that a lot of the business practices that these companies are having, they need to look at their business practices and try and figure out how do you get back on track. And we need to get workers back into the workplace. That's quite honestly the bottom line. The airlines, I think a lot of these flights that are being canceled or delayed is because, and I've been in plenty of airports waiting for the flight crew to come in from one plane to another plane. What we need to do is continue to invest in workforce development, job training, and get more people trained up for these jobs moving forward. And then organizing is a separate piece of that.
U.S. Labor Secretary Marty Walsh, thanks so much for taking the time and joining us here for this discussion this morning on the back of the jobs report that we've been continuing to watch the markets digest. Appreciate the time once again. And to our own Jen Schoenberger, who's joining us as well for the conversation. We appreciate it.
Ethan, we'll start with you. What do you make of this action, and what could be the catalyst to rally us back? Since the words of Jerome Powell, we have just seen day after day of bleeding. How long will it continue?
Well, it's very strange. It seems like good news is now bad news, and that we saw that the strong consumer sentiment, or stronger than expected perhaps, as well as the stronger than expected employment numbers, and the fact that labor is continuing to be resilient and perhaps is the only pillar that's preventing us from stepping into a recession. These numbers or indicators are all still positive, but it still seems that markets are prone to react and see that this is now more fuel for the Fed to continue their tightening cycle and to continue to be as assertive and as aggressive as they are. It is quite an unusual combination of events. We'd see that actually this is still very positive news, despite the fact the market can't seem to look through it at the moment. We've been looking for some time at the anatomy of this, whether it's a bear market rally, is the beginning of a bull market. And what we're seeing is that actually there is considerable breadth. We saw some breadth on the downside here today, but we have seen breadth overall on the upside. That gives us some comfort, as well as the fact that we see a lot of technical factors underpinning demand for equities. So it is a little bit confusing as to why markets are reacting as they are for the third consecutive day. But overall, we see that the news is net quite good.
Alejo, what do you think? Do you agree?
Look, I think the trading environment is going to remain challenging for the foreseeable future. When you look at what's being priced into markets today, the constellation of expectations is pretty positive. Inflation is priced to moderate towards a level of 2.5% to 3% by mid-end 2023. Earnings are expected to continue to grow in coming quarters. When you look at what might take the Fed to bring down inflation, markets expected to bring rates up to 3.75% and to even cut interest rates in the second half of this year. In our view, reality is going to be a bit more challenging than that, and therefore I think volatility is here to stay. Broad equity markets are likely to trade sideways from here through mid-2023. There are specific opportunities, but it is hard to take strong directional bets in this environment.
So Ethan, let's talk about some of those opportunities. What are the best sort of inflation hedges here right now?
We look at the traditional inflation hedges as being infrastructure, real assets, real estate. These are assets that would typically pay an inflation-linked income. Obviously, equities themselves are an inflation hedge. They tend to be a somewhat looser inflation hedge. They won't necessarily react positively in the case of an inflation shock, as we're seeing. So that would be where we'd stay. We would steer clear of fixed income, pure play fixed income, certainly preferring to see some of the floating rate there. But overall, keeping a broad-based portfolio, staying exposed to both private and public assets so that we're not necessarily forced to take that mark-to-market correction. That's where we see is our way of building an all-weather portfolio.
Alejo, you talk about markets continuing to trade sideways. Do you think we'll find some new lows back to mid-June? Some are calling for a 3,600.
It's certainly possible. We think the best way to position in this environment is to bias portfolios towards defensive style sector strategies, focus on quality, focus on some income generation. Income has returned to fixed income in 2022, so there's some opportunities there. Look, I think volatility is here to stay. You can take advantage of this higher volatility in equities, in fixed income, in currencies by taking advantage of certain strategies according to your goals. But once again, I think relative to what's priced in, the reality is most likely going to be more challenging. And this means we could test new lows. But by and large, we expect equity markets to thread water in coming months and going into 2023.
Alejo, I know you closely track emerging markets. Now we have the Fed really doubling down. The comments from Powell on Friday, they will not stop raising rates. It doesn't seem like anytime soon. What does this mean for emerging markets? Can they weather it?
Look, historically, tighter liquidity is not good news for emerging markets. The cost of financing at the sovereign level, at the corporate level goes up. We've seen difficult periods from a macroeconomic perspective in the emerging world, usually being preceded by a sharp tightening in global liquidity. So I simply don't think that today is going to be an exception. However, when you look at how prepared the larger emerging markets are for a more difficult global environment in terms of liquidity, the picture is not bad, right? It's a difficult environment, but it's not a crisis-prone environment. Take a look at current account balances. Most large emerging markets exhibit current account surpluses. When you look at external debt relative to external assets, not a bad picture either. When you look at the proactiveness of central banks in the emerging world relative to the Fed, the Brazilian central bank started hiking interest rates over a year before the Fed. So by and large, when you're looking at Mexico, Brazil, Chile, Colombia, Peru, when you're looking at Poland, Hungary, China, Indonesia, Malaysia, not badly prepared for this environment, even though it's not going to be easy.
And Ethan, I want to ask you about the strength of the US dollar and really the sort of domino effect that that's going to end up having on the US economy and potentially the global economy.
It's a really interesting point. I'd also like to address a little bit of the emerging markets. I think what we're seeing and what really came out after Jackson Hole's speech was that we really had to throw off the guardrails in terms of what the Fed considers to be, say, a neutral rate of interest rate. We're now in this form of, we may use the abused term regime change, but the guardrails are off. Investors don't know what is a norm, what is a neutral any longer. That's why markets are this unsettled. I don't think this volatility in equity markets will persist. I think it will persist in fixed income markets because the interest rate trajectory still remains quite unprecedented in our current sort of frame of reference. When it comes to emerging markets, we have this additional uncertainty then thrust on an area that was already somewhat uncertain from a geopolitical standpoint and an inflationary standpoint. And that gets us to the testing of those institutions. The institutions were being tested, but they're still in a fragile state. And with this new regime change, it makes it look even more uncertain. And we've had to certainly very much question our emerging markets exposure at this time, just in terms of re-underwriting it. When it comes to the strong dollar, absolutely, that will have a negative effect on the US economy. It'll affect our exports. It's going to ultimately weaken our trading partners. And we are in this global economy. We need these trading partners to survive. And it's also reaching a level now that is quite out of the range of normal trading. So it is poised, we would suggest, for a correction. It certainly makes non-US holdings very hard to defend at this point, given the impact that currency changes are having on those returns. So this is a worry for us.
Ethan, David, Alejo, Trawanko, thank you so much to both of you for joining us this afternoon.
Well, SoFi Head of Investment Strategy, Liz Young, joins us now with more on the markets. So, Liz, as you're taking a look at the market action right now, what sort of questions do your clients have?
Well, I think everybody has the same questions right now, and that's whether or not we are headed for a more catastrophic type recession. I still maintain that I don't think that needs to happen. There's a lot of bears out there saying that it has to happen in order to bring inflation down, and that we've never had a situation where inflation has been fixed without a big recession. Now, I think we've gotten a little bit more used to the idea of having a recession, at least sometime in 2023, as we cool demand. And now, as we've heard from the Fed, that they do expect to have some pain on consumers and businesses. But it's a matter of the big question being, how big does that recession have to be? Now, we, as you've already mentioned, have gotten some pretty strong JOLTS numbers today. The labor market continues to be tight, continues to be strong. If that doesn't crack in a meaningful way, a recession, even if it does happen in 2023, does not have to be severe.
Liz, what does this mean for the Fed, do you think, in September? Because we mentioned that JOLTS number. We've gotten a string of econ data that shows what you were just saying, that things are actually okay. Is that going to do you think we have enough conviction, at least at this point, in order to see the Fed hike by 75 basis points next month?
They could look and look, they left open the possibility of 50 or 75. The market continues to be kind of split on those two possibilities. What investors also need to remember, and this is what the Fed is watching as well, is that the pace of quantitative tightening, or that balance sheet roll off, or taking liquidity out of the market, the pace of that is going to double in September. So then there's two tools that are working against liquidity in the market, both rate hikes and that quantitative tightening pace. And they are definitely taking that into account. Now, the one thing I would say that would be in the 75 basis point camp is that the Fed has continued to message that they would rather go too far than not do enough, because trying to clean this up later, if they didn't go strong enough in the beginning, is much harder and much more painful for the economy. So if you really had to choose, they probably err on the side of doing too much. However, there is a very important CPI read that we are going to get before that September meeting, and that'll come on September 13th. We'll get the rate hike news on September 21st, and I think that that's really going to show the Fed whether or not some of this tightening is already working.
So as you're looking at some of this market action ahead of this big day that we're expecting out of Jackson Hole, talk about some of the things that the markets are digesting right now.
Well, thanks for having me. I think we're all sort of on pins and needles as to what Powell might say. I think that expectations for clarity might be a little beyond reality, though. I think we'd all like some clarity from Powell as to where he sees the Fed funds rate peaking, when, and then what impact that is likely to have in the economic scenarios over the next year or so. The likelihood of actually getting that kind of specificity is, I think, pretty low. I think what we really want to hear simply is, how's the Fed looking at the situation now? Are they encouraged by the decline in inflation we've seen? Are they still very worried about inflation? I think that's going to be the message we get from Powell, that they need to get this under control. But the nuances will be important. And then, the title of his speech is about constraints on the economy and the markets from Federal Reserve policy, and just how much can the Fed influence the economy and markets. And I think it'll be interesting to see what he says there, because that may set the stage for some sort of different framework from the Fed than we've seen before.
Well, Kathy, the Fed certainly has a massive challenge, right? Finding a way to cool inflation, trying to do it without damaging the economy. From what we heard in terms of the Fed's playbook up until now, what we will likely hear over the coming months, do you think the Fed is going to be able to walk that thin line, really thread that needle that I think Wall Street is a little bit uncertain about at this point?
Oh, I think it's going to be a real challenge. This is not fine tuning, and I would not say that people at the Fed have a clear vision of a pinpoint of the Fed funds rate or the amount of quantitative tightening to do to achieve that soft landing. Obviously, that's the goal. And it's pretty good situation they're starting from because unemployment is low. The economy is kind of churning along. It's not falling off a cliff. But the headwinds are, tightening in Europe and other global central banks going into a very risky situation with the energy prospects there. The Bank of England tightening, even though they're forecasting a recession. Slowdown in China. The Fed's going to have to walk a pretty fine line between hiking enough to get inflation down, but not going overboard and sending us into a recession. And that's going to be a real challenge.
How much do you think we'll hear about the balance sheet? We haven't talked about it. We haven't heard about it much. It's been so much focus on the hikes.
Well, I hope we hear a little bit more about it because there's a lot of question marks around it, particularly their mortgage-backed securities holdings, which they have indicated that they want to bring down. Esther George at the Kansas City Fed actually did make some comments today about it, or yesterday about it, saying that she's taking that into consideration as a part of the tightening program, and that's one reason she hasn't been in favor of more rapid rate hikes, because she's wanting to see what the lagged impact, not only the rate hikes is, but also that quantitative tightening, which is really just starting to get underway. It's going to pick up steam in September. So I'd love to hear more about the Fed's plans. I'd love to have them say, $1 trillion reduction is worth how many basis points in tightening. I don't think I'll get that clarity, but that would be great to know.
So then, Kathy, what's the play here in terms of fixed income in this sort of environment?
Well, we've been suggesting that so we came into the year saying keep duration low because we knew that we were on a path of higher interest rates. Now that we've gotten to, plus 3% on the 10-year, now we're at a flat to inverted yield curve. Now we're suggesting investors take a look at some longer maturities of high credit quality. So you could look at investment-grade corporate bonds with maturities in the 5 or 6 year area that have yields north of 4%. That's pretty good when you compare to where we were for the last several years, and also compared to dividend-paying stocks. So, there's finally income and fixed income, and we think that the trajectory here will be flatter, more inverted yield curve as the Fed hikes, and investors should really take advantage of that.
Kathy, in terms of what the Fed needs to see in order to pull back and not be so aggressive with its rate hikes, certainly up for debate just in terms of whether we've seen peak inflation right now or what that could potentially look like over the coming months. What do you think is the 1 or 2 data points that the Fed needs to see in order for us to see the central bank ease in terms of its Fed policy at this point?
Yeah, I think the key would be a slowdown in wage growth. So there's a lot of focus on the low unemployment rate, the tightness in the labor market. Now, we're starting to see some indications it is loosening up, but I think they'd like to see that, employment cost index, which has been running north of 4%, start to ease down. And same with average hourly earnings. They'd like to see that kind of slow down and level off at a lower level. That would indicate that we're not getting wage pressure, and that would point to the likelihood of a slowdown in inflation with demand kind of easing back down to match up with where supply is. I think that's a key driver of Fed policy going forward.
Indeed. Kathy Jones from Charles Schwab on a huge day ahead. Appreciate your time. Thanks.
Well, the fallout from the war has been devastating for soft commodities, but that's not the only factor. Record heat waves, ongoing droughts, and skyrocketing fertilizer costs have seen cereal prices soar this year. We are well off our highs for the year, but where do we go from here? Michael Magdovitz is a senior commodities analyst at Rabobank. Great to have you on today. Let's start by talking about where prices are now, because you said that even though we've seen a discount from the highs, that's not going to bring a whole lot of comfort when you consider where the dollar is now.
No, it's not. If we look at prices, we've seen a 2-year bull market for soft commodities since around when COVID began in April of 2020. And prices, for example, for the BCOM index rose as much as 138% from that time period before seeing a pullback, which you described, which has to do with several aspects. The most important of them, though, are the economic headwinds and the shifting consumer sentiment that we're seeing, whether it's people opting for chicken instead of steak, or whether people are not driving on the road. Recall that gasoline is actually 10% ethanol made out of corn. So what we are seeing is soft commodities pulling back with these recession fears, and a strong U.S. dollar is part of that, because the fact that we've seen a pullback, well, the U.S. dollar, the DXY, is at a 20-year high, and it's cold comfort to a lot of these importers to have to be paying for these goods in dollars, and it offsets a lot of the pullback as well.
I want to get into more of the inflation and climate impact, but let's talk specifically about the impact from Russia, Ukraine. We are obviously marking 6 months since the war began today. Obviously, grains, fertilizer, there's certainly a number of things that we have seen push higher on the back of what's been playing out. How much of that you think has already been priced in? Because there is still no certainty as to how this all plays out months from now.
Well, the impact of fertilizer has been enormous in contributing to inflation, and actually causing acreage itself in the United States, for example, to decline. So the principal user of the principal crop that we use nitrogen fertilizer for in the United States is corn. And corn production will be down this year, probably 5 to 6%. And considering the U.S. is the paramount exporter of corn to the world, that's extremely problematic for animal protein prices and for other prices. But talking about Russia and the Ukraine in particular, Russia is obviously a large producer of wheat and natural gas. The Ukraine also is an agricultural powerhouse in different areas. But the big impact here is natural gas, I think, from Russia. If you're looking at the price of natural gas for Europe, which relies heavily on Russia, it's about 15 times where it should be for a summer period. And that has an impact on anybody from a baker to a brewer. I know you're talking about soft commodities, but the impact of natural gas for a baker is much more important than is the price of wheat. So definitely something to consider. Yeah. So in terms of the Ukraine, go ahead.
Yeah, I mean, Michael, I'm looking at your notes here. You say that the price of natural gas has brought bread prices up 25 to 50%. I mean, that is an incredible increase when you think about where the costs have gone up down the line. I want to hit on the climate bit here, because we have seen record temperatures, droughts play out across the U.S., but not just in the U.S. We're getting these reports out of places like Texas, which has been suffering a drought, where we're hearing that ranchers are really cutting back. And in many ways, they don't have enough feed for their livestock, which is why they're sending more cattle to slaughterhouses. I mean, what is the impact down the line? Sure, that increases the supply for now, but there's got to be a huge supply crunch waiting on the other end, right?
Oh, yes. I could walk you through so many examples of climatic conditions that have actually impacted different crops. Texas, you touched on cattle, but I could also point out that cotton has been absolutely decimated and stands to, at the end of this next year, reserves in the U.S. of cotton stand to be, I think, at their lowest on record, which can impact the price of your shirt. And so we are seeing corn impacted. We're seeing cotton, cattle. And in South America, we're also seeing the impact of another issue called La Nina, which is a phenomenon that causes massive drought in Brazil and in portions of Argentina. And that is certainly impacting the price that cattle ranchers have to pay for their feed.
And Michael, finally, getting back to that point you made about inflation in sort of the trade downs that we're seeing, or maybe it's just different options that consumers are considering. Because beef is so high, maybe it's chicken, maybe it's one product for another in terms of produce. What do you see is the biggest beneficiary on the back of it? What are you watching really closely in terms of the inflation impact moving forward?
Well, we're already seeing consumer sentiment change in a big way. If you look at gasoline consumption in the United States, AAA has referred it to a COVID-like circumstance. And of course, if you were looking at $5 a gallon a few months ago, much of the reason why we've come off is because of less consumption. And it's a similar story if you look at grains, feed, oil seeds, et cetera. We are seeing people move down, for example, the animal protein chain. If you know, it costs a lot more grain to feed a cow than it does a chicken. And so we are seeing people consumers looking for respite in lower intensity and lower cost products. So there is consumer behavior certainly shifting. It's causing a downsizing in terms of use. And I think that's one of the ways in which you address inflation. Certainly, if you look at places like Aldi's, if you look at consumer behavior, you're seeing a pickup in footfall for discount chains that can provide, basically more affordability for your dollar.
Michael Magdovitz, Senior Commodities Analyst at Rabobank. Good to have you on today.
Hi, welcome back. Stock futures are under pressure this morning as the S&P 500 inches closer to breaking its 4-week winning streak. But our next guest says patience is required as investors await a recovery. Wells Fargo Investment Institute strategist, analyst Veronica Willis joins us. Veronica, sorry about that. Good to see you here on this Friday. It's Friday vibes here on the desk. You are still calling for a recession. We've seen a lot of folks, I think, on the street dial back recession risks. Why are you still standing firm with that call?
We think with, inflation at these elevated levels, even though it's cooled down a little bit, wages aren't increasing as quickly as inflation. And we're already seeing some signs that the consumer spending may start to weaken. And that strength in the consumer is really what's kind of been the bright spot in the economy. And once that starts to weaken, I think we're at risk for some more economic contraction.
So then what are the implications of that, Veronica, of that economic contraction, right? Things have been bouncing off the lows, right? If you look at the stock market lately, does that mean that things are poised to perhaps fall again or fall in particular areas?
There's definitely the potential for a little bit more downside here in the equities markets. We've seen this nice little rally here, and it's not unusual to see a bit of a rally during a bear market. And it's kind of key to remember that it often takes a little bit of time for the market to recover from a bear market. In 2020, it was a much different situation. We had a lot of stimulus coming into the market. The Fed was very easy, and that's just not what we're seeing now. We're seeing a very aggressive Fed. We're expecting them to keep tightening policy. They're taking liquidity out of the market. And it's not the same type of environment where we're expecting that kind of quick recovery from the lows. And we think that investors have to have a little bit of patience here. Maybe it's time to trim from those riskier areas, things like small caps, maybe some of those cyclicals, and move a little bit more defensive and focus on that large and mid cap, higher quality, that areas that are going to be a little bit more resilient if there's another downturn.
Veronica, this month we've seen a reawakening, I think, of the retail investment crowd, a real wild moves in some of these meme stocks. Is there anything you and your team have found that could be triggering these types of moves?
We think that it's really a sign that the consumer is still okay right now. There's still a lot of liquidity if investors are moving towards some more of those meme stock things, the areas of the market that are a little higher beta, a little bit higher risk. And that's kind of the first thing that we're going to look to slow down once we're actually at that point where maybe the recession has started and maybe there's a little bit more conviction that we're in a downturn.
And so how should people be attacking their strategy now going into the latter part of the year? If there is the potential for a recession to be happening, should people be positioning themselves differently than they have been?
Yeah, I think that the shift should be more toward higher quality, both in fixed income and in equity holdings. So I mentioned kind of a shift from small cap and maybe a shift from international equity towards those large and mid cap equities that are going to be a little bit higher quality, a little bit more resilient through a downturn. And on the fixed income side, maybe a shift shorter in duration to those short-term fixed income strategies that might be a little bit less at risk for sharp price movements based on the Fed raising interest rates.
Are you surprised, Veronica, how how quickly some of these big cap tech names have rallied from the June lows, and what's driving that?
I think a lot of it has to do with the sentiment in the market. It's not very surprising when investors are feeling comfortable. There has been some economic data that's come out that's been encouraging. We saw, that decline in inflation from the peak in June, and I think that has really increased investor sentiment. Because there was this kind of expectation that, maybe the Fed will be a little bit less aggressive because inflation has started to come down. But we are really encouraging people to be cautious when taking that kind of approach. Inflation is still very high right now. The Fed has reiterated that they are going to remain aggressive to get this inflation down. And so we're still expecting the Fed to proceed along the path that they've highlighted for raising interest rates. We don't think they're going to kind of let the foot off the pedal right now.
All right, we'll leave it there. Wells Fargo Investment Institute investment strategy analyst Veronica Willis. Good to see you. Have a good weekend.
Thank you.
More evidence of a cooling housing market today, with existing sales pulling back nearly 6% in July. Debbie Boyd is the CEO of DLB Financial Services. She joins us now with more on the sector and where we're headed. Debbie, nice to see you. So it was Lawrence Yun of the National Association of Realtors who provided that data and says we are, quote, surely in a housing recession. Do you agree with that assessment? And how significant is it?
Well, thanks so much for having me. Real estate is always local. And when you look at the local markets, yes, if people are leaving your city, moving to some other city, then you're going to think you're in a recession. I'm in Texas. Texas is booming right now. So we're not in a recession. I think you have to look at this on a local level. Also, just because the numbers are down, that's kind of misrepresentative. They're down because people are in leases because they couldn't buy a few months ago. So they're still out there looking to buy a house. They just can't actively do a mortgage application and go looking for houses unless they want to buy out of their lease. But they're still looking.
Debbie, I can't help but wonder, is there a danger in saying this is a housing recession when, to your point, historically, when you look back to the last 3, 4, 5 years, home prices are still at an astronomically high level?
Well, what I try to tell families is it's really all in your family. So if you have to move, you're going to move. If your company's relocating and you go into the office, then you're going to move. If you want to be near grandma or whatever, you're going to move. Then you're going to buy a house. It's always better to buy than rent. So there's still going to be a lot of movement around. It is going to scare people into thinking that there's not a lot of home choices out there. That's why they've always got to work with a professional agent and a mortgage broker so that we can show them what's available. There is going to be a lot more home choices now than there was just a few months ago because everybody thinks that everybody's done looking, but they're not.
But Debbie, when you take a look at the numbers, supply of homes do remain tight. I know that might not be specifically the case where you are in Texas, but when you look at across the country, that is the case. And even the numbers out this week, residential permits, which is a bellwether to home construction, that fell about 1.3% in July. So do we see this on a nationwide landscape? Do we see this potentially not improving now for quite some time?
Well, I think the builders are kind of nervous of are they going to start building homes and then no one's going to come buy them? Are they going to start building homes and then get them under contract? It really depends on what the people in your area are saying. A lot of homes are back on the market because they fell out of that people couldn't afford to buy them if they were paying $50,000, $60,000 above asking price. The rates are higher. If they didn't get qualified right, then they can't qualify now. So we're seeing a lot of movement in the space. People are still wanting houses. Builders are still wanting to build houses, but there's a shortage of land, I think, everywhere where the roads are already done. So if you're starting a new build, it's going to take a little while longer, but these new builds are coming back on the market. Now home builders, the big national home builder companies, are actually reaching out to real estate agents saying, we're giving you a big advantage. We're giving you an extra $5,000. Please come sell our homes. Just a few months ago, they didn't have any homes to sell. It's always a timing issue when it comes to real estate.
Speaking of timing, homes are flying off the market 14 days on average in July, matching the fastest pace we've ever had from a month prior. So there's a lot of conflicting signs in here. And speaking of, mortgage rates fell from 5.22 to 5.13 at the moment. Mortgage applications at their lowest level since 2000. So if you're on the sidelines as a buyer, do you sit there and wait for prices to fall? Or are you overcome by the fear that mortgage rates are going to go back up as the Fed raises rates?
I think the smart people are getting the advice that you got to buy now. You can always refinance if the rates drop. 8 years ago, we never thought we'd see rates in the twos. Oh my gosh, I would have bet my life that would never have happened. So now that it happened, everybody expects it to happen again. I think that was just a fluke. These are where the prices are normally, 4s and 5s and 6s. Yes, if inflation gets really bad, they're going to go up again, and then people are going to stop buying. But if you need to buy a house, you need a bigger house, you need to move across the country, you need to sell your house. It's all family specific. So people bought houses when the rates were 18%, and they bought them when they were 2%. The thing is, the people are not going to sell their homes now if they're in a 2 or 3% rate just because. It's going to be a very enticing reason to double their interest rate to move. So it has to be for a really good reason.
Debbie, how much power does the buyer have in the home selling process? Because we talked about during the pandemic, the buyer basically couldn't ask for anything, and that wasn't too long ago. So how much power does the buyer have today?
A whole lot more, like double, triple, like back the way it used to be. Now they're asking for the title policy to be paid, the survey to be paid. Now they're asking for concessions and help on closing costs. If you don't have 25 offers bombarding you, paying $50,000 above, you've got to be nice to the 2 or 3 people that are making you offers if you want to sell your house. So we're seeing a lot of seller concessions right now, which is just the way you're going to have to sell your house in this market. Markets change fast. It could go back the other way, but I don't think so.
We've talked about all the dire data that continues to pour in day after day, but what one region of the country is really bucking those national trends?
I think the South, and you're talking Arizona, Florida, Texas, where a lot of the companies are moving. So now everyone wants to work remotely from home. Great. But there are companies that are moving employees still across the country. Those people are still going to be moving. They're going to states that do not have a state income tax. It's better for the businesses and better for the employees. So we do see a lot of movement coming to the South.
All right, Debbie Boyd, thanks so much for joining us here this afternoon.
All right, guys, and switching gears back to retail. Retail continuing to run markets this morning. Targets miss, tempering early earnings optimism seen from Walmart and Home Depot. Retail sales data adding to that picture. Let's step back and take a broader look with Steen Jacobson, who is the Saxo Bank Chief Investment Officer. Steen, great to have you here with us this morning as we are continuing to evaluate what this all tells us about the mindset of the consumer. What would you extrapolate from both the economic data as well as the earnings reports to really kind of paint the picture of exactly where consumers find themselves as a part of the economy right now that is 2/3 driven by them?
So overall, the consumer is in fine shape. And what you find in terms of the actual reporting, you find a very scattered sort of picture in terms of how the companies are doing. Some companies clearly has been left with too much inventories in this cycle. And some of them, of course, have been stacking up simply because 1 year ago, even getting commodities and goods on the shelf was a big issue. But overall, the private sector balance sheet has been shown to be extremely resilient. You see that through the credit card spending. You see that through even the economic data that comes out of the Federal Reserve and the Bureau of Statistics. So for me, this is just another example of how the market is clearly moving into a stock pickers market more than a momentum market.
Steen, let me push back on that because we've seen a lot of momentum over the past week on these meme stocks. It's been a very confusing names. We've been highlighting all morning long, Bed Bath & Beyond, seeing some big moves and a lot of cash plow into AMC and GameStop. What is driving this?
It's the euphoria. Basically, if you want to really create a narrative, I don't think stocks like that need a narrative in themselves because it's like a game. For a allocator like me, I don't even spend more than 2 minutes a day concerning myself with the meme stocks and the likes. But if you want to find a rationality for what goes on, it's basically that the soft landing is going to work for the equity market. We have a free ride in terms of the maximum interest rate that we'll see. And on top of that, then you clearly get what we in our business call convexity plays. So as interest rate and volatility comes down, these stocks become extremely attractive for short-term speculators. But let me stress, this is entirely speculative. You can just as well go to the casino and put all your money on black.
Oh, yeah, no, I'm not going to do that. Steen, when we think about, though, what you just mentioned a moment ago, the soft landing probability and whether or not a real recession would be felt as part of that soft landing, what would you kind of put the expectation at around that?
So I think from my perspective, we are in a recession if you want to talk about real growth, but we are so far away yet that is almost imaginable if you talk a nominal growth. So like now, the U.S. economy is humming along with 9 to 10% nominal growth, while the reporting that we've seen in terms of 2 quarters of negative growth in real terms is coming down. But remember, the stock market is actually using nominal growth rates. Of course, the sales top line of most companies is cost driven by the actual sales they have, not the real sales. But if you did actually bother to do the exercise of taking nominal growth of the for instance, the retail companies and deconstruct that with the actual underlying inflation rate, you will see that the numbers that's been reporting in earnings per share is actually very, very poor relatively to the euphoria that exists in the marketplace. So a long answer to your question, basically, in real terms, we are in a recession. In nominal terms, there's not even a 10% chance that we reach that in 22 in terms of for the nominal side of it.
So, Steen, just staying on some of these retail earnings, look, the weakness was very clear at their core. I mean, do you think these numbers from a Walmart, Target, you name it, even TJ Maxx, they suggest we are in a recession?
No, I don't think they necessarily. I know we all love to view the back of an envelope. 70% of the U.S. GDP growth is from consumers. But the consumer side that the Targets and the Walmarts you look at is the consumption, and it is the consumption, if I'm diplomatic, at the lower end of the income brackets. And lower income brackets, of course, is severely hit. So what I think is the biggest story here is that the low income brackets in the U.S. is being hurt massively and being impaired from the high energy prices, from the higher inflation that we see. But in terms of the middle income and the high income brackets in the US, there's absolutely zero impact so far in terms of their ability to both live through this inflation elevation, but also deal with it. So in total terms, if you take the relative size of the different brackets, we are still at a very slow and grinding and bleeding lower in terms of the consumer's pocketbook, basically.
Steen Jacobson, Saxo Bank Chief Investment Officer. Good to see you. We'll talk to you soon.
Good morning. Happy Friday. Welcome back to Yahoo Finance Live, everyone. Fears of a recession have been growing on Wall Street over concerns of record high inflation. We saw potential signs of inflation cooling this week, but investors are not convinced that the worst is over. We took this question to major executives this week and asked them how recession fears are impacting their business. Take a listen.
During recessionary times, I think we are actually incredibly well positioned to really disproportionately take share and build that brand equity because we're really delivering on something people need.
You look at our internal dashboards, you wouldn't know that anything is happening in the world, with the possible exception of inflation, which we do feel.
So we've been able to weather through that storm and still drive some profit to the bottom.
So, we hear about a recession, and again, we may be in one. It's always backward looking. But from what we see, we've never grown as fast as we have from a volume standpoint, and our outlook for the remainder of the year is very, very positive.
Okay, so those were the CEOs of Lemonade, Wendy's, Hims and Hers, Saz. I want to get your take here.
Well, let's go through them one by one. We had Hims and Hers CEO come on here. Well, first of all these CEOs are not going to come on here saying, hey, we're in a recession and we're going to think things are going to get really bad in the back half of the year. But you can always hear and pick up certain things in their tone because we've been doing this for a long time. So Hims and Hers actually saw an increase in subscribers. I think in a recessionary and more just those subscribers spending more per transaction. If we are in a true recession, none of that is happening. People are getting off of that service. They're not signing up for it. And they're probably switching to cheaper vitamins and, I don't know, ED medication, whatever it is what it is. Also, Wendy's CEO, Todd Penegor, has been the CEO for numerous years, telling us that this quarter has started well. People are not only going out there and visiting Wendy's, they're switching from $4 value meals up to the $5 biggie bag. So they're spending $1 more to get more in the biggie bag, which I'm a big fan of. But again, if it was a true recession, you are not only sticking with that $4 value meal, you're perhaps trading down, getting maybe a small fry, a small soda, and a one patty burger. So again, that's another indication as well. And in insurance too, Daniel Schreiber talking to us from Lemonade, they saw an increase in their business in the most recent quarter, struck an upbeat tone for the back half of the year. In a recession, people maybe are canceling their insurance.
That's really interesting. Okay, so, well, going back to the necessity part of this as well, on the food side with Wendy's, that's particularly interesting because I'm old enough to remember the dollar menu at some of the McDonald's of the world and all of the competition that ensued thereafter to try and help people hedge against some of the spending that they were doing during the GFC as well and during that financial crisis and the economic downturn that ensued thereafter as well. And so with all of that considered, now you're looking at a consumer profile that knows prices are higher yet is opting into some of the better tastes or menu innovation, even if it looks like, okay, it's only going to cost me $4 or $5 at this point.
If I know I'm going to have to pay more for something at Wendy's, I want the best Wendy's has to order. Yeah. I'm going all in here.
It's a little luxury at that point.
If I have to pay more to get my Triple Dave burger, I'm going to go for it. If it's more, it just is what it is. And you're just going to go out and get those items. And it's not just Wendy's. You know, we talked to Dine Brand CEO John Payne. He said his quarter has started off pretty good as well. Struck an upbeat tone for the back half of the year. Why? Because gas prices have come down. And here's my take. We'll throw up this graphic on the board, just following all of those CEOs talking here at Yahoo Finance this week. It is very simple. Don't worry, be happy. And there I am on the beach, lots of smiles, feeling good. You can see what you don't see there is my CEO friends smiling offside the camera, agreeing with me. Look, we got a lot of signs this week that the economy is not in a recession. And what's wrong with that? We shouldn't be rooting for a recession.
Also not pictured your ukulele and your Crocs.
And my tequila.
And the tequila as well, of course, here. You know, what is it, a pina colada? Val said it's pina colada.
It is a pina colada. I mean, that team just goes above and beyond for us. But that should be a Wendy's. That should be a little bit of Wendy's soda.
It should be, the Wendy's, at least the lemonade, the pink lemonade, because we tried that out as well.
Yeah.
And that mixed with a little bit of something will probably start your weekend off right.
It is, to say the least, a weird time in this economy. The labor market's good, people are employed, but inflation is high. And there's no doubt Americans are feeling it. So how do headlines like this that you're seeing on your screen impact the psychology of the consumer in this weird economy? And how could that feed into the recessionary dynamics? Let's bring in UC Berkeley Haas School of Business professor Barry Schwartz for this conversation. Professor, it's great to have you on because I feel like we need to take a big step back here and just acknowledge the role that the way that people think factors into the actual economic happenings that we're experiencing. What do you see as kind of the big play here in how the way that Americans are thinking and consuming factors into the immediate issue of high inflation?
Well, let me just say amen to your sentiment. When economic uncertainty happens, people always go to economists to try to explain what's going on. And economists have a lot to offer. But I think the really significant impact of things like inflation or recession is not in the short-term problems with supplies that might spark it. It's not that gas prices go up for a few weeks because of some political intrigue going on somewhere in the world. What really matters is whether they persist. And whether they persist depends not on this immediate shortage, but on what people think this immediate shortage predicts about the future. Our decisions about whether to spend or save, whether to loosen our belts or tighten our belts, are all based on our predictions about what tomorrow's going to be. And that is really in the realm of psychology. Do I think that hard times are coming? Well, if so, I'm going to cancel my vacation. I'm going to cancel my work project, updating my home and stuff like that. Do I think this is a temporary problem? Well, then I'll go on my vacation and I will get the workman in to give me a new patio.
So then when we just had a chart up there showing how consumers are feeling versus how they're spending. So is that about confidence in the future, or is this sort of spending, comfort spending to make yourself feel better?
Well, there's a little of both. People may be very nervous about the future, but so down for whatever reason that they feel it's almost like they need to take another hit of a drug. Even though they know it's foolish, they do it because I feel so bad. Maybe this will make me feel a little bit better. But that's a short-term thing. The long-term thing, making strategic decisions about whether and when and how you're going to spend your money, is really about whether you think the current economic conditions are going to persist. Robert Shiller, Nobel Prize-winning economist, has said that if there's a recession, it will almost be self-fulfilling. It'll be the result of how we're talking ourselves into a recession. There was an op-ed in the New York Times last week by Kyla Scanlon, and she said, quote, "The root of economic problems lies with expectations." And that's the realm of psychology. And I got to say, this has always been true, but prior to the 24-hour news cycle, you just didn't get bombarded over and over and over again with economic news, trivial changes from 1 hour to the next. Now we're just assaulted with it in the same way that when we're driving around town, we keep seeing these signs for the price of gas and we can't avoid it. Well, now you can't avoid people predicting that prices are going to go up or, jobs are going to go down or what have you. And it just starts to infect you. And lead you to have either optimistic or pessimistic predictions about what tomorrow is going to be like.
And Professor, you talk about the 24-hour news cycle, right? I mean, people might be listening to our conversation and forming those views, but it also depends on what policymakers are saying as well. And we heard President Biden trying to take a bit of a victory lap over the July inflation numbers yesterday. Take a listen.
I want to say a word about the news that came out today relative to the economy. Actually, I just want to say a number. 0. Today, we received news that our economy had 0% inflation in the month of July. 0%.
But then you had economists like San Francisco Fed President Mary Daly, who has the ability to lever interest rates, saying in a new interview, quote, "Consumers and businesses are getting some relief, but inflation remains far too high and not near our price stability goal. This is why we don't want to declare victory on inflation coming down. We're not near done yet." Does this add to the confusion that Americans feel when they're getting these types of commentary out there?
Surely it does. But I got to say, confusion is better than simply being wrong. It's being wrong about the future that leads people to go out in their lunch hour and buy groceries because by the time the workday is over, the price of groceries is going to be up 5%. If we're uncertain about the future, it's not going to lead to a kind of systematic explosion of expectations about what prices are going to be like in the future. So if we just don't know what prices are going to be like in the future, chances are pretty good that we'll behave tomorrow the same way we behave today and curse all of these people that we're watching because they're not all speaking out of the same side of their mouth. And I got to say, with respect to Biden's comment, I think this is an effort to try to diffuse the incessant talk about inflation or recession so that the sort of expectation-driven worsening of those conditions can, to some degree, be dampened. There isn't zero inflation. He knew there wasn't zero inflation. He was just trying to tell people, listen, don't listen to all these hysterics on 24-hour news telling you how bad our economic future is. It's not bad.
So then, so as we look at this then, you're trying to keep a level head, taking in this information. What should people do to really so that they can get a real clear view of how they should be viewing the economy without sort of panicking at every sort of bit of news data that comes out?
I wish I knew how to answer that question. There's a joke among non-economists and some economists that the economic profession has predicted 9 of the last 3 recessions. So everybody would like to know the secret of what tomorrow is going to be like, but nobody knows the answer to that question. So all I can say is to take all that you're hearing with a grain of salt. Many people, most of the money they spend, they need to spend. They spend on necessities. But there are a lot of people in a privileged position where a significant amount of their spending is discretionary. And so it seems to me, if you're a little bit uncertain about the future, you pull in your belt a little bit for a month. It's not the end of the world to defer some of these discretionary expenditures. Get your new washer and dryer in October instead of getting it tomorrow. And as things settle out, you'll come to a view about how stable the economic future is and in what direction it's moving. And then you can start pulling the trigger. But, you can't find certainty. And I think confusion is better. It is better to be confused than it is to believe the wrong thing.
Well, we're going to leave that there. That's an interesting mantra to end on. Thank you for joining us, Barry Schwartz, UC Berkeley Haas School of Business professor. Thank you for joining us this afternoon.
Thanks for having me.
Well, for more on what's happening with the markets, let's bring in Insignio Chief Investment Officer Ahmed Riazgo and Oxford Economics Chief U.S. Financial Economist Kathy Bostjancic. Thank you both for being here. So first, I want to start with you, Kathy. In terms of the economic environment, with this latest data added in, how should we be characterizing how the U.S. economy is doing right now?
Well, thank you. I'm happy to be on with you today. It's a unique business cycle. So the numbers at times can be a bit confusing. But what we're seeing is that inflation pressures are easing. And it's mostly on the goods sector. As you said earlier, the core service side of the equation still looks quite sticky to us, and that's really being led by higher residential rent prices. Yes, hotel prices were off, car rental prices were off, but in general, the core service prices is something that we're watching closely. So the inflation picture is getting better. It's going in the right direction. The overall economy is slowing. Labor market still remains really strong. And just one last point, bringing that back to the inflation picture, if you look at wages, especially services, jobs, the wage growth is still quite strong. That's going to have a good correlation with core service prices. So that's something we have to keep in mind. And we're not done yet. We can't call victory on inflation.
Yeah, Ahmed, let's talk about the market reaction. You heard Kathy there say that we're not out of the woods just yet. Yet when you look at the reaction today, there seemed to be some relief, at least in the number, that it didn't tick higher than expected. How did you view it in the market context?
Yeah, I mean, we think actually the market reaction is pretty in line with what we've been saying. We've actually been pretty sanguine on the U.S. outlook. We've been pretty adamant saying that we're not in a recession in the United States, despite the 2 consecutive GDP prints. Primarily because of the strength of the labor market, and that's still quite robust. So we continue to see gross domestic income in the United States quite high, definitely not in negative territory, perhaps not as robust as it was earlier in the year. I think what the market is cheering right now is it's taking kind of the worst case scenario for the Fed, or at least the Fed rate hikes off. Where we are disagreeing with the market, and we think the market might have sort of swung too far in the opposite direction, market's already pricing in 50 basis points of rate cuts into 2023. And precisely because we see the U.S. economy in relatively good footing going forward, and we do see inflation coming down, mostly because of decreasing margin costs and rising inventory levels, we don't think the Fed's going to be able to cut as much as the market's currently expecting. So that could lead to some volatility down the line. We're looking at perhaps more in 2023. But for the rest of the year, we're pretty sanguine on the outlook.
And Kathy, obviously consumers happy to see gas prices at the pump continuing to tick down at around $4, just slightly over $4 a gallon right now. And also, obviously, oil prices still continuing to tick down. How enthusiastic should we be, though, about this trend? Is this one that you expect to continue, or are we perhaps unprepared for some surprises ahead?
Well, we think that it will continue. If you look at futures prices for gasoline and oil, it does look like we're on a downward trend. But you're right. At any given month or any unseen exogenous shock could send prices soaring again. So we do have to be careful there. But I do think we're going to get some reprieve. I think the big question is on the food category, and if food prices continue to soar higher. We're up almost 11% year on year for food prices. That's the fastest pace since 1979. Is the consumer going to get some reprieve there? And there's some indications that may happen, but it's going to be a little bit more delayed relative to where, commodity prices, which have already fallen. But if food prices come off, that's really going to be another boost to consumers. And I think we're going to see consumer sentiment, confidence measures start to get a bit of a lift and come off of the lows that we've seen. And that certainly can help, and it help with purchasing power, right? And help stabilize the economy. We're a little less rosy on the outlook for next year. We don't think recession is baked into the cards, but we do see economic growth continuing to slow. And we think by the end of next year, actually, we do think the Federal Reserve will be lowering rates pretty aggressively because inflation will be lower and economic growth as well.
And when you think about the sectors hit hardest on this expectation of more aggressive rate hikes, obviously high growth tech names getting hit. We've seen some of that money flowing back in. Today, tech, one of those sectors that's leading the way. Are we starting to see that debate, growth versus value, kind of reverse, or is it too soon to make that shift in your portfolio?
Yeah, we think it's too soon. I mean, there is obviously an opportunity for short-term bounce for growth and growth factor style equities. But if you look at historical valuation metrics, it's still quite expensive versus value. Historically, growth tends to, trade at around a 55% premium to value. That got as high as to 130% just 6 months ago. We're only down to about 90% there. So if you look at historical levels, it's still expensive. So I still think, if anything, this is a good opportunity to sell out of growth with this recent bounce and keep tilting further into the value space, which still remains historically cheap versus growth.
And Ahmed, just a quick follow-up there. In terms of any sectors that you're starting to rotate out of, what's on the agenda there?
Well, we are looking more than anything to buy into some dips that we've had in some of these prices, like even the commodity complex, the energy sector, which has come off the boil a bit. We think that we're sort of in the early stages of a long-term multi-year commodity super cycle, and it really has nothing to do with the demand side. It has simply to do with the supply side. Most commodity markets, with a few exceptions, such as like iron ore, most of them are in physical deficits, and we really don't see these being resolved anytime soon. So we think the drift in commodity prices will continue upward in a multi-year horizon. So we're looking to add there. We're also looking to add generally in sectors that have high dividend, high income stocks, because we think those are the ones that tend to perform better in a high inflationary environment, which unfortunately we think we're going to be in for quite some time. Inflation is not going to be at the levels we saw earlier this year, but I do not see it dipping down to the 2.25% long-term Fed comfort level anytime soon. So we think that those stocks will continue to outperform.
I think most customers are preparing to be in a recession. I think there's a chance you could have a technical recession, but I don't think it'll be long-lived. I do believe that as the monetary policy becomes a little bit more predictable and perhaps even loosens, let's just say a year from now, if you see inflation numbers come down and you see monetary policy stabilize, you're going to see the markets run, because business is great. And the business for digital companies like ours is fantastic. And actually, I see the tailwind coming into the market again, where people are now saying, okay, I've done the great reprioritization. I know which platforms matter. I actually know what those platforms do. I'm doubling down on digital transformation. So I see that tailwind actually reigniting even stronger than it was before these macro crosswinds became popular to talk about in the last 90 days. So I think growth is back, especially for digital companies.
When do you see that actually taking hold, though? I mean, do we need to see a resolution in Ukraine? Do we need to see this cycle turning with the Fed?
Yeah, I think that the Ukrainian situation is unpredictable and probably could last a while. And I don't think that'll be a bellwether for the overall economy anywhere in the world. Yes, the supply chain complications are there. Yes, there's issues. And of course, it's a humanitarian crisis beyond belief. And we're all heartbroken to see this happening. It shouldn't be happening in the 21st century. It's hard to actually stomach. But that aside, it won't be the determining factor in the economy. I do think inflation's the big thing. So once inflation stabilizes or starts to come down, I think that is going to be a very, very good sign. And I don't think it'll take that long given the tightening of the monetary policy, not only in the United States, but now also in Europe. So I'm actually really optimistic right now that you could have something technical, short-lived, and I think the economies are actually going to be fine.
Investors are still digesting a key read on inflation out this morning, with the Consumer Price Index showing an increase of 8.5%. For more on this and the broader investing landscape, let's turn now to Scott Kroner, Citigroup Managing Director. Scott, great to see you here this morning. I really enjoyed your note on investing themes. I talked about it early in the week, but I want to get your instant reaction to the CPI report. Markets seem to love this. Are they right or are they wrong?
Well, I think they're right. I think there's been a lot of angst regarding the peaking in sort of Fed hawkishness, and I think what this sets up for is a little bit more appropriate Fed response to what we're seeing in terms of economic activity. So if you look at the Fed funds futures, for example, this expectation for Fed funds peaking in the beginning of 2023, it's an important narrative in terms of how we think about equity market positioning. So I'd say, yes, the response here is spot on for this particular data point.
In your view, was the June low the low?
In our view, the June low was the June low. We think at that point we were close to pricing in a mild recession. And so anything regarding interest rates or earnings that would be an upside to that mild recession risk were net positive for the market. Ergo, we had a positive view towards the second half for the S&P, which is sort of playing out pretty quickly here.
What type of basis point hike does this give the Fed credence to do at their next meeting?
Well, the discussion had always been around 50 to 70, and then 100 had crept in. I think this probably takes it back down to the 50 to 70, 75 basis point discussion. Somewhere in there we'll see, because we still have some economic data between now and then. But I think suffice it to say, the Fed still has to keep an eye on getting this inflation situation down to a point where it can probably step back and take a look at how the economic activity indicators fall from here. And I think that's still on the come.
We saw the jobs report last week, pretty strong. This report, encouraging. Are we just not going into a recession?
So there's a discussion out there that the soft landing scenario can take hold here, and that's part of our math in terms of how we think our S&P targets. I'd say there's probably still a decent chance of that. To get there, though, the way this has to play out is what's happening in the broader economy isn't precisely aligned with what's happening in the stock market per se, sort of a function of the construction of the S&P 500.
So the market hasn't priced in a soft landing?
I don't think, the market has not priced in a soft landing. You can think of S&P levels more in the 4,700 level to reflect that.
So Brian referred to the thematic investing note that you put out. So if you're looking at a soft landing scenario, what groups then, what themes become the most attractive?
So let's step back on this, okay? So our view had been going into the second half, S&P 4,200 is a year-end target. We're nearly there. With today's action, we might be very close. That doesn't mean you exit the stock market. What it means is that you have to begin to move away from an index focus around traditional macro variables to, let's call it, much more of a bottom-up focus. And what the thematic approach does is begin to identify longer-term structural approaches to investing in the market that can help you navigate soft landing or mild recession, essentially a path to look across an economic valley to the other side. So what we're doing with this thematic approach is another means of leaning into the growth side of the market. The types of themes that are coming up in our work would include everything from artificial intelligence, internet-based business models, net zero, emerging market consumer, and top brands, which is sort of a moat play, if you will. But all of these align with approaches to stock selection that have more of a structural growth bias. That is our means of navigating this ongoing Fed on, Fed off economic recession or not situation in the broader markets.
And so across any theme right now, it still comes with this caveat that you could have companies come out and continue to provide guidance that is lower than what the street may expect in the near term. And so as we're seeing even not just throughout the rest of this year, but even going into early next year, some of that guidance start to come in and then forecasts and outlooks. What would you be looking for specifically to say that we've actually turned a corner?
Right. So you start looking for, obviously, for negative guidance or bad news to elicit a positive market response. And that's sort of an ongoing, approach that we use. What I just want to emphasize here is that when you look at the first half of the year, the major multiple compression on the initial inflection in rates was on the growth side of the market, which is going to align with a lot of these themes that we're talking about. So our view all along has been that the rate effect on multiples has been mostly priced in, and going back to that June low discussion. And so from here, the issue does become, in our view, more of earnings growth trajectories. So you're right. You can still have a thematic play that succumbs to near-term economic response. Got it. That's to be expected. But still, what you get is some comfort that the underlying growth trajectory on a longer-term basis that comes with said company or theme is a means of navigating that near-term volatility around economic consequences.
So when you talk to your various analysts on the team, are there certain stocks that continue to pop up in their work that they like based on some of these themes?
Unfortunately, I can't talk to specific stocks, but the fact is, when you look at the S&P 500, and this was what was sort of interesting about the note, we have 91 themes that our Citi theme machine follows. And not all companies within the S&P 500 are allocated to these themes. So you have a lot of companies within the S&P that don't fall in this thematic approach. When we look at the performance of the stocks that are in the S&P that are in themes versus those that are not, they've tended to outperform over the past 3 years. Now, again, past 3 years has had a growth stock bias to it, so it's not a big surprise, but it still plays to the same discussion. Essentially, you're looking for longer-term growth opportunities in a market that's still reconciling where we are with interest rates and economic activity.
Well, good to see you in studio for a change. We're avid readers of your work. Scott Kroner, Citi Managing Director, good to see you.
Let's take a broader look at the markets today with our first guest. We've got Ryan Payne, Payne Capital Management President, Payne Points of Wealth podcast host. Ryan, it's good to talk to you today. Give me a sense of where you think things are headed right now. As Brian said, it's kind of sort of the quiet time of year in the summer, but we're starting to see a lot of money move back into tech.
Yeah, I mean, there's been a lot of action this summer. And I'm typically optimistic. As you know, I'm optimistic right now. Because I think, the real theme this year, all you've heard about is economic slowdown, the big R word being recession. And I think the big R word is not recession, it's actually resilience. If you see, last week is a perfect example. The jobs report just came out, it was the hottest jobs report we've seen in a long time. We had, close to double what the expectations were. And now we're down to a 50-year low in unemployment. We know wages are going higher. And we know it's been 80% of companies that beat. So we've seen the market really rally on a lot of unexpected good news, I would say, over the course of the last month and a half. The S&P has rebounded like 13%. I was on your show about a month ago, very, very bullish. Not to say I'm prophetic, but I think the right decision here has been, not to give up on your equities and sit in cash and be afraid.
Ryan, at the same time, though, we love a little bit of optimism, but, you've had some warning that the bear market rally could still present the presence of a bear that could end up ripping your face off, because it's true that the overall story about inflation weighing on this economy, which could tilt us in recession, is still very much the case. We'll see what happens when the CPI comes out tomorrow. But is there a sign, clearly in your view, that we've already reached a market bottom, or, hey, not so clear yet?
Again, I don't have a crystal ball. I wish I did. But if my best guess is here, you probably have seen the bottom, because if you start looking out, projecting to the future, and that's what markets do, invariably looking at what's going to happen over the next 12, 24 months, is inflation is starting to come down, right? We've seen commodity prices come down. We're talking about the chip now oversupply. We had an undersupply of chips, and now that's why all these semiconductor manufacturers are having an issue, is because demand is starting to dissipate. So there's just not as much stress on supply chains. That's going to be very, very deflationary. And I think the bond market's already telling you, right? We're already looking at the 10-year Treasury, somewhere around 2.7%. It was as high as 3.5%. So I think the reality of it is inflation's starting to come down. The job market's going to continue to stay hot. We have never seen a job market this hot. So wages are going to stay strong. And the Fed, they really have the ability here over the course of the next couple months to pivot, because we have another CPI reading next month. We're going to have another jobs report next month. So by the time September comes around, the question is, are they going to be a little less hawkish? And if I was a betting man, I'd say I think they are, because clearly the signs are that we are starting to cool off. And that's essentially what they intended to do, is to cool the economy off. And it's starting to happen.
Ryan, you said you're bullish right now, but I was saying this morning, I've never known you to be not bullish in the markets. I mean, you're generally a positive guy. You're pretty defensive because you are more value oriented. I mean, what would it take for you to kind of change your view? I mean, what are some of the risks or potential red flags that you're looking for that say, well, maybe this could change the direction a little?
Well, I think here's what's the dangerous component right now is if you look what's led the market, Akiko, over the course of the last month and a half, and I'm going to talk about this on my podcast this week, Pain Points of Wealth, maybe the greatest financial podcast in the country, but is tech has led the way here. And you're seeing a lot of money. I probably review over 50 portfolios a month. A lot of money is going back into tech, and tech is still overvalued. I think we're still going to be in a higher inflationary environment we were the last 10 years, and you're seeing this with the chip makers now. They're getting hit. They had a nice rally, and now they're getting hit again. So I think putting your money into tech and concentrating in tech is not a good decision. Don't ride the momentum here. You want to diversify. And this happened when the tech bubble burst. You saw the NASDAQ stocks go down something like 70% of NASDAQ stocks went down 50%, but then they had a huge bear market rally where they went up like 30%. Everyone piled back into that tech trade, and then tech went down 80% from there. So I think, we talked about the meme stocks today on your show and just all that speculation there. You're starting to see Bitcoin go up a little bit here again, too. The animal spirits are out. I would say here that's probably short-lived. And if inflation does stay stronger, now I think it's going to come down, but I think it's going to be a lot higher than it was. That's not the environment that tech stocks with valuations that are still relatively high are going to really, really shine. That's where those old school value stocks that I talk about a lot are going to do better, that have pricing power, and those profits are more in the immediate.
So I guess looking forward, right? I mean, because I imagine the interest rate environment plays into some of that thesis as well. If it is indeed the case that maybe higher interest rates will kind of put a little bit of a dent into these tech companies. We're already seeing them start to lay off. But what is the bigger economic story then beyond the Federal Reserve itself? Like, what econ data are you watching? I know that the jobs report last week was something that you were watching very closely.
Yeah, I think it's just where consumers are spending their money right now. And you're seeing that during this earnings season. I think there was a stat out today, just if online goods are down about 1% in price from where they were a year ago. So I think what I'm really looking at is where's the consumer behavior? We know consumers are continuing to spend no matter what those other economists and strategists told you. I'm always confident the American consumer is going to spend. We love to spend money here in the U.S. So I think that trend's going to continue. It's just where's money being spent in the economy. And if you look at it, it's going to be more hospitality, right? It's people are going out again. They're eating out again. They're traveling. And you're looking at where we have labor shortages. It's in those places like hotels, anything that's service or leisure. So I think it's really about where is the money flowing. And I also think it's about, again, that I think that employment data says everything. We've never had a recession while unemployment was coming down. And unemployment was always going up since the post-World War II era, where we've seen actually a real recession. I mean, we know we've had one technically, but I think the real reality of it is, things, again, are resilient. We're not really going into this huge, dire economic slowdown like you're hearing a lot of people on Wall Street say.
Ryan, quick question on energy. Obviously, we're coming off of another quarter where big oil companies have seen record profits. I know you've liked the space for some time, but there's questions about whether, in fact, we have reached the peak as we see some of the prices come down. What do you see?
I think energy is the new tech. If you look at profits this year in energy, they're going to be double what technology is. They have the highest dividend in the S&P 500. Multiples are still cheap. And I always say, peak energy demand or fossil fuel demand is not for another decade. We haven't built a new refinery in this country in 40 years. So we may get a pullback here short term. Oil prices have come down a little bit, but I think energy companies are poised to have a very long rise here. So I think that's going to be a core component to your portfolio, a tremendous inflation hedge. And again, I think inflation is going to come down, but it's still going to be heightened versus what we've experienced for the last decade. And that's critical here. It's just a different paradigm than we had the last 10 years. That's why tech's not the place to be anymore.
Yeah, Ryan, something tells me you're going to stay bullish based on what I see behind you. BeBullish.com. Ryan Payne, Payne Capital Management President and Pain Points of Wealth podcast host. Appreciate the time. Well, as the markets try to price in jobs and economic data, alongside a better than expected but still mixed earnings quarter, Notorious market bull Cathie Wood is out with a very bearish take, saying a recession may already be here. Let's bring in Alexander Semenova on the Cathie Beat today.
Well, guys, as we know, 2 consecutive quarters of declines in real GDP are the unofficial definition of a recession, but this is apparently the official marker for ARK Invest's Cathie Wood. The ARK founder and CEO said Monday in an interview with Bloomberg that the U.S. economy has already entered a recession and that we'll be coming out of it next year. She pointed to 2 consecutive quarters of negative GDP and 3 months of declines in leading indicators to suggest we're already in an official economic downturn. This is, of course, different from expectations on Wall Street and the majority of economists who believe we may enter a recession in 2023, pushing those expectations after the blowout July jobs report on Friday showed a payroll gain of more than 500,000 last month. Wood downplayed the excitement over this report and said that investors should instead focus on the more moderate rise of 179,000 jobs in household employment. She also pointed to a rise in weekly jobless claims and company layoff announcements. And while the yield curve inversion has some economists predicting we'll enter a recession next year, Wood also said that she believes this is yet another testament that the economy is already in one. ARK Invest also expects the Federal Reserve will, quote, usher in rate cuts next year. ARK Invest's family of actively managed ETFs have been hit particularly hard by this year's sell-off in tech stocks, which many have tied to rising interest rates. The flagship ARK Innovation has rebounded about 17% this past month, but remains down nearly 50% year to date. Guys.
So on the tech side of things, we have noticed some movement in some big names, NVIDIA seeing a fall, and apparently Cathie trying to take advantage of that by taking a stake.
Yeah, well, you know, even a recession isn't stopping Cathie Wood from staying the course on her investment strategy. Buying the dip yesterday on NVIDIA, Wood bought more than $60 million worth of the chip company across 3 of her funds Monday when the stock fell 6% following a revenue warning. The move is consistent with ARK's strategy to double down on existing holdings, particularly during periods of decline. We have seen her do this recently with Shopify, Roku, and Zoom. So we'll see how that turns out for her.
All right, let's see. Yahoo Finance's Alexander Semenova. Thanks so much.
Thanks,
well, you know, on the point of kind of what ARK has done so far this year, I think it's important just to kind of zoom out here and just take a look at what's been happening with overall ARK innovation funds fall, right? I mean, when you consider that this is an ETF that's down, 50% year to date. I mean, it's recession or not.
More than 60% from its 52-week high.
Right.
Right? I mean, that's worth pointing that out. I think you're right, Brian. I mean, we were just talking about this in the break. These are conviction plays, and Cathie Wood has made it always very clear that this is not about just sort of the short term. She sees the 10-year, 20-year plan. But, I mean, you have to wonder, I was just looking at her, her holdings right now. I mean, they haven't shifted that much, even in this environment. I guess that's what they call conviction plays.
Yeah, and I think that this frames a lot of what Alex was just talking about in terms of how she's viewing the economy in a recession, even though the debate is still out there about whether or not we are in one, given the jobs report that we saw last week showing a strong labor market. But when your kind of indicator and your lens of the world is from the innovation side of things, right? Even outside of the companies that are in the ARK Innovation ETF, tech broadly has had a very rough 2022. And the rebound so far in the last 6 to 8 weeks hasn't necessarily gotten better because we're still seeing announcements of companies laying off employees and getting smaller, right?
And also when you think about tech broadly, right, the ones that have been hit hardest are the ones that are not profitable. And these are the companies that are in growth mode, that are investing in this innovation that Cathie Wood's talked about. That is not an environment where, when we're not in an environment right now, investors are saying, yeah, put more money behind it. I mean, how much have we heard from so many of these tech companies who say profitability is now the focus? It's not about growth anymore. And yet her funds are really focused on those growth at all costs, pouring into innovation. I mean, if you believe in the tech, the underlying tech, sure, you could make the argument, even with the declines, that doesn't change your outlook because of the way the company is run.
And, another important thing to bring up here is we were just showing the max chart of the ARK Innovation ETF. I mean, it's a remarkable thing to look at because if you were to compare this against the S&P 500, a very different story. But look at this, a massive pop essentially between 2020 and then now. And the trend line is almost still the same if you draw it from the beginning of, let's say, 2016. But Kiko, what's the running theme for this period? From I believe it was 2014 that the ARK Innovation Fund was started. Zero interest rate policy, right? They haven't really gone through a cycle like this before. And I think you're starting to see what the wear and tear does on tech and high growth stocks in an environment like we're seeing right now.
Welcome back to Yahoo Finance Live, everyone. We're set to get a new read on inflation tomorrow, with Wall Street expecting the consumer price index numbers for July to show a slight drop from June. There you're looking at the expectations, and particularly here, this is following a better than expected jobs report Friday that could throw a wrench in recession talks yet again. For more on what this means for the markets and investors, let's bring in JP Morgan Private Bank Managing Director and Head of the Global Investment Opportunities Group, Monica DeCenzo. Monica, great to have you here with us this morning. Okay, so lay out the case for us as to why the jobs report numbers actually signal that we are not in a recession.
Well, I think we can all agree that technically we may be in a recession because you had negative GDP for 2 quarters. But when we think about a recession and what that means to most of us living in this economy, it's jobs. And it's job losses, it's layoffs, it's feeling that crunch on our balance sheet personally. And that just hasn't happened yet. Now, meanwhile, the market priced in that this was happening, and now we're in this push and pull a bit of, will this data start to roll over tomorrow and in subsequent months? And if so, then you could see the Fed pivot, and that likely means that this will be much less dire than people thought a month or 2 ago.
Well, how much damage would the Fed do, whether it moves 50 basis points or 75 basis points at the next meeting? It's still a significant rate hike. How much damage would moves in either direction bring to the markets and the economy?
I don't think a near-term hike matters all that much because people are expecting it. So I think if you were to see something meaningfully outside of expectations, that would have people starting to question this narrative that started to settle in the market that, yes, we saw negative GDP, but that the Fed may be able to balance this in the coming months. So I think 50 or 75, it probably doesn't matter either way.
And Monica, I want to pivot and talk about earnings for a second here, because as you point out, as many people have been pointing out, the earnings season was not as bad as feared, but warnings are piling up. We've been talking about another one this morning in the form of Micron, and it's only the latest chip maker to come out and warn. The retailers have been warning, right? We've had other companies in manufacturing that have been warning. So what does that tell you about the future path of earnings for the rest of the year?
You know, I think the challenge is we spend a lot of time talking about, is this a recession or not? I think we can all agree that things feel challenging, but that doesn't mean the market should go down another 20 or 30%. But there are clearly cracks that are happening because of what's happened from inflation and price pressure. And so that's what you're seeing in earnings. The tension now is, okay, we had a correction. We've bounced off lows. Is that enough to account for what you're hearing companies talk about now? And when you look forward at forward expectations, there's really very little incentive for anyone to be too bullish. I think companies, were quite honest, and the market said, okay, we can handle this. We've repriced for a lower growth environment.
Okay, and so for anybody who's still looking for an opportunity to put money to work right now, I mean, either you're kind of channeling the Cathie Woods energy right now and looking at NVIDIA and say, you know what, this might be a buy on the dip opportunity, the dippity dip opportunity. But where else would you be looking into some of those opportunities in the market?
Yeah, I mean, tech is always interesting because of the growth, right? So I appreciate that. Then I think you have to look at what else hasn't worked recently. We've seen a lot of money flow into defensive. So we're looking at some cyclical sectors and saying, hey, could financials or energy see a little bounce back? And I'm talking about a near-term bounce. Longer term, we still love fundamentals of defensive sectors like healthcare. And I think healthcare is kind of interesting this year. We're in an election year. And for once, we're not barraged by all these headlines about potential legislative changes and law changes that would weigh on that sector. So I think it's a great time on this rally to look at what you have, figure out, is this what I want to own the next few years? Perfect time to do some repositioning. And for me, pockets of tech, looking at some cyclicals, but making sure you have a balance with defensives like healthcare and probably even some fixed income because rates are higher.
Monica, any chatter on the trading desks about this return of the meme stock movement? What's driving it? How long could it last?
Yeah, I mean, it's August. Liquidity is light, and people are focused on a lot of things. So I can't say I've been having too many conversations about it, but certainly if you look at how tech has performed recently, you've seen a lot of short covering, and that's probably what's driving some of this. I think following the volatility we've seen, it would behoove people to look at fundamentals. Fundamentally, I struggle with some of these names to say why they should be up that much. So I'm going to focus more on stories that I can be comfortable with longer term rather than as a short-term trade for a day or a week.
A top tip indeed. Respect the fundamentals. JP Morgan Private Bank Managing Director and Head of the Global Investment Opportunities Group, Monica DeCenzo. Good to see you.
Thank you.
Welcome back to Yahoo Finance Live, everyone. Let's take a look
at how the markets are faring. Currently trading mixed at the moment. We see the Dow is the only one in positive territory right now. The S&P 500 and the Nasdaq still down about 0.2% there. Well, joining us now is Stephen Waiting, Citi Global Wealth Investments Chief Investment Strategist. So we saw in your notes, you're talking about seeing a recovery from a recession that hasn't actually happened yet. So break some of that down for us.
Well, that's what we shouldn't exactly be looking at this period as. We shouldn't be thinking of this as some new refreshed economic recovery. It is a period in which we've had a lot of employment and profit growth just behind us. We did have a sequential drop in real GDP. We had deceleration in the actual spending in the economy. But this is not the same thing as pervasive declines that have taken the economy down to a low level. This is not a period of depressed corporate profits ready for a great big rebound like we were in the second half of 2020. So we don't want investors to think that we should start taking a great amount of cyclical risk again. And that's sort of the point.
Stephen, good to see you. The word out of the Fed these days is data dependent. That is their new buzzword, and that's what Mary Daly from the San Francisco Fed told CBS over the weekend, asked about a 50-point hike, said she thought that was likely but wouldn't rule out a 75. And again, we need to be data dependent. We're far from done. What do you think would be required to change the calculus of the Fed from between a 50 and a 75-point hike in September?
Well, I would just say, first off, that data dependent is a lot better than being on autopilot. So yeah. It's nice to see that language change a little bit. Talking about how much work they have to do is still a little bit troubling because we see that the peak, well, sort of the optimal lag time between expected changes in monetary policy and the full cyclical effect on the economy is about 18 months. What's happening in new and existing home sales transactions right now doesn't have a lot of economic effect. They're declined 26%, which is no small number. But the effects on construction and employment and the consumer spending that goes into moving into a new or existing home, all of that is still to come on the economy. So just go back and look at what Chairman Powell said at his Jackson Hole event a year ago. The August 2021 speech that he gave, and it was very much focused on the potential of mistiming monetary tightening with its peak impact. And those are the sorts of things that I worry about right now. So we had strong employment data. In reality, I wouldn't worry so much to say that the July report was such a wonderful thing, but we've had gains all year long that are very, very substantial. And just as you're showing on this chart right here, we actually don't see any lead time at all. The labor market doesn't tell us when a recession will begin. In fact, when we reach our lowest levels of unemployment, that's actually when we mark recession timing. So I think, again, for the Federal Reserve, they should really be trying to look ahead. They shouldn't give up on forecasting. They shouldn't give up on trying to prevent a recession or a surge in inflation. The surge in inflation was very much about what they did last year, easing during a boom period. And they should see that, I guess, the seeds of a slower inflation period have already been planted and that we're going to have a deceleration, a probably strong deceleration in the economy in the coming year.
Stephen, what do you think the market is pricing in, just in terms of what we should expect in September? Are we looking at 25, 50, 75? What do you think the market is anticipating?
The market is priced a little bit closer for a 75 basis point rate hike rather than 50. If it was 50, it would be a little bit of a surprise at this point, and you'd have to wonder what data it was that might get them to go 50 rather than 75. I bear in mind, Wednesday's inflation report, the CPI, the headline reading looks like it's going to get a very big drag from the drop in the gasoline price. If some of those other core components that have still been giving us trouble, if they were to rise a little less, it might be helpful. But this is really not the kind of data that we really want to actually prefer to run monetary policy off of. I would take a look at what's happening to retail spending. And we entered the third quarter with negative momentum. We've had a rise in unemployment insurance claims, which doesn't happen when the economy is operating at its full potential. If we saw more of that, then it might be better to take it a little bit slower, or at least think again about a pause in terms of the tightening. But even that is hard for the Federal Reserve to do when they're tightening with two tools at once, when they're tightening with their balance sheet, which has only begun. Again, but they're talking about rapid pace of balance sheet reduction, $95 billion per month when we get to the peak.
And Stephen, quickly, in 20 seconds or so, you mentioned energy, gas has come down 60 cents in a month. What are you expecting Wednesday from that CPI print? The expectations are still at 8.7, and how do you think the markets react?
Look, I think we have potential for a little bit lighter CPI reading for the month of July. I think that the headline could be closer to 0. I think markets are all about, at this point, everybody got bared up on a recession. They might have some short covering. They might have a little bit of joy, but that's not going to stop a slowdown in the economy.
Welcome back to Yahoo Finance Live. The London Stock Exchange Group reported earnings from the first half of the year, noting a slight decline in listings. But CEO David Schwimmer is optimistic that a new wave of IPOs, initial public offerings, could be on the way. For more on that, let's bring in David, again, CEO of the London Stock Exchange Group. Great to have you on the program this morning, David. First of all, just kind of unpack what you've been seeing in capital markets. Obviously, public offerings and companies eager to tap the capital markets, a big part of your business. What did that look like over the first half of 2022, and what's your outlook for the remainder of the year?
So definitely a slower first half in terms of IPOs, given the market environment. Not particularly surprising given the volatility, given the war in Ukraine. But I must say, Brian, in terms of first the pipeline, that market will come back. The IPO market closes, it opens, that'll come back. And then in terms of our overall business, the London Stock Exchange, great part of our business, fantastic business, but less than 5% of our overall revenue. And we've seen great growth across all of our businesses with 7% top line growth and broad-based growth across our capital markets division where the London Stock Exchange itself exists. Our post-trade business, 9% plus 9% growth. And then in terms of our data and analytics division, 5% growth. So really across the board, pretty strong performance. I'm really pleased with that.
Yeah, as you mentioned, David, a lot of arms that you have over there at the London Stock Exchange Group. But I do want to just kind of focus still on the market side of things, just because you have such an interesting and unique vantage point from that front. I mean, when you say you do expect things to get a little bit better, I mean, we've already seen kind of a rebound so far this summer. But is there anything idiosyncratic to specifically Europe that you've seen as an interesting factor here when you consider you've seen the Bank of England's projections over a possible recession happening in that area, broad Eurozone projections showing similar slowdowns as well? How do you think that affects companies that, still want to do capital raising, but it's just such an uncertain environment right now?
Well, one of the things that is a bit different about Europe, particularly relative to the US, is the energy challenge. Europe is more exposed to what's going on in Russia and the gas dependency there. So we'll see how that plays out. I'm not in a position to predict, but that is a greater sensitivity relative to the US. In terms of some of the other aspects that we've seen in the overall environment, whether that's inflation, recession risk, some of the other challenges, those you're seeing inflation in Europe, you're seeing inflation in the US, you're seeing recession risk in all the different markets. But I would say the energy exposure, the gas exposure in Europe is a little bit of a different one.
So let's switch over to data analytics. That's been a very interesting part of your business when we just track the evolution with the acquisition of Refinitiv. I believe that was about a year and a half ago or so. So you've seen revenues up about 5%. How important is that data business to what you're doing here? What do you see as the synergies between, a pre-Refinitiv acquisition, London Stock Exchange Group, and a post-acquisition?
Well, it's been a transformational acquisition for us. If you go back prior to our closing of the Refinitiv transaction, the London Stock Exchange Group, LSEG, was an important provider of execution venues, mainly in equities and largely with a European focus. Geographically, we largely had a European focus. And in terms of our data and analytics capability, we had the FTSE Russell business and we had some very attractive fixed income analytics capabilities. Today, we are one of the world's leading providers of financial market infrastructure and data on a global basis across asset classes. So instead of being primarily focused on equities, we now have leading execution venues in equities, foreign exchange, and fixed income. again, on a global basis. We have 25,000 people around the world. We have a presence in 70 countries. And that presence is in the Americas. We have several thousand people in the Americas. We have 10,000 plus people in Asia. And then as a data and analytics provider, we're one of the world's leading providers of financial data and analytics. We're the world's #1 provider of real-time data, leading provider of background check information for banks doing KYC and AML through our World Check database. So it's been a transformational transaction for us, really positioned us globally as one of the world's leading providers of, as I said, financial market infrastructure and data across asset classes, across the trade life cycle.
All right, London Stock Exchange Group CEO David Schwimmer, thank you so much for joining us. Really appreciate it.
Let's get back in on the markets and talk inside them. Jeff Carbone, Cornerstone Wealth Managing Partner, and Jacqueline Remen, Morgan Stanley Private Wealth Management, Private Wealth Advisor and Senior Vice President. Good to see you both. Jacqueline, let's start with you. What do you make of the market's reaction to that job number? Initially looked like it was going to be overwhelmingly negative. The S&P largely shrugs it off, and the Dow finishes up.
Yeah, well.
Yeah, thanks.
Yeah. Okay, sorry.
Jackie, go ahead.
Thanks so much for having me. It's great to be here. Yeah, it looks like the market, is basically shrugging it off. It seems like it's ready for rising interest rates. And we're seeing that, not surprisingly, what's leading the market today are the areas that typically would do best in rising rates. So thinking about financials, energy, consumer staple. And what we're talking to clients about right now is that this is just one piece of economic data which confirms information about what's happened in arrears, and talking to clients about looking present forward in the market and what opportunity exists, both short term with rising interest rates and higher inflation, and longer term opportunities for growth.
Jeff, what do you think? What's your assessment of today's report and how the market responded?
Yeah, this seemed like a quiet week after last week with the GDP, the Fed, earnings, 250 companies. So this was like a vacation, but big numbers, today, double what was anticipated. In our view, I mean, if there was any recession talk, this had to put it to bed for at least a little while. We didn't see it happen. And technically, maybe the technical sign, but it has not been deemed a recession. But it did also show us the get back to the good news for the economy is bad news for the market, and we saw that a little bit, right? Good job number, the unemployment number dropped, but the market took it negatively, of course, because it looks like the Fed's going to have to continue a more aggressive hiking cycle, and 75 basis points is probably back on the table for September at this point.
We needed a vacation. It is, after all, August. Jacqueline, how does the Fed see this number today?
I think it's one data point that they're going to be considering. There's a lot of time between now and the end of September when they'll have their next meeting to decide about hiking. We have another set of CPI, actually two more sets of CPI and PPI numbers. One will be next week, which we'll definitely be looking at, and then another round of employment data. So just one piece, in the puzzle for them to consider. And as I mentioned before, we're talking to clients about taking that in the bigger perspective of looking present forward, what that means for how to position ourselves, which is that short-term reality that rates will likely continue to rise. So that puts you in sectors like staples, financials, energy, and then that longer-term opportunity.
What about you, Jeff? Where are you seeing the most opportunity right now?
Yeah, I think some of the same areas that Jacqueline mentioned, but I think we also look at, we know the economy is slowing. Inflation's remained higher, although we do think it's going to start to dissipate here or decelerate. It hasn't decelerated. We thought it would decelerate a little sooner, but it hasn't. I do think we're seeing signs, as Musk has said too, we're seeing signs that it may have peaked. So we're looking for areas that do well, both defensively and offensively. So healthcare, really like the healthcare sector, and there's some specific positions we like there. We also like high quality mega cap tech, seeing some opportunities. We've had a little bit of a run back in the last week and a half, 2 weeks now, but with the mega cap technology, and then also, as mentioned, some consumer staples. Certainly fits in, but I will say, from the defensive, we're starting to lighten up on some of the utilities that we did hold, and looking to place that in other places that give me a little bit better upside because we could see a little bit of a rally back into the year end. Although maybe being a little bit more range bound in the S&P, still see some opportunity ahead of us.
Jacqueline, I never pass up an opportunity to talk. Elon, are we past peak inflation?
That's what the indications are starting to show. Some of the numbers that have come in show that inflation's starting to come down. We'll see where that brings us next week when we actually get the CPI and the PPI prints. We're talking to clients just about positioning for that beginning to come down and opportunities more long-term, like in healthcare, as was mentioned, with the rising aging baby boomer population, that presents a really good opportunity. And then also opportunities within other companies that we're seeing earnings coming in pretty good and better than expected, which also brings opportunity for, say, mega cap tech.
Jeff, how much of an aggressive Fed is already priced into the market? Because after today's strong jobs report, the chatter has picked up that we'll most likely see a 75 basis point hike at the September meeting. If we do see that, I guess, how do you see the market responding?
Yeah. Well, I think if we see today, right, negative, not in the right direction that we want to see it. Again, the strength of the economy, yes, is slowing, but there's still some strong sectors. You have a consumer that is still in fairly good health. Continue to spend. Maybe I think we're changing. The habits are changing, right? We're not as goods based, more service based. We want experiences. I think we saw that with Live Nation. You're seeing that with Marriott and some other hotel travel positions or stocks or sectors. So I think the Fed is going to certainly be the markets will be a Fed driven market. And I think they're going to stay on a little bit more aggressive side right now. Last week, if you asked me, I would have said we may be 50 basis points September, and then we can almost give the Fed the ability to maybe take a pause. That may be off the table for now because we got such a strong number in the jobs numbers today, and we're not seeing any of this decline. So Fed needs to see the wage pressure ease up, needs to see the participation rate pick up. They need to see the unemployment data pick up. So we need to see unfortunately, some negative to back the Fed off, which would then kind of give the markets a little bit more running power.
All right, Jeff Carbone, Jacqueline Remen, thanks so much for joining us this afternoon.
Welcome to Yahoo Finance Presents. I'm Jennifer Schonberger. 5 former Treasury secretaries endorsing the slimmed-down version of the Build Back Better bill, now being dubbed the Inflation Reduction Act. Former Treasury Secretaries Geithner, Liu, Paulson, Rubin, and Summers all saying in a statement, quote, taxes due or paid will not increase for any family making less than $400,000 a year. And the extra taxes levied on corporations do not reflect increases in the corporate tax rate, but rather the reclaiming of revenue lost to tax avoidance and provisions benefiting the most affluent. Former Treasury Secretary Larry Summers joins me now to discuss this. Mr. Secretary, welcome to the program. Thanks so much for being here. So the Inflation Reduction Act would impose a 15% minimum corporate tax rate on companies earning $1 billion or more in revenues. And you say, along with a handful of former Treasury secretaries, both Democratic and Republican, in a statement today, that the extra taxes levied on corporations do not reflect increases in the corporate tax rate, but rather the reclaiming of revenue lost to tax avoidance and provisions benefiting the most affluent. My question is, though, how do you see this impacting job creation and business investment at a time when the economy is slowing?
I don't think the effects are likely to be harmful. I think that the total effects of this bill could very likely be positive. The stimulus to renewable investment in particular that's given by the tax credit provisions is likely to do far more to stimulate investment than closing various loopholes, which in some cases probably encourage financial manipulation rather than real productive investments. I don't think there's any reason at all to think that asking corporations that report themselves as profitable every year to pay something in taxes at a minimum rate of 15% is likely to be harmful. And in fact, by expanding the taxation of their global income relative to their domestic income, I actually think this could encourage jobs to be brought home.
Republicans have argued that the bill would break President Biden's pledge to not raise taxes on those earning $400,000 or less, based on the Joint Committee on Taxation's analysis that higher taxes paid by corporations would indirectly raise the effective tax burden on those with incomes of $200,000 or less. Your rebuttal to that?
I don't think that's a credible argument. What the taxes are placed on corporations, they're placed only on profitable corporations. Disproportionately, they're going to fall on corporations who are making investments abroad. That's going to work out on balance favorably for the whole economy. There's no sense in which this is a tax placed on any family with income below $400,000.
Sir, this bill is titled the Inflation Reduction Act. And while it does lower the deficit, some analysis out this week from Wharton finds virtually no impact on inflation, noting the estimates are, quote, statistically indistinguishable from zero. Your reaction to that, and what is your argument for this bill decreasing inflation? Do you see that happening?
So the Wharton analysis takes no account of lower prescription drug prices. The Wharton analysis takes no account of increased energy supply. The Wharton analysis is extremely conservative in its assumptions about extra government revenue from better tax enforcement. And still, the Wharton analysis acknowledges that this legislation is doing great things for the environment, great things for health access, great things for fairness, without contributing to inflation. If Wharton, which focuses on the fiscal policy analysis, but doesn't focus on the sectoral analysis, had recognized the impact on pharmaceuticals, for example, then it would have reached the same conclusion that bipartisan Treasury secretaries reached, that this is reducing inflation.
Mr. Secretary, you said that you think that the impact of this bill will be additive, will help investment, it will help the economy. I'm curious, your outlook for inflation from here. The Federal Reserve has raised interest rates by 75 basis points for the past two meetings. We're still seeing high readings on CPI, on the Fed's preferred inflation gauge of PCE. Granted, there's a bit of a lag indicator there. We have seen commodity prices coming down. What is your outlook for inflation from here, and how does this bill tie in with that?
Jennifer, I think we've got real inflation problems in the country. I don't think they're going to go away quickly. I think they're a consequence of the overheating of the economy that took place last year, along with adverse supply shocks. And that's just something we're going to have to work through and live with. I think we will do so in a better way if this bill passes. But this bill is certainly not sufficient to contain our inflation problem. And even with this bill, we're going to have inflation problems for quite some time to come. The important thing, though, is that this is doing a whole set of necessary things for our country while beginning the process of reducing inflation pressure.
You just said you think inflation is going to be with us for a long time to come. And as just noted, the Fed has been pretty aggressive. Do you think they should sustain that aggressive stance? Fed Chair Powell said at his press conference that there's a prospect of perhaps tailoring the size of those rate hikes, or minimizing, I should say, the size of those rate hikes from 75 maybe to 50 basis points in there, 25 basis points. Do you think the Fed needs to be more aggressive as we go through the latter half of this year?
We'll have to see how the data unfold, and I'm not prepared to make a prescription for the September Fed meeting at this point. I do think there's an important lesson that we all learn at some point in our lives, which is when the doctor prescribes a set of antibiotics, you have to take the whole course through, and you're making a mistake and you're compromising your potential health if you stop taking the antibiotics the moment you feel better. And I think there's some similar principle here with respect to the central bank, that if inflation comes down a bit, if the economy looks like it's slowing, it will be tempting to stop raising interest rates. And indeed, people in the market are expecting that interest rates will come down beginning in December or January. And I think that would be a serious error.
Interesting. Okay. Before we get to your outlook on the economy, I do want to ask you, while the Fed is in the driver's seat for trying to reduce inflation, what other actions do you think the administration could take at this point? For instance, should the president dial back former President Trump's tariffs on Chinese imports? Are there other actions the administration could take to help ease inflation, perhaps when it comes to commodity prices, creating incentives for farmers, opening up more land, or perhaps that's just an issue that has to do with the weather? Your take?
I think we should be reducing tariffs, not just on Chinese goods, but on goods all over. I think the consumer interest is really important. I think we need to think more about affordability economics than we tend to do. We need to put consumers first many times. I think there are things we can do in this bill and outside of this bill that would reduce energy regulation and make possible more production and even more distribution of energy, which would contribute to lower gasoline prices and lower energy prices. I think in general, if we can have more rapid permitting and less NIMBY problems, less not in my backyard regulation, I think we could get more housing built, and that would contribute to more affordable housing. So in general, I think we need to think about affordability, whether the issue is higher education, whether the issue is healthcare, and that could make a contribution to reducing inflation. Though I think the overwhelmingly most important determinant of inflation is going to be the cyclical performance of the economy and what monetary policies we pursue.
You said just a bit ago that it would be a serious mistake for the Fed to sort of do a U-turn after hiking rates next year as the market is pricing in. Given that, I'm curious, do you think that a soft landing can be engineered here? We just saw 2 consecutive quarters of negative GDP growth, what some would call a common definition for a recession. Of course, the official arbiter looks at much more than that. And Secretary Yellen has argued we'd need to see massive layoffs to actually be in a recession right now. Do you think a soft landing is in the cards? Or do you think that a recession is near, or that we are in one, given what we've seen with the GDP numbers?
I don't think we're in a recession. I think it's unlikely that it will be judged that in July of 2022, the American economy was in recession. I think given the difficulties associated with high inflation and bringing it down, the necessary monetary policy response, the odds that the economy will go into recession within the next 18 months are quite serious and probably in the 3/4 range. And I think that if the economy gets into a situation where unemployment rises, unemployment is likely to rise quite substantially. And so I would expect sometime within the next 2 or 3 years that the unemployment rate would cross 6%.
And then would that be the medicine that's really needed to get inflation back under control? Is recession needed, essentially?
I think we're unlikely, as I've said many, many times, I think we are unlikely to restore inflation to target levels in scenarios that don't involve a recession at some point.
Mr. Secretary, thank you so much for your insight. I so appreciate it. Hope to speak with you again soon.
Thank you.
But we'll get more analysis now and from John Hancock Investment Management Co-Chief Investment Strategist Emily Rowland. She is joining us alongside RSM Chief Economist Joe Brusuelas here with us in the studio. Joe, I want to start with you. Whoa. I mean, I don't know what else to say. This is a really surprising number.
Economies in recession do not generate 525,000 jobs on any given month and don't have 3.5% unemployment rates. Now, it doesn't mean that we might not fall into recession. We have a 45% probability of that over the next 12 months, and I think the most likely time is at the turn of the year. However, it's not happening right now, and I think Brian Hinton really nailed the mark there. Federal Reserve is now going to have to follow through. They're going to have to come by with another 50 basis point hike in September, and they're going to likely have to continue hiking that policy rate well into restrictive terrain. Now, we think it's going to get to at least 3.25 to 3.5%. Probably we're talking 4%. Look, this is going to take a while to cool down here. This is where we're at. And I think we all ought to put that recession talk to the side and start addressing the issue, which is the Fed's going to have to remain vigilant, bring down the job gains per month, and this economy is going to have to cool off until we're really out of the woods. And this is going to be a while.
Emily, what happened here? Because you're seeing, I think, a stunned market, at least here in the pre-market, seeing tech stocks under pressure. They don't like this report because it probably means a faster pace of rate increases, not good for tech stocks. But what do you think went wrong here?
Yeah, this is not the kind of jobs report that the Fed wants to see right now. The economy continues to run hot. Unfortunately, one way to get wage growth to cool, which is exactly what the Fed wants, is for the participation rate to go up, meaning there's more supply of workers. And we actually saw the opposite this morning with the participation rate falling a bit at the margin here. Wage growth pressures remaining elevated. Pretty much everything with this report went wrong for the Fed, even though it is good news for the economy. We've talked a lot this morning about good news is bad news, and we're seeing that priced into the markets. I'm watching the Treasury yield curve right now. The entire curve is moving up, but the 2-year Treasury, which is more reflective of Fed policy, is just absolutely skyrocketing. We went from 305 before the report to 317 as of right now. So the yield curve was inverted, and now it's really inverted. And we know that that is a classic harbinger of a recession. As Joe mentioned, not there yet. We think that there's more things that need to happen before the recession fully plays out, but likely going there with the yield curve this deeply inverted.
Emily, I gotta call you guys out a little bit. I know that you've been big on bonds and chill, buying bonds and chill. This hurts a little bit, I guess. Then.
Oh, Julie, that hurt so much.
Sorry,
you just said that, but no, it's okay. You know, these things don't happen in a straight line. You know, and certainly there's an element here where we're seeing bond yields rise based on the potential for more aggressive Fed policy. But remember, the Fed is hiking rates into a slowing economy. There is no doubt about it. You also know we use things like the Conference Board's leading economic indicators, which are at 1.4% and falling precipitously right now. We're seeing things like the ISM index of new orders, which is our favorite sort of leading indicator, which is now at 48, well below 50, indicating contractionary territory. So something's not right here, right? Remember that, one of these things is not like the others. There's a bunch of dislocations happening across markets right now. We think Treasury yields ultimately do reprice for an increased likelihood of recession, but it may take some time.
Joe, maybe this is a simple question, but it has to be asked, what is the state of the economy? There's so many mixed reads. We're seeing massive warnings from retailers. We're seeing what looks to be a hot jobs report. We're seeing layoff announcements from big companies. This is a confusing time for investors, confusing time for the economy.
Well, this is why you want to reestablish price stability, because it's impossible to set prices when you have inflation running rampant like it is, and you get these cross purposes where the Fed's raising rates into an economy that's actually slowing. If you take a look at sort of real final private demand, it's increasing right around 0.5% per annum. That's not what you want. You want a much more stronger rate near 2%, but we're just not there. So you're stuck in the netherworld between no growth and growth that's, along the long-term trend. And really, if you want to get into it, you probably want to call it a growth recession. Now, here's the thing about the inflation. We have a bifurcated economy, right? Economic inequality's been with us for a long time. It's down market households that are feeling it. That's why you're seeing the problems at Walmart, but not at Amazon, right? And it's going to depend on which segment you're in, whether you're looking at a company or an industry or even the overall economy. I know those upper two quintile of income earners that are responsible for 60% of spending. I mean, think about that. 40% of households are responsible for a little over 60% of spending. They're doing well. That's why you see the hiring.
Household recession.
Yeah.
High income, they're okay.
Completely right now. That's exactly what you're seeing.
And of course, Emily, there are implications for the market from that as well, both in terms, because those upper income households are also tend to be the households that are invested in the market, whether they're through 401ks or directly. So how are you thinking about that bifurcation and the implications of it?
Well, there's a broad trend in place right now where we're seeing big shifts in consumer behavior, where consumers are eschewing the things that they want in favor of the things that they need. They might not be buying that big ticket item, but they're still going to turn the lights on and take a shower. So we're thinking about positioning portfolios more towards those not only higher quality parts of the market, companies that don't need to tap the capital markets in order to remain profitable, companies with great balance sheets and good return on equity, but we're pairing that with more defensive sectors as well. Things like utilities, infrastructure, like investments, which can see that dependable income coming through as we want to position away from areas that are more economically sensitive given the slowing economic backdrop.
So, Joe, does this report put a 100 basis point increase in Fed funds back on the table?
No, I'm not going to get in that game. They're going to go 50 basis points. You know why? Because they prepared the market, and they should. Now, after that, maybe instead of slowing to 25, we get another 50 basis point hike. So the supersized, the really large ones.
So no supersized, so a series of 50.
But they prepared the market, but there's a lot of time before the next meeting.
Oh, yeah, there is.
They have time to re-prepare the market, no?
No, they do. Never let it get in the way of a good story, right? I mean, we're all here and we have time to fill. No, look.
Such a cynic, Joe. Come on.
The policy rate is going to move deep into restrictive terrain, and I think that's the main takeaway here for the investment community, for forward-looking policymakers, and most important, those CEOs and CFOs out in the real economy that are just trying to figure out where to set prices given where inflation is and how many people to hire and what to pay them. I mean, at the end of the day, that's what this is really about, right? We have more people getting hired. We didn't talk about wages yet, by the way. Did you see that? Yeah. 3-month average annually pace of average hourly earnings is sitting at 5%. That's right in line with, employment cost index. Okay, that's probably higher than where we want it, but it's not a wage price spiral either. So there's a lot more here to be looked at.
Emily, do you go or touch tech stocks after a report like this? We saw a bid down lower on the NASDAQ, but this report doesn't exactly set a fertile environment for some of these names.
Yeah, I would just add, by the way, before I answer that one, I've been refreshing my screen on Fed funds probabilities, and we did just go to the market pricing in 75. There's a 65% chance now of 75 basis points in September. The probability before the report, of course, was for 50 in September. But so growth stocks, growth stocks are not, and technology stocks are not as tied to rates as a lot of investors think. We've looked at the data and the relationship's not actually that strong. We have seen it in recent times be correlated. But what happens in an economic growth slowdown is you want to own companies that have more durable profitability, have more earnings stability, have more cash on their balance sheets to deploy. And you're actually going to find that in technology companies. Now, listen, they're not all created equal. So I don't know that I would just buy a tech index. I would think about screening for those more profitable companies and really kind of emphasizing that as a way to play a late cycle environment, which we're firmly planted in now.
Yeah, at the very least. All right, thanks so much.
For more on the markets, let's bring in Brent Schutte, Northwestern Mutual Wealth Management Company Chief Investment Officer. Good to see you, sir. I want to start where Brian left off there with that precipitous drop there in WTI. What do you make of it? Is it really factoring in and showing those recessionary fears?
I think so, but in general, Americans have driven less this summer than they have in past. And so gasoline demand has been lower, which has caused those prices to come down. And that's the real reason behind it. And so I don't know if that's economic recessions or just people changing their lives and not going out as much as they used to, because a lot of us are still working at home. And so in general, I think that's behind it, and it's going to have a good impact on inflation moving forward.
Hey, Brent, Brian Chung here. So on the point of just kind of the broad market action that we've seen lately, we do know that the big story is the Federal Reserve. So when you take a look at commodities prices, does anything that you're seeing with the decline in gas prices actually tell you that, hey, all the volatility we've gotten in 2022 so far might be the worst and already behind us, given how energy prices could be helpful to the inflation story?
I think so. I think the market is sniffing out that forward indicators of inflation, like oil, like commodities, like container ships, like other things that are happening, are showing that inflation is going to moderate. And that means the Federal Reserve is likely to follow through with what they've said they're going to do, but they probably won't have to do much more than that. And that's been the big fear. The big fear has been that the economy would slow, but inflation wouldn't go with it. And what you're seeing is, yes, the economy is slowing. We may have a mild recession, but inflation has been highly sensitive to that, and it's going to be coming down, which will alleviate some of those fears and possibly lead to a market that grinds higher as we push into 2023.
Just to clarify, are we talking about another 75-point hike, or are you in the 50 range? And when do you think we will see a positive print on inflation? Will we see it next month, given the fall of gas prices?
Yeah, I mean, the expectations on Wall Street for the CPI print next week is 0.2% month over month, which would be a positive surprise, lower from what we've been in the past. And so I think you're going to see more of those in the future. And as I mentioned, all those indicators are showing that inflation is set to come down. I think the Fed does 75 basis points. Keep in mind, this is supposedly a Fed that doesn't offer forward guidance, but I still hear them on TV every day talking about what they're going to do. Look, the Fed wants to maintain their inflation fighting credibility, I should say. They want to talk tough. They have to talk tough, because the reason they had to go harder was because the market was starting to think inflation was more permanent. They wanted to tamp down inflation expectations, and they've done a good job of that. And so I think we get 75 this time, possibly 25 one more time. And then I do think you might be done if the data continues to be in the same direction that it is today.
Well, Brent, on your point about Fed speak, I was actually speaking with the Cleveland Fed President Loretta Mester on the phone earlier this afternoon, asking her just kind of about where you could see the Fed stopping. Her suggestion that they could go past 4%. Having said all of that, we've heard what the Fed speakers have said. There's going to be more interest rate hikes. Why haven't you seen financial conditions tighten more? Why is the 10-year yield falling? Why is the 30-year mortgage rate falling? Isn't that counterintuitive to what the Fed wants to do here in dampening demand?
Yeah, I mean, demand has already dampened. We've had 2 negative quarters of GDP. You've seen the housing market off 24%. I mean, the Fed rate hikes have already had a dramatic impact that is just beginning to filter through the economy. And so the housing market is off 24% from its highs. You are going to see prices decline there, or at least moderate, which will have a dampening effect on inflation. Keep in mind that the market probably doesn't agree with Loretta Mester. We'll see. The Fed is data dependent. They're month to month, even though they are offering forward guidance. They want to talk tough right now because they want to keep inflation fighting credibility there. But they have shown that they can pivot fairly quickly. As a reminder, a few months ago, they went from saying they were going to do 50 to 75 within, right before the meeting. And so I do think there are certainly doubts out there. There's certainly risk out there. But a lot of the things that we've talked about why inflation should slow in the future are starting to show they're going to slow. And we'll get a key input tomorrow with the jobs report. What happens to wages?
Yeah, that will be a key report. We're looking right now at Treasury yields. What is the 10-year telling you is coming?
I think it's telling you that there is a recession likely coming. I think the market is telling you on the equity side that it's likely to be mild. And that's where I think the market is okay. I mean, you've seen economic growth slow over the past few weeks. At the same time, the market has rallied. And this is because inflation has been coming with it. And this is because the market believes the dire circumstance would be that we slip into a recession, but because inflation hasn't fallen, the Fed has to keep going. I think you're starting to see that become priced out of the market, which is why the market is actually rising. The 10-year is telling you likely there is going to be a recession. The curve is certainly inverted. That's telling you a recession. But I think the market believes, much like I do, that any recession would be mild just given the overall state of the U.S. consumer, which even despite the recent price hikes and oil price increases is still in pretty decent shape in aggregate.
Brent, what's the move right now? Because you've seen some people already call a bottom. Maybe you want to get in while you still can. Is it small caps that you're looking at right now? I mean, Russell 2000 is still underperforming the broad S&P.
Yeah, and so when I say small caps, we look at the S&P 600, which is a higher quality index, which actually I believe is the part of the market in the U.S. that's up the most this year, or down the least, I should say. Not up the most. That's wishful thinking. But that's the area that we like. I mean, it trades at 13 times 2022 earnings. Certainly some of those earnings could be at risk, but this quarter they were very strong and the expectations did not come down much. That gives you a margin of safety against falling earnings expectations. Now, if the recession is deeper than what I think, the area could be a bit of in harm. But keep in mind, I mentioned a margin of safety. It typically trades somewhere 18 plus times earnings, at least for the past 25 years. And so there is room against a downturn. And if the recession is mild, this is an economically sensitive area that will do well on the opposite side also. And so that's the area that we've been focused on in our portfolios.
All right, Brent Schutte over at Northwestern, thanks so much for taking the time to stop by this afternoon. Appreciate it.
Well, Wall Street's gloom might be here to stay as markets deal with what our next guest calls inflation shock, but that pessimism may not mean big trouble for the broader economy. Let's talk about all of this, parse it out. Alessio DeLonghi is Invesco Investment Solutions Senior Portfolio Manager. Alessio, what a pleasure to see you. It's been a while. So welcome. Let's talk about this idea that we are indeed seeing issues in the broader economy. You say in your note to us that we've moved to what is now a contraction regime. What does that mean, and how are you sort of applying that framework to how you're thinking about investing right now?
Always good to be with you guys. A contraction regime is a regime where the economy is expected to grow below its long-term trend and to continue to decelerate, so to remain weak while growing below trend. And that is exactly what the Federal Reserve and the global central banks are trying to do. We saw Chair Powell specifically say, in order to bring inflation down, it will be necessary to have the economy grow below its long-term trend for some time and to increase slack in the economy. Increase slack in the economy simply means we need to see the unemployment rate rise. Now, that's the way to adjust. There's no other way to adjust inflation down from the demand side, which is what the Fed controls. Now, what is difficult about that environment? What is difficult is that it's a very tight rope. It's very difficult for the Federal Reserve to strike the balance between growing below trend but avoiding a recession. And that is an environment that becomes particularly tricky for risky assets, for financial assets in general, and market volatility.
Alessio, all of this sounds like a train wreck between what the Fed is doing here in the U.S. Now we had the Bank of England out this morning, 50 basis point rate hike of its own, potentially pushing the U.K. Economy into a deep recession by the fourth quarter of this year. So you're getting all of these coordinated rate hikes around the globe. Isn't this a perfect environment to start raising cash?
Well, there is no other way, right? You are highlighting correctly what the relationship is between raising interest rates and hurting the economy. The issue is that central banks don't have that option. Central banks today have one job alone, which is to bring down inflation, and they need to reduce growth. They need to reduce demand in order to accomplish that. So it's not a great environment for financial assets, which have been holding up quite well. Why do I say that? Because despite the double-digit underperformance in risky assets this year, they have basically matched or even outperformed government bonds. So in that sense, in my opinion, global financial markets have not really priced a recession yet. What they have repriced is the higher dividend discount yields, is the higher discount rates that are applied to future cash flows.
Well, then, Alessio, if the market hasn't priced in, how overvalued is the market here?
Valuations are a lot more attractive today than they were a while ago. So that is comforting. I think in the classic recessionary environment, even of a relatively mild recession, what you tend to see is a gap between global equities and global fixed income by about 15 to 20%. So you could see an additional correction in equity prices by about 10, 15% in a recessionary environment, coupled with the long end of the curve, long global bond yields, global bonds to deliver a positive 5 to 10% return, right? So the order of magnitude does not need to be a shock and awe type of situation. Not every recession has to translate into a panic and a financial crisis.
Alessio, I want to ask you about what's going on in Europe as well. Today, we heard the Bank of England was raising interest rates. The ECB is expected to continue to do so as well. You could argue the economic situation there is more alarming, perhaps, than here in the United States. So would you apply some of what you're talking about there, or do you have to think about that differently?
No, certainly. Next to the global picture, which you highlighted, which affects everyone, Europe is additionally hurt by the energy shock due to the Ukraine-Russia conflict. The energy shock hurts Europe much more, and its current account surplus has basically evaporated. The inflation shock and the impact on demand is going to be, and it is already larger in Europe.
In this episode of Influencers, Allianz Chief Economic Advisor, Mohamed El-Erian.
So it is bad analysis, bad forecast, too little, too late, and miscommunication. And that's how we've ended up in this mess. We need to get back to a world where the Federal Reserve is credible, because that is absolutely essential to the well-being of our society. We simply are not in a recession. Is the risk of recession high? Yes, it is high and getting higher.
Hello, everyone, and welcome to Influencers. I'm Andy Serwer, and welcome to our guest, Mohamed El-Erian, president of Queen's College at the University of Cambridge and Chief Economic Advisor at Allianz. Mohamed, great to see you. Thanks for joining us.
Thank you, Andy. Thank you for having me on your show.
So you said at one point recently, I think, that you thought inflation had peaked. How did you arrive at that conclusion? Can you elaborate?
Yes, the old-fashioned way. So I look at the components of headline inflation, and in particular, what's been driving it higher in recent times. And what we have right now is energy and food in particular are going to be much weaker drivers of inflation. So the headline number is going to come down, but worrisomely, the core number is going to stay stubbornly high. And that just speaks to an inflation process that has become more entrenched and has become more broad-based in our economy.
Right, transitory, entrenched, broad-based. So what is your prognosis when it comes to inflation in terms of sustainability and severity?
It will come down by the end of the year. It will be sticky. I'm looking for a core CPI in the 4.5% to 5.5% range, so well above the 2% target of the Fed. But what I'm most worried about, Andy, is the collateral damage that's going to be associated with inflation coming down because the Fed has been so late in responding.
Yeah, I mean, you've been critical of the Fed in a high-profile way, and so what do you think of their moves to raise rates and combat inflation? I mean, how did they get it wrong? Why did they get it wrong? How wrong has it been?
So they started getting it wrong 15 months ago when they absolutely embraced the notion of transitory when it was an open question. Had they listened to companies, they would have been much more humble in saying we don't quite understand the inflation dynamics, because companies themselves were warning that the supply disruptions they were seeing, and we know the list, supply chains, containers, ships, what companies were seeing, what they were warning, saying, we're not sure they're going to resolve themselves quickly. And yet the Fed got hooked on this notion it's transitory. And then it got itself into a cognitive trap. It kept on repeating it and repeating it and repeating it all the way, as you know, till the very last day of November, by which time it was clear that inflation was a problem. And then we tied it, but didn't move. It could have done more at that stage. And you ended up with this absurd situation that in March, it was still pumping in liquidity. It was still doing QE in March when the inflation rate measuring for February with a month lag was already at a 7% handle. So it is bad analysis, bad forecast, too little, too late, and miscommunication. And that's how we've ended up in this mess.
A cognitive trap sounds like something we all should be avoiding, Mohamed. So the causes of inflation, obviously COVID leading to supply chain issues. Then we have Russia. Those may be transitory, or we certainly hope they are. What about globalization and nationalization, deglobalization? Is that a bigger factor and a more worrisome one, even perhaps?
So what you point to is really important. So we have two big dynamics going on. One is on the demand supply. We've gone from a world of deficient aggregate demand to a world of deficient aggregate supply. And you spoke about the elements of that. That's going to resolve itself. But we have another phenomenon going on, which is the nature of globalization is changing. And we are going from a very intense focus on efficiency, on just in time, to another focus on resilience, just in case. And that transition is by its nature inflationary. And that hasn't played out fully yet. That's why it was really important and it remains really important to ensure that the inflation dynamics don't develop very deep roots across many, many segments of our economy. Otherwise, we may end up with a low growth, high inflation environment for much longer than we need to.
Could it ultimately be a good thing, Mohammed, that we are reshoring a lot of our supply chain in the United States, and wouldn't technology then mitigate costs over a period of time, and that would perhaps offset inflationary pressures and create jobs in the United States, maybe a win-win?
So I think that's the most likely long-term journey. The problem that we face is that it's the most long-term destination. The problem we face is that the journey to that destination is so tricky that we may end up at another destination. So yes, it is a good thing if we get there, but you don't get there without a lot more policy focus, a lot more private-public partnership, and a lot more communication than we've had so far.
What do you think about central banks generally, Mohammed? I mean, there's some people who are critical of the Fed, and it's like you talk to them for 5 minutes, and it turns out they're these people who hate all central bankers. I don't think you're quite in that camp, but is there a cult of central banking?
So first of all, I'm not at all in that camp. I think central banks play a very important role. The reason why I'm so critical is because central banks have an enormous responsibility and they're given enormous power. Where else do you have an institution that is so powerful and can make decisions on its own, has political autonomy? And that is an incredible thing to have. And that comes with a lot of responsibility. So you have to be held accountable to your actions. And I think central banks are absolutely key, and politically independent central banks are essential for economic well-being. So I am not in the camp of central banks are something we shouldn't have and anything else. No, we absolutely need them, but we need them to function well. And we need them to be honest. When they make a mistake, tell us why you've made a mistake and tell us what you've done in order not to repeat the mistake. You know, it dismays me, Andy, that when the Fed publishes its quarterly projections, people call it laughable. And who calls it laughable? Former Fed officials. They also complain. And we need to get back to a world where the Federal Reserve is credible, because that is absolutely essential to the well-being of our society.
I also want to ask you about GDP and using it as a measuring tool, as a be-all to end-all to measure nations' economies, and even actually to measure their societies. I mean, there's been some talk lately about how that's not maybe the best way to measure an economy. What do you think about GDP?
So it is a shortcut, but it's not comprehensive enough. The problem is that, talk about cognitive trap, we've all gotten used to measuring things by GDP, and we're having a huge problem getting out of that. Also, the nature of your GDP growth is important. Is it inclusive? Is it non-inclusive? That's really important. So look, it is a useful measure, but it is just a tiny perspective into an economy.
We've been talking a lot about inflation, but what about the R word, recession? Do you think we're headed for a recession? If so, how severe will it be? What do you see in those tea leaves, Mohammed?
So my definition of a recession is a holistic definition. It goes well beyond 2 quarters of negative GDP. We are not yet in a recession. We're not. The labor market is too strong. Consumer spending is too strong. Business balance sheets are too strong. We simply are not in a recession. Is the risk of recession high? Yes, it is high and getting higher. Why? One, the Fed is hiking into a slowing economy. Two, as the IMF forecast showed us recently, all the major areas of the global economy are slowing. They called it gloomy and uncertain. These are strong words coming from the IMF. I was there for 15 years. I know you don't use the word gloomy lightly. So we do have a high risk of recession. It's not preordained. There are and should be various measures to be taken in 4 areas in particular to stop us from slipping into recession. But let's monitor it. The risk is certainly high, Andy.
What are those 4 areas?
So first and foremost, we got to get control of the inflation beast. And that is a Fed that needs to act in not only tightening its monetary policy, but also regaining credibility. Its forward guidance right now is almost meaningless. And that's not a good thing. It's a major tool of monetary policy. So the Fed has a lot to do on the inflation front. Second, we need to target fiscal policy more to protect the most vulnerable segments of our society. That has massive economic, social, and political consequences. Third, there's a whole host of pro-growth, pro-productivity reforms that need to be done, including to increase labor force participation, to improve what you talked about, the supply chains. They have a domestic angle and they have an international angle. And then finally, let's not forget financial stability. Let's not forget how risk has not only morphed and migrated from banks to non-banks, but non-banks have been encouraged by years of zero interest rates and massive and predictable liquidity injections to go well beyond their native habitat in taking risk. So the non-banking sector is still offside, and we have to keep an eye on the financial stability risk because that could come back and harm the economy.
I want to drill down on number 3 because we focus so much, or we tend to, both people in my business and people in your business, on monetary policy. But are there fiscal policy tools coming from, say, the White House that can be utilized to combat inflation and to fight recessions? And what are they?
Yes, absolutely. They don't have an immediate effect, but they are important. They basically come down to facilitating the supply side. Do you remember I mentioned that we've gone from a world of deficient aggregate demand to deficient aggregate supply? And we see it everywhere. You need only go out and you'll see what labor shortages look like. You'll see what supply chain disruptions look like. On the labor side, it is critical that we take steps to enhance labor force participation. That comes down to basic issues like childcare. That's really important. Female labor force participation hasn't recovered to the levels where it should be. We can do more on supply chains. There is a massive set of opportunities for public-private partnerships. We should learn from the good things that happened during the pandemic in terms of how private-public partnerships can work really well. And then finally, let's not forget that that's an international problem. It's not just a national. So collective action becomes really important. I think that these areas, unfortunately, are underemphasized by your profession and by mine, because we tend to focus on the urgent and immediate, which is inflation, and then the recession risk that comes from having let inflation out of the bottle.
Yeah, I've been focused on this point, Mohammed, of too much looking at these shortcut things, which are GDP, cutting interest rates. It's just, but they're deeper problems and deeper solutions, perhaps. Interesting stuff there. In a recent piece, you outlined 3 upsides of the current economic conundrum that we're in. It's fascinating. What are they? And are those silver linings or what?
So there were ups of the market situation. If you were an investor and you looked at what happened in the first half of the year, what happened to your retirement, what happened to your investments, it's a pretty depressing picture. Not only have you lost a significant amount of money on your equities, but your bonds that are supposed to be your risk mitigators, they also got hit really hard. So you've had massive problems of returns, significantly negative. Your correlations, your risk mitigation did not work at all. And it's been a pretty volatile. So it's understandable that when people looked at their first half statements, they got quite upset. Having said that, if you look forward, there are some silver linings. I don't want to in any way understate the losses because they are painful, but the silver linings. One is because valuations are becoming more reasonable, we're starting to see entry points for really attractive long-term investment. They are selective, they are individual rather than general, so they're not buying the index, but they're buying certain names that have been contaminated much more than they should given their fundamentals. So there's value being created. We also finally are seeing bonds return to their traditional role of risk mitigation. Why? Because interest rate risk, inflation risk has played out, and now we're looking at recession risk. So that's really important. And then third, something that people don't think about, we came this close to having a third risk factor. And as you can see, I really like thinking in terms of risk factor rather than asset classes. A third risk factor come together with the other two, which is inflation risk and recession risk. And that is market functioning risk. There were periods where we saw liquidity really strained. And the good news is the markets held, and we were able to navigate through the repositioning that people wanted to do.
Yeah, I gather you're talking about, say, March of 2020, one of those little scary points. Want to ask you about just sort of continuing this market conversation part about the big tech stocks and FANG and all that. You're out in California. You have some exposure to that community as well. What is your thinking on the prospects for those companies? We're in the midst of earnings seasons for them as well.
We are, and I think on the whole, the earning messages are things are not as bad as people were afraid of, and that's the good news. But what you're seeing is significant differentiation. Compare a Snap to an Alphabet. So we're seeing, and then we're seeing dispersion happen. If you like, think in terms of a distribution. Big tech is going to do fine. And then venture opportunities remain exciting. It is the middle of the distribution where you don't have scale, where things are getting more difficult. And that's why Snap is in that direction. So this is a very barbelled situation, and it's going to remain so for the next few months.
Right. So in other words, the venture, you are excited by the prospect of a hockey stick growth chart. And then on the other side, you've got these big, stable legacy businesses. But in the middle where growth has peaked, perhaps, market not so happy about that, right?
Right. And they find it much harder to compete with the giants because they don't have the diversified sources of income that the giants have. So they have less resilience, which in turn reduces their agility. And you need that agility when you're at that growth path.
Right. Shifting gears, in another recent piece, Mohammed, you mentioned the implementation of the Debt Service Suspension Initiative and the formulation of the Common Framework for Debt Treatment by the G20, which is a form of assistance to emerging countries during COVID. Were these mistakes? Why or weren't they?
So they were good intentions. Now we're going back to 2020, first, second quarter, when we've realized that this shock was a significant exogenous shock, where the poor countries in particular would need to liberate financing for COVID relief. And the official sector came in with these two initiatives that you mentioned. The Debt Service Suspension Initiative, DSSI, which basically said, you don't need to pay us. We are going to postpone your payments. And then the other one was the Common Framework, which was meant to bring different creditors together in order to provide relief to developing countries. It was a good initiative. It was well-intentioned. The implementation was disappointing. And disappointing in two regards. One is you didn't get private sector participation. The private sector ended up being a free rider on this because there was no mechanism to get the private sector involved. So the private sector continued being paid while the public sector carried the burden once again. And that's not a repeated game, Andy. At some point, the public sector says no more. We need fair burden sharing. And then if you don't get fair burden sharing in an orderly fashion, you end up having fair burden sharing in a disorderly fashion where everybody loses out. The second issue that was disappointing is that it simply suspended the payments, but didn't restructure them in any fundamental way. So now, if you look at the profile of debt servicing, there's a big bulge coming in a year and a half's time, which is somehow going to have to be navigated. So good intention. It was the absolutely right approach, but unfortunately, implementation fell short of expectations.
Another area where you've weighed in is Russia, and recently you've recommended we continue our sanctions against Russia. In particular, you've said that we should end exceptions for its energy sector. Why is that?
We're in the muddled middle right now. We have imposed sanctions on Russia for good reason. We have undermined its economy, but we've carved out the most important sector for Russia, which is energy, and allowed that to be treated relatively favorable. So the outcome of that is that Russia declares that sanctions haven't hurt it much, and we are disappointed that we haven't been able to encourage Russia to change its behavior. And the reason why is because of these carve-outs. So we can continue in this muddled middle, or we should bite the bullet and end these carve-outs, because we've done something else, Andy, that you and I will be talking about in the next few years. We've weaponized the international payment system. And we've weaponized the international payment system without any set of standards, safeguards, or anything else. And if you are in a third country looking at that, you're going to start asking yourself questions as to your vulnerability to a dollar-based system. And if we're not careful, we end up fragmenting the global economy.
Can you explain what weaponizing the monetary system means exactly?
Yeah, Russia is a G20 member. Russia is the 11th largest economy, or was the 11th largest economy in the world on the eve of its illegal invasion of Ukraine. And the notion that you would put sanctions on its central bank, the notion that you would take it out of the payment system and wouldn't allow it to settle through the payment system, was one that was almost unthinkable. That is the nuclear weapon of sanctions. Trade sanctions, sanctions on individuals, this is something we know. And you know what? There is a system that governs the trading sanctions, etc. But this was something really different. It's very powerful if you don't have carve-outs. You can bring an economy to its knees. I mean, imagine that I suddenly stop you from using any credit card, debit card you have, and all you have is a bit of cash, and I tell people you can't accept Andy's cash anymore. No matter what you want to do in terms of paying or receiving, you won't be able to do it. That's how powerful sanctions on the payment system is. So we've weaponized a really powerful tool without having the safeguards that come with weaponizing a really powerful tool.
The other big actor in this equilibrium or disequilibrium is China. And I wonder how concerned you are right now about the US-China relationship.
So it is not getting any better. It is, if anything, it is getting worse. It is particularly concerning for countries that I call having the dual option model. I mean, think of Australia. For a very long time, Australia looked to China for its economic prosperity. That's where most of its exports went. That's where economic activity was expanding really rapidly. And looked at the US for national security. It was part of the Five Eye, the intelligence system. And that dual option model had a very low price. As tensions between China and the US started to increase, that model became less sustainable. And as you know, Australia ultimately was forced to make a choice, and it opted for US national security. And as a result, its economic relationship with China has been significantly damaged. So this tension between the US and China has implications that go well beyond the US and China, and has also implications for the functioning of the international monetary system.
I know you've talked about climate change as well in the past. Does that kind of take a back seat with all these other problems going on? And is that an unfortunate consequence of, say, tensions with Russia and what Europe's going through?
It's a disaster consequence. And when we think of what we're going to leave our kids, we need to take the threat and the reality of climate change much more seriously. And the responses, the short-term responses, you were talking earlier about the immediate versus the long-term. The short-term responses to the implications of the Ukraine war has been to go backwards. Coal mines are being opened again. Some governments are subsidizing the use of fossil fuel in order to alleviate the cost of living crisis. There's other ways they could have done it. It's unfortunate that they chose that measure. So it is a concern that we are going backwards on something that already we're behind on, and that is the fight against climate change.
We seem to be in a bit of a crypto winter, Mohammed, and I'm wondering just how cold is it, and how long will this chill continue? I don't mean to be flip. How serious is this, and what's your take on crypto these days?
So any innovation that I know of, any major innovation that I know of, goes through winters, okay? And it's really important to understand the steam engine went through winters, the fiber optics went through winters, securitization famously went through more than a winter. I don't know what you call that. And there's a reason for that, which is human behavior. If I suddenly lower the barriers to entry to an activity and do it suddenly, you get typically overproduction and overconsumption. That's what we do when we suddenly allowed to do something that we couldn't do before, we hadn't thought of before. We overreact. So it is not surprising to me that innovations are never linear. They go through winters. This, depending on how you measure it, is either the second or the third winter for crypto. What it's doing is it's shaking the system, it's cleansing it of its excesses. I'm a believer that crypto is here to stay. I do not believe that we're going to have Bitcoin as the reserve currency of the world, but neither do I believe that the whole crypto is one big joke that has suckered a lot of people into it. I think crypto has significant innovation that we're going to see play out in fintech. We're going to see play out in other areas. And what you're getting is a bit of a flushing out of the system. And I think if you are a long-term player in that space, particularly in the application of the innovations that come with crypto, that at the end of the day is going to end up being a good thing for you.
Mohammed, you've lived all over the world. Now you're bouncing back and forth between the UK and the United States. What is the UK versus the United States like now? How has that changed? Maybe they used to be at parity in some regards. Are things different? Not part of the EU anymore? What's it like?
So I think the US is much more resilient than the UK. Just look at what's happening right now. Yes, the US is having difficulty with inflation at 9%, with growth slowing, but in the UK, it's called the cost of living crisis. And that cost of living crisis is giving rise to industrial action. There are strikes. People feel that it is the summer of discontent. So the systems are different in terms of their ability to absorb shocks. And then the second issue is what you just said. The UK is still redefining its relationship with the rest of the world. It had exited one regime, one paradigm, the EU, but it hasn't reestablished an equilibrium yet in a new paradigm. Whereas the US is pretty stable in its paradigms, with the exception of China. So it's an issue of resilience and stability. That's what the big difference is right now.
Mohammed, this show is called Influencers, and you certainly are one. And I'm curious as to how you see using your influence on the world.
So what I try to do, Andy, is through my writings, through discussions like that with you, through social media, is share with people things that I find interesting, thought-provoking, and hypotheses. I don't try to tell you what to conclude, Andy. I try to say, here are the certain things that you should think about. And there are a few things, there have been 5 so far as I know, when I feel really strongly, and only one in which I use capital letters throughout, where I will try and not only inform your thinking, but go well beyond and try to strongly influence it. But my role is to try and inform people so that they make better decisions. And what I appreciate most is when people come back to me and say, you're wrong. Have you thought of this? Have you thought of that?
Quickly, what were some of those 5 things, and in particular, the all caps one?
So February 2020, in the beginning, was an all cap world when I said this, what is happening in China and increasingly happening in Italy, take it seriously. This is not a thing that will stay there. COVID will not stay there. Coronavirus, as we called it then, will not stay there. The global financial crisis. Inflation. I wrote a book, as you know, in 2016, The Only Game in Town, that looked at what would happen if we continued to rely on central banks, and central banks were forced to stay out of their well-defined area of operation for such a long time. So it's that sort of thing. And of course, it was Argentina's default, which I couldn't understand in 1999 and 2000, why people were continuing to allocate so much money to a default that I thought was almost preordained because of past policy failures.
Got it. Last quick question. I have to ask you. You're a big New York Jets fan, so I have to ask you, what are their prospects for the coming season? And second part, in the UK, which EPL team do the Jets remind you of?
Okay, so the prospect for the Jets, I'm going to go through the same cycle, and you know it well, where I'm hoping that we can have a winning season. And within the first 2 games, first against the Ravens, we're going to come to the reality that this is going to be another losing season, and let's just hope we can beat the Patriots. In terms of, look, it's really funny because if you look at the teams I support, they had 1 or 2 big days, and that's it. The Jets, they haven't won anything since 1969. The Mets, they haven't won anything since 1986. And then if you go to British football, English football, I support a team that's not even in the top division anymore, that has fallen. It's called Queen's Park Rangers, QPR. So I somehow have 2 traits. I pick losers, and I'm incredibly loyal to them.
You like the underdogs, and you're loyal.
Or I turn winners into losers, and I'm loyal.
All right, you're being too harsh on yourself. Mohammed El-Arian, president of Queen's College at Cambridge, chief economic advisor at Allianz. Thank you so much for your time, Mohammed.
Thank you, Andy. It's a pleasure.
You've been watching Influencers. I'm Andy Serwer. We'll see you next time.
Let's check back on the markets today, and it was certainly a positive momentum mover today on this hump day. 415-point gain on the Dow, about 1.3%. The big winner once again, the NASDAQ up 2.6%, led by Microsoft and Apple and Alphabet and Amazon, and the same names have driven us since mid-June. All right, let's get to our panel now and check in closer on the markets. Laureen Gilbert, WealthWise Financial CEO. Omar Aguiar, Schwab Asset Management CEO and CIO. Good to see you both. Laureen, let's start with you. The floor is yours. What is driving the markets for you? What's driving the day?
Well, it is all about earnings. And we came into going into the quarter here now, looking at the last quarter, thinking we would see maybe 4% year-over-year earnings growth, it's been much stronger. Many companies have been able to maintain profit margins despite cost increases. And so it is all about earnings. And then we continue to get good data. ISM numbers came out today and they were positive in that growth territory. So, still the data that we're getting, while we are in a slowing economy, we still see positive data.
Omar, what do you make of the positive action that we saw today at the Dow closing up just over 400 points? Is some of this optimism warranted?
Well, it may be, I think it's related to positive news on earnings. Just to think about psychology for investors as we go into 2022, we have had a year where it has been full of negative news across the board since the very beginning of the year. And I think any positive catalyst that will make investors find opportunities to get into the market, they're probably being rewarded. And in this particular case, as it was just said a second ago, earnings related in a period where everybody expected decelerating of profits, decelerating of margins, warnings on outlooks is welcome. I also think that there is a component that, investors are trying to still digest the fact that they heard a very dovish Jerome Powell and Fed with the thinking that maybe the majority of the rate hikes are behind us, and that may turn out to be a little premature.
Let's follow there, Lauren. Do you feel that there is a dovish Fed talking? Or are you focused on the last couple of days with Daly and a couple of others that sound rather hawkish, wanted to almost clarify what Jerome Powell said?
Well, I think they are on a tightrope. We know that, and they know that. And so everybody's trying to be careful with what they say because they don't yet know what they're going to do next. I think we've had the 275 basis point rate hikes. I think we still see another 50 and maybe 2 more 25 before we see them really take a pause. However, they're leaving themselves enough room that if they need to take a pause sooner than that, or if they need to change that, they will. And so I think they're doing the right thing, looking at how the economy fares as these rate hikes go into effect, and then looking at what happens after that and how they're going to respond.
Omar, as it stands today, S&P up about 13% from that June low. We have seen, though, some volatility in the markets over the last several weeks. Is that what investors should be bracing for, at least here over the next couple of weeks?
I think we need to continue to be expecting volatility going forward. The amount of information that we're going to receive in the next few weeks and months, will continue to drive market volatility. And I would say it's not just equity market volatility that, is probably the more visible for investors. The bond volatility has been probably higher, in the last several months than it is on the equity side. Just the move on the 10-year yield from, 350 to where we are now at 270, it's just massive for that particular market, which basically shows a lot of the, confirmations of the fact that, we're in a slowing economy. There is a probability of a recession, and that the central banks are trying to not necessarily go too fast to try to get that recession going. So that volatility is certainly something that we'll need to continue to get adjusted to.
That move on the 10-year, Laureen, tells you what is coming.
Well, I think something to be looking at for investors is to start looking at continue to keep their bond allocations and even go longer duration at this point. But what the market is telling us is eventually the Fed is going to reverse course, right? So while we've been in this rising interest rate environment, the Fed could dramatically change that as they see the economy slowing, and then they could pull back. And so that's where there is this confusion right now in the bond markets. But for investors, as they're looking at their allocations, certainly bonds are starting to act more like bonds again, and then looking to increase the duration as those yields on the long term go up.
So, Omar, what does all this mean for portfolio allocation? Where are you seeing the most attractive opportunities today?
Yeah, good question. Well, there's no question that, the risky assets continue to, relatively to bonds, continue to be more attractive. If we are in this interest rate hike, inflation is still, pretty high. And therefore, in an effort to try to get us to the right place, the expectation that there will be a pivot by the Fed is probably way too premature. I think, the neutral rate that the Fed has set up compared to the levels of inflation we have, clearly, give us the sense that, inflation expectations may come down a little bit, but may not necessarily, be as fast as people expected, while we still have significant amount of supply chain disruptions. When you think about that, and when you think within equity markets, we are in the last phase of the economic cycle. During that period of time, the ability to stay defensive and start planning for the change in direction in the market is probably, a good strategy. So we're suggesting to clients to do a barbell where they stay defensive in a low beta, areas that will, withstand the volatility we're going to see going forward, but start position themselves for what it comes ahead, which tends to be more growth oriented, that tends to be more technology and EPS growth oriented. Stay high quality and stay in areas that will benefit from this environment.
All right, got to leave it there. Great conversation. Omar Aguiar, Laureen Gilbert, good to see you both. Thanks. Brian, good to see you. I mean, what is driving those big growth tech stocks up since mid-June?
So it's clear that the economy is slowing. And when you're in a slowdown, investors tend to pivot back towards those businesses that can generate true earnings growth and generate cash flow in a slow environment. So when you're in a recovery or an expansion phase of the cycle, you want to be exposed to those parts of the market that need that catalyst, that require an improvement in economic activity to take you higher. As the economy slows, investors tend to shift back towards the big tech companies or the big growth companies that can generate earnings. And quite frankly, they have been.
Hey, Brian, so two-part question here. I guess, well, first, do you think that there's still room to run in some of these larger cap names? The fact that they have been beaten down for so long, coming off a strong month, is that momentum going to continue?
Well, it might not be, every day in the near term. I mean, we still have challenges here. Ultimately, this is a market that's waiting for greater clarity on inflation and greater clarity from the Fed. So we can't extrapolate this forward. But in a slowdown, the larger, growthier businesses should be the outperformers. So we may not see it. There could be some near-term days of challenges if investors extrapolate interest rates moving significantly higher. But ultimately, we do think this is a Fed that'll put the tightening in. The economy will slow meaningfully. The Fed will back off, leaving us back in a pretty benign growth environment. Again, that favors the true growers.
Is it a market that's yet priced in a mild recession? And how will we know when it does? What are those lows going to look like?
Yeah, I mean, if you look at recessions like 1980 or 1991, the returns were somewhere around the negative returns were 15 to 20%. Now, the average return for recessions, the last 10 recessions, and of course, that would include 08 and 01, the average is negative 31.9. The median's negative 23. So we've done 23.4% peak to trough. I think that was from January 4th through June 16th. So you've done the median and you've done 3/4 of the way to the average. It's a process. As this works, interest rates start to come down. And so we've seen that, not necessarily in the last couple of days, but rates come down, you reassess earnings a bit, but as rates come down, multiples start to move up. So, I don't know that we're all clear here, but it's a process. And the good news is, I think a lot of that process is behind us.
Brian, we got some comments out from San Francisco Fed President Mary Daly this afternoon or earlier today saying that the markets are ahead of themselves on the Fed cutting rates, also saying that raising the Fed's policy rate to 3.4% by the end of this year is, quote, a reasonable place to think about us getting to. What's your reaction to that?
Yeah, I mean, the more that the Fed talks hawkish, and the more that if the market starts to believe that they really need to drive short rates as high as she's suggesting, then yeah, it's likely we're going to have a recession. It's still a mild one. Corporations and households are in generally good shape, but nonetheless a recession. Again, as we talked about earlier, the market's priced in a decent amount of that, but it would suggest more volatility ahead and a little bit more work to put in a bottom here for these markets. I would also say, though, let's be careful. I'm not sure that any Fed official is going to take advice from me, but let's be careful. We know that inflation is cooling. We know that the economy is slowing. And we've also known that we've had a lot of tightening in a very short period of time. It would be nice to try and assess what that tightening is doing to the economy, especially given that long-term inflation expectations in this country remain very benign. This is not an environment where the Fed is losing control of long-term inflation expectations.
Well, perhaps Mary Daly is listening, if not James Bullard, who said today, we're going to need to see convincing evidence across the board that headline and other measures of core inflation all coming down convincingly before we'll be able to feel like we're doing our job. To you, does that suggest yet another 75-point hike? Can't imagine we're going to see convincing numbers across the board by September that give them pause.
Yeah, no, unfortunately, we won't get that as quickly. So yeah, a 50 or 75 basis point rate hike is certainly in the cards. And I do start to worry it is too much tightening in a very short period of time. But while it might not be convincing, I would say look at what's happened to freight costs. Look at what's happened to gasoline prices. Even look what's happened in the bond market. I mean, the 1 year break even. So that's just subtracting a 1 year treasury from a 1 year treasury inflation protected security. That was over 6% a few months ago. It's now at around 3.5%. It has come down rapidly. And as my old mentors in this industry used to tell me, of all the indicators, the bond market gets it right most often. The bond market is telling us that inflation is coming down. So, again, if the Fed were to listen, I would advise them to tread carefully. We know what happens when there's high and rising inflation. The Fed has to combat it. The odds of a recession are elevated. Now, that may sound scary to investors, but again, markets tend to go down ahead of the recession. They tend to put in the bottoming process as you enter it. And actually, 4 of the last 9 recession stocks were positive. So, as an investor, I'm not all that concerned about the official definition of a recession. Rather, it's an economy that's slowing, and I want to be favoring those businesses that can do well in that slowdown.
Brian, investors are keeping a close eye on that strong dollar, with the dollar pairing some of its earlier gains this morning, jumping to its highest level that we've seen in about a week. A number of executives on these earnings calls over the last couple of weeks talking about the strong dollar. How big of a challenge do you see this being to the markets here, at least in the short term?
Yeah, it's clearly a challenge. And it's all about this idea of tighter policy and rising interest rate differentials between the U.S. and the rest of the world. And this is how this goes. When think about how cycles come to an end, high and rising inflation, inverted yield curve, high yield spreads out, dollar strong. And so we've seen some of that. Certainly high yield has held in, but the dollar is strong. You combine that with businesses no longer restocking inventory to the extent they were, and consumers probably slowing down a bit here. A mild recession is a reasonable possibility. But again, the markets are well aware of that. And as the Federal Reserve, as inflation starts to moderate, and perhaps the Federal Reserve can provide some clarity on when that pivot may come, you'd likely see an alleviation of that pressure on the U.S. dollar.
Welcome back to Yahoo Finance Live, everyone. Fed officials maintaining a hawkish tone this week. You've got Mary Daly, Loretta Mester, and Charles Evans, each signaling additional rate hikes should be expected. And this morning, St. Louis Fed President James Bullard weighed in. He told CNBC he expects another 1.5 percentage points worth of rate rises this year. So, is a soft landing even possible at this point? Let's bring in our next guest, University of Chicago Booth School of Business Professor of Economics and former Federal Reserve Governor Randy Kroszner. Such a great pleasure to have you here with us this morning. We'd love to get your expectations, as we're getting a ton of Fed speak, both on the increase that could be probable, that is most likely, I should say, at the next meeting, and what you would be listening for as we do get some more of the Fed speak that comes out this week.
Well, thank you very much for having me on. Delighted to be with you. On the second question, I think it's very clear that the markets heard something different than what I heard at the press conference and from the Fed when they made their decision. They seem to hear that, oh, sure, we're going to be raising rates, but we'll bring them down fairly quickly next year. I don't think that's the case, and I think that's why the Fed speakers are out underscoring that we're going to be raising rates, and I think people have different views on how quickly they're going to raise them, whether they're going to end the year around 350 or closer to 4%. But nonetheless, they're not going to turn down anytime soon. They're going to keep them raised because they need to make sure inflation comes down consistently, and then inflation expectations stay down. Because that was one of the things that the Fed got wrong back in the late 1970s. Inflation came up, they started to raise rates. Inflation came down a little bit, they brought rates down. Inflation really took off, and they had to raise rates to double-digit levels.
Randy, the investors read that conference by Jerome Powell is a potential pause in rates coming later this year, and maybe even talk of a rate cut early next year. So just listening to you, you think that's misguided, at least from a market standpoint?
I think that I agree. I think that's misguided. And I think the speakers who've come out have given a very consistent view that ain't going to happen, or at least that's not what they expect to happen. Now, of course, the economy could completely tank. And if we had to get a severe recession, then that's going to bring down demand. That's going to bring down inflation pressures, and they could begin to cut. But I don't think anyone has that as their baseline forecast.
Now, as we mentioned, you, of course, were on the Federal Reserve Board. What can you tell us about the sort of flavor of discussions at a time like this, right? Where obviously, I think there's broad recognition that Fed officials do not have an easy job of it if they're trying to engineer a soft landing. What is it like inside the room where this is all going on?
Well, I think there seems to be pretty strong consensus among everyone, whether they're more hawkish or more dovish, that the Fed needs to fight inflation, and that's their primary objective right now. Obviously, they have a dual objective, but inflation is so far away from its 2% goal, and the unemployment rate is still quite low. This gives them an opportunity to continue to raise rates while they're close on one of the objectives, which is the unemployment rate, and they're very far from the other objective. But how quickly, how much, where they should stop, and my guess is there are a lot of back and forth about that. People will be making proposals on whether they should go faster, they should go slower, looking at different pieces of data, looking at, and in particular, I think they'll be looking at the labor market. Some people will say that's going to continue to be strong. Other people saying, gosh, we're starting to see some elements of weakening. And because we're going to continue to raise rates, the labor market will weaken considerably, which is my view.
And so, Randy, with the Fed being far away from its 2% inflation goal, as you were mentioning a moment ago, plus unemployment still being quite low, how would you describe the landing that should be anticipated?
That is the $9 trillion question. That's the size of their balance sheet. We haven't really been in exactly this kind of situation before, where you've got such strong underlying economic growth and a persistently strong labor market, and these supply shocks that are facing us, plus war. So what they're hoping is that they can raise rates, let's say, into the 3.5% to 4% area by the end of the year or early next year. Hold them perhaps in the low, around 4% or low fours for, let's say, 6 months or so. During that time, the unemployment rate is going to be coming up, but not going up too high. I mean, we're starting at a very low level at less than 4%. They're hoping that they can perhaps, they report that they don't think that that unemployment rate is going to go much above 4%. I don't think that works because you can't raise rates so much, have so many negative shocks coming on the economy, and only get the unemployment rate to just slightly go above their long-term average. I think it's going to go higher than that. But let's say it just gets into the 5s. That's a significant increase in the unemployment rate, but still pretty good by historical standards. That would certainly be a soft landing. The thing that we worry about is that the unemployment rate may go to 6% or higher, because there'll be continuing negative shocks from the war, from sanctions, and obviously geopolitical tensions in Asia. And so, unfortunately, I think that the shocks are more likely to be negative. And so we're in kind of a fragile situation as the Fed raises rates, and that could push us away from a soft to softish, or even landing and even into recession.
Okay, and so you've kind of laid out what the soft or softish landing would look like. So again, just to kind of re-ask the same question, excuse me, because if I've got to describe this to my mother when I go back home, she's going to want to know what she should have in her mind as she's evaluating the economy. What type of landing, what type of picture should I be painting?
So I think she should be prepared for a recession. because I think we do have an elevated probability of recession. I don't think that's baked into the cake. It's not necessary, but I think it's very likely from a combination of higher interest rates and negative shocks that'll come in from war, sanctions, geopolitical tensions, et cetera. So I think if you're thinking of building your portfolio, make it a defensive one against the possibility of a recession. But I do think the Fed is going to be able to bring inflation down considerably. I don't think they're going to get to their 2% goal by the first half of next year, but inflation will come down. But a defensive portfolio, because the chance of things not going so smoothly are reasonably high.
Is it, just staying on the recession, Randy, is it a devastating recession, as Elizabeth Warren has been floating out there recently?
So I'd say most indicators and most economists would suggest that we're not there, that given how low the unemployment rate is, given that inflation expectations have not taken off. Remember, the last time that we had inflation this high, 40 years ago, interest rates were in double-digit levels. People don't believe me that can happen, but it can. If you got a mortgage at 12%, that was a great mortgage. And so we're far from that. So I don't think that the Fed's going to have to go to that level. And so I don't think we're going to have a devastating, early 1980s type recession. But of course, there are a lot of shocks that could come in that really have nothing to do with the Fed that could make things worse. But I don't see that is my baseline scenario.
Two of the things that have nothing to do with the Fed, they have no control over energy prices. They have no control over the supply chain right now. And so what particularly in both of those scenarios would you be looking for to take place in order to kind of alleviate some of the concerns that consumers may have, even if they should be bracing for a recession, as you were mentioning?
And so on the energy side of things, I think we're not going to see a lot of investment to unlock hydrocarbon resources in the short run. There are too many uncertainties about that, and the Biden administration is kind of of two minds on this. They want more production in the short run, but they also say we want to go green and are going to potentially be taxing or taking away support for traditional energy sources going forward. These are long-term investments. You're not going to see an investment coming in there. We just had an OPEC Plus meeting where we've gotten very little increase in supply. So I think if you're looking at energy, the main hope, unfortunately, is that demand will fall off as the economy slows down. I don't think we're going to see an enormous, again, unless there's more geopolitical tensions, sanctions, et cetera. I don't see an enormous spike in energy prices from where we are, but I don't see them going down to where we were last year. I think they're going to remain elevated.
Great analysis for us here this morning. Randy Krasner, University of Chicago Booth School of Business Professor of Economics and former Federal Reserve Board member. Good to see you.
Quite a bit of commentary from Fed officials already today, with more coming soon, as I was mentioning a moment ago, as markets try to gauge where the central bank is headed and where their head's at. Our next guest says that the Fed hawkishness has likely peaked along with inflation, but how long will we stay at that peak is a different story. Let's bring in BlackRock senior macro strategist for iShares EMEA, Laura Cooper. Laura, great to have you here with us today. First and foremost, just help us break down if the Fed hawkishness has actually peaked and inflation, if that's peaked as well here at this point.
Well, I think there's probably a scope for Fed hawkishness to persist, but what we're seeing in terms of rates markets is actually this recalibration of expectations after markets really interpreted last week's FOMC meeting with a dovish tilt. So clearly we are seeing Fed members come out today. We had speak yesterday as well, really just confirming the fact that this is a Fed that really it wants to ensure price stability, and that is likely going to come at an economic cost.
I'm always fascinated here, Laura, where the Fed essentially says the same thing, then repeats it, and the market reacts completely differently, right? And I know that your focus is EMEA, so that doesn't just happen here. It happens with regard to the ECB and other central banks too. What gives?
Well, I think it's a great kind of context right now in the fact that we are actually seeing central banks deviate away from forward guidance. So it leaves markets with a little bit more uncertainty about the path going forward. So if we look at both the Fed and the ECB are data dependent. So we would expect that that sets up for a greater bout of volatility, notably until we get those September meetings, because we are still seeing inflation pressures come into the upside. In the US, as we just had that ISM services print, does suggest that growth still remains fairly resilient, whereas in Europe it's quite different. So it's really a backdrop where this data is going to dictate what central banks are going to do. So that leaves markets trying to guess, which is underpinning this volatility.
Laura, do you think markets here in the U.S. are underpricing the probability for an economic hard landing in Europe?
I think, for an in Europe, that's a great question. I think, our base case is that we're likely going to see a recession come through in Europe on the back half of this year. Certainly the Q2 data didn't suggest that just yet. There is this resiliency in Europe. But if we think about the PMI indicators are coming in softer, we did have unexpected contractions in France and Germany. And as well, if we look at consumer sentiment, this is deteriorating quite markedly. That does set up for quite a challenging backdrop through the latter part of this year. I think there's pockets where markets are not accurately pricing that in, notably equities, which is one of the reasons why we actually prefer to take exposure in credit over equities at this current juncture.
For those who do have exposure in equities, though, and perhaps those equities names that they're invested in also have a significant exposure into Europe, what would you be advising them in their own strategy right now?
I think it's really all about a case of being quite selective. So we still advocate for a barbell approach in portfolios, but certainly what we are seeing is that there's likely the need to be a little bit more tilted towards the defensives. If we look at what came out of the recent earnings season, notably tech was fairly resilient. We did have, better than expected earnings come through there. That does advocate for what we expect to be really these secular underpinnings going forward of a robust demand backdrop. So we wouldn't want exposure there. And as well, more of the defensive sectors, you think about healthcare, utilities, staples, I think it's really hiding out in that type of environment, regardless of whether we see a downturn in Europe, which is our base case, and the US potentially more so later next year.
There's one other thing that you guys recommend as a hedge for tail risks that stood out to me, and that's gold. And it stands out to me because it hasn't worked so well, right, as a hedge thus far this year. Is it more just insurance to hold in case something truly outside the pale happens?
That is the case. I guess it's the context of how we perceive a hedge. So if we see it as an inflation hedge, it certainly hasn't worked out that way. But in this environment where we have actually seen real yields take quite a bit of a tumble since mid-June, that has provided a little bit of a tailwind to gold. But when we think about it, it's more of a diversifier in portfolios. So it's not our base case that we are going to see an escalation of geopolitical tensions or a material severe recession in the US, but you'd want to have that exposure in portfolios should any of those tail risk scenarios materialize.
BlackRock senior macro strategist for iShares EMEA, Laura Cooper. Always good to see you. We'll talk to you soon.
Shares of Airbnb have been declining this morning after the company reported earnings after the bell last night, beating on the bottom line, announcing bookings of over 103 million nights and experiences. That was a record high, but it was lower than estimated. For more on Airbnb, we're joined by Oppenheimer's Jed Kelly, who tracks the company. And Jed, I actually want to take a bit of a step back first before we dive into these numbers, because one of the comments from the CFO really stood out to me on the call, Dave Stevenson. He said, "We don't know what the economy is going to bring, but we do know that Airbnb is resilient to almost any kind of economic shock." I don't know. I feel like a company saying that's kind of jinxing themselves a little bit. What do you think? Is this a resilient company?
Well, you got to remember, if you take a step back, the company was founded during the 08-09 financial crisis, right? And typically what we've seen in a recession, this is true with the other OTAs, Expedia and Booking, is you typically get more supply. So what I think David means is that in a recession, you likely see consumers trade down, so you do see ADR compression, but you would actually potentially see more people list their homes or list their rental properties on Airbnb, increasing the supply, which should make volume all right. The other thing you generally see too with the online travel companies is the margin offset they get from lower ADRs. They can actually offset with lower sales and marketing. So that's what he means by resilient. And even if you take a step back, obviously, the street lowered their room nights for next year pretty dramatically. However, EBITDA actually was up, right? I think the EBITDA didn't change that much for next year. So that's sort of what we're saying is, and that's what he means. They will still drive a highly profitable, high free cash flow generative business in a recession.
And so in this perhaps environment where we're going to be watching how closely the consumer, because in past recessions, consumers would lean into loyalty, they would lean into where they're getting the rewards from as well and capitalize on those. Is that an implication that Airbnb should be concerned with? Is that something that you believe that they're going to have to kind of problem solve for in this near-term period of time as well?
No, we saw in 08, 09, booking grew rich room nights. Now they were a much smaller company, but they still grew, book room nights over 50%. So what you see in a recession, even though you have loyalty like through Marriott or Hyatt, right? But that's a small segment of the population. Most people in a recession comparison shop, right? So you would expect them to go to Expedia, but you'd also expect them to go to Airbnb because they have such a strong brand name. And I actually see them in a recession, just given their unique supply, given their, over 6 million listings. I think they'll be fine in terms of demand generation. The reason we have a performance just on valuation, it trades over 23 times our EBITDA. And we see a risk to multiple compression if we go into a recession.
Jed, a lot of focus in tech land on hiring and firing. Now, Airbnb, they cut to the bone when the COVID-19 pandemic was really taking hold. Are you happy with their expense structure now? Do you need to see them take more actions?
No, they're investing in the business. I mean, they're this third quarter, they're calling for 49% EBITDA margins. We have margins expanding probably 50 to 100 basis points next year, and we still have them developing product and tech and operations and support. If you look at the design, right, they're spending a lot of money on their design. They've done a great job with categories. They've done a great job with flexible search. I mean, the management team's executing flawlessly. So, who are we to say, they're spending too much or too less, given how they're positioned. And if they think they see share gains, especially with onboarding more hosts, I would expect them to invest.
Jed, good to catch up with you on this. Oppenheimer analyst Jed Kelly on the Airbnb numbers. Thanks. Let's talk a little bit more about inflation. We don't talk about it enough, but we're going to take a different angle here. The textbook definition of a recession: 2 consecutive quarters of negative GDP growth. A lot of the recession fears today having to do with inflation, but many experts weighing the term against a number of other measures, some of them a little unusual. Let's take a closer look at some of these alternative ways to measure sentiment. And first up, I want to take a look at the Champagne Index. A couple of important things to point out here. Now, the pattern tends to go that champagne sells well in good times because people are excited, they're celebrating, willing to spend some money, and then sales fall during economic downturns. Putting some numbers here to what we're seeing, consumption hit around 15.8 million bottles in 87, then crashed during the recession that followed, down to 10 million in 92. Similar with the Great Recession. When you look at 2007, 2006, 232 million, that would be a lot. 23 million bottles were consumed in 2006. That plunged to just over 12 million in 2009. And Dave, 2022, the numbers out so far, it doesn't look that good. Now, we don't have the official numbers from the Champagne Trade Association yet because we're only just over halfway through. But the Nielsen IQ data showing wine sales have been falling every single month this year, comparing that to last year's number. In May, dropping 7%, June dropping 8%.
That's shocking, given this is a record year for weddings. I would have thought champagne sales would have been through the roof this summer alone.
Not picking up the slack.
My favorite indicator of a looming recession is the MUI. You haven't heard of that? It's the men's underwear index. And that's not my theory. That's Alan Greenspan, the former Fed chair, that did like to chart this in terms of a looming recession, because that's when men begin to cut back. They begin to say, okay, times are tough. I'm probably not going to upgrade the underwear. I'm going to stick it out, deal with a couple of holes, maybe some worn out undies, boxers, briefs, whatever you happen to prefer. We saw it plummet 2007 to 2009, and you see it begin to recover again in 2010. That also happened in 2020 at the beginning of COVID. And I have to say, I didn't know this theory, read about it this morning and thought, yep, I really have cut back this year on buying new underwear. It's just one of those things you draw out a little longer when times are tight, Rochelle. This one is spot on.
Yeah, I noticed that's just for men's underwear. I don't know if women are willing to sacrifice that as much as men are. Now, the one that I'm watching is actually called the Hemline Index. So this is basically an index that shows that the better the economy is doing, or when there's a bull run, we tend to see hemlines get shorter. And then we did see this in the Roaring '20s. We saw then, of course, the long dresses came in when the Great Depression came in. And then you had some of these mid-length outfits during World War II. And most recently, we saw miniskirts really coming back right before the pandemic. Obviously, equity markets doing well. The economy was doing well. But then, of course, the COVID pandemic adds a bit of a twist in there, because obviously when you were home, people were wearing comfortable clothes. You saw a lot of these maxi dresses coming into fashion. And compare that to what you saw with the shorter dresses and skirts in the 60s and the 80s when there was a millionaire boom. So it'll be interesting to see what happens now with fashion if we just sort of give up because it's all just too much between the pandemic and inflation and everything else. So we'll see if that's one that will still hold the test of time. We'll have to see. Dave?
Interesting indicators indeed.